what's your view on where this thing is going? Is America winning? Is it losing? Or is it trapped?
I think the IRGC has been preparing for this kind of fight for over 50 years, since, 1979, almost 50 years. Between tunnels and low-cost energy, it has definitely taken away the advantage of American air power, and an enemy that doesn't wish to be defeated and certainly does not wish to admit any kind of setbacks. I think the Israelis killed all the wrong Iranians. They killed the most moderate ones, the ones that we should be negotiating with, like Laranjani. And instead, the most radical ones have survived, and we're suffering the effects of that. So, just like just like the North Koreans don't really have to have nuclear weapons, because they can have 15,000 artillery tubes pointed at downtown Seoul. In the same way, the Iranians can still very much affect the traffic in the Straits of Hormuz with conventional means and unconventional means, but not nuclear weapons. And that gives them a significant strategic advantage, which they've played. And so this is, without a ground force, I don't think this, I don't think for all the talk of regime change, no one had done the preparation of actually organizing an armed resistance to affect the realities on the ground. No campaign has ever been won by air power alone. And so those strategic deficits are now showing themselves, unfortunately.
Well, Eric, it sounds to me like you're saying that the United States is not winning here. It's either losing or trapped. Of the latter two, which one is it?
I don't think they're trapped. And I would say, look, the United States is a superpower. It outspends the Iranians by multiples to one. The Iranians continuing to persist is definitely a strategic setback for the United States. And so finding something to take away that leverage that the Iranians have, which is what we're trying to do. Give customers in the Gulf means to protect their assets so they're not held hostage to Iranian drone and missile attacks as a means of negotiation, which is certainly going to be the case unless a company like Vectis helps protect them.
Eric Prince there. Stay with us here on CNBC. We are back in 2 minutes. Good morning.
One hour of added insight every morning doesn't just add up, it compounds. 1 extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC.
Just go and talk to Keith. American soccer legend Landon Donovan. He'll explain how the 2026 World Cup could shape the future of Major League Soccer and the inner demons that drove him to greatness.
I was constantly chasing this insatiable desire to be noticed.
He's the man behind Apple's sports ambitions. In an exclusive interview, we talk about the tech giant's unique sports strategy and whether a blockbuster acquisition is on the horizon. This is CNBC Sport on the Record.
Listen to CNBC on the move with the CNBC app.
A check on how Europe is set to open the trading day.
Real-time market updates. Strong number this morning. Listen wherever in the world you are. Download the CNBC app now.
And whether a
Welcome to Closing Bell Overtime.
Get the essential post-market edge.
A very busy overtime.
After-hours action and opportunities.
The economic impact is just beginning.
What happened today?
The market had to resort to defense.
We've got a developing story out of Washington.
What's moving in real time?
What do the numbers tell you, pro or con?
Be ready for tomorrow after the bell.
There's a wait and see about a lot of things for tomorrow night.
Completely.
Melissa Lee, Mike Santoli, Closing Bell Overtime, CNBC.
Okay, welcome back to Access Middle East. Some other stories on our radar this morning. First up, France, Germany, Italy and the UK, as well as Canada, have issued a joint statement condemning Israel's construction plans in the West Bank. The project sees Israel opening up tenders to build some 1,200 settlement homes in a strategically important and occupied part of the a strategically important part of the occupied West Bank. The joint statement called the move unacceptable, undermining peace, and urged Tel Aviv to retract the plans immediately. Separately, the UN Secretary General has also condemned the plan. Jordan's King Abdullah has arrived in Beijing to continue his week-long state visit to China. This marks King Abdullah's 9th visit to China. He had visited Shanghai and Shenzhen before arriving in the capital. He's expected to meet with China's President Xi Jinping to discuss regional issues. And the trial of the man accused of building the bomb that brought down Pan Am Flight 103 over Scotland in 1988 is moving forward with jury selection. Libyan and Tunisian national Abu Aguila Mohammed Mossoud Kahir al-Marimi is the first suspect to face criminal charges in the United States. A bomb exploded on the Boeing 747, killing 270 people as the aircraft crashed into the town of Lockerbie. Libyan intelligence agent Abdel Basset al-Magrahi was convicted on 270 counts of murder in 2001 and jailed for life in Scotland. He was released on compassionate grounds shortly before his death in 2012.
Yes, the king really is the fiercest one of them all.
Back to the market session now, and a mixed bag of results for Chinese tech giant Alibaba. First quarter profits slumping after ramping AI capex, but strong AI demand fueled growth elsewhere. CNBC's Emily Tan joins us live now with more on the numbers. Hey Ems, good morning. What can you tell us?
Hi, Dan. It's good to see you. And this slump that was reported by Alibaba in its June quarter, that comes as the company really spending more on AI infrastructure. It was a 75% drop in profit as capex surged by the same percent. So capex at $10 billion with profits of $1.57 billion. The tech giant is making investments to build out compute capacity, and this really, they say, reflects fluctuations in procurement cycles, an increase in CPU capacity, and higher pricing in chip components. CEO Eddie Yu says that the ramp up of their own proprietary chips will replace commercially procured chips in their data centers, and in result, this will have higher gross margins as well as profitability. Alibaba made a strategic shift, or they streamlined their business segments in this quarter, and this, they say, is to help better integrate their commerce and AI businesses. They have, of course, their e-commerce business, which combines domestic and their international operations together with their grocery chain Fresh Hippo, and revenue there was $30 billion, up 4%. AI Cloud and Compute Services covers their cloud business and their T-Head chip unit, and this is a portfolio of proprietary silicon, which includes GPUs, CPUs, and of course storage and networking chips. Revenue there jumped 45% to $7 billion. It is the Genwu chips, as they are known, and they have achieved broad commercial adoption. They've been used in over 650 commercial customers, spanning 20 different industries across autonomous driving, internet, and financial services. Then there's AI Labs and Applications, which includes their AI models and Qwen Consumer Business Group. For Qwen itself, they recently most launched their 3.8 Max, and this is now the world's largest open source model, with accumulating something like 3 billion, with a B, global downloads in the last 6 months, eclipsing the likes of Meta and Alphabet and a lot of the domestic peers as well. Alibaba shares, though, in Hong Kong trade down as much as 3%, and shaking off the 1.2% gain that we saw in U.S. trade. Dan, it's back to you.
Ems, good to see you. Have a great weekend ahead. Thanks for joining us today. Staying in the AI space, and this week the Saudi-backed AI firm Humane made the move into hardware, showing off its new laptop design. CEO Tariq Amin confirming that the device is made with Qualcomm chips under the hood. It is an ambitious step into consumer technology. It's a Saudi-made laptop powered by Qualcomm's Snapdragon processor and its own operating system. Instead of clicking through the apps, users can speak to the device using language commands with dedicated AI buttons designed to trigger assistant features. Now, while the details on pricing, availability, and real-world performance remain limited, the device is drawing attention as one of the region's first major consumer tech plays. It was first unveiled at Qualcomm's Snapdragon Summit in Hawaii last year, and an updated version is expected to be showcased at Leap in Saudi Arabia, which is taking place later this month. I wanted to get more on that and bring in Meli Murat, who is an Associate Research Director for IT Services and Software at IDC. He joins me live from Istanbul this morning. Meli, welcome into the program. I'm sure you also saw this vision this week from Humane, which has been teasing this Saudi AI laptop. But what's your take on this? Is the laptop really the story, or is this about Saudi Arabia trying to build an entire AI ecosystem here?
Oh, thank you for having me here. So what's happening here, I think, is greater than the laptop itself. Laptop is a game changer, but when you think about the evolution of the Saudi market, what's happening here is like the Saudi market has been a consumer of emerging technologies for quite some time. But now the country is no longer just a consumer, but also builder and trying to be an exporter of emerging technologies. So this is part of a bigger picture. And what's so important here is Saudi government has set its Vision 2030, which is basically the economic diversification strategy of the country. And this has enabled both public sector and private sector to transform its operations by using the emerging technologies, especially AI, so that they can serve the country's goals. And actually, there are lots of things happening right now, and Humane is, I think, at the center of this transformation. Humane is not only providing just a laptop with a transformational operating system approach, but Humane is also providing like many other capabilities around compute, like CPU, GPU capabilities, data management capabilities, industry-specific applications, and many other innovative solutions along with it. And the company is not doing it itself, it's trying to achieve all these things together with its ecosystem partners. And we expect the Saudi Arabia market to reach out to like $8 billion for AI spending by 2029. So what's happening here is quite big. And by the way, one final remark on this. In the past, when we talk to organizations in the kingdom, we used to show them best practices from US, from Europe, and so on and so forth. But right now, we started showing Saudi Arabia the best practice in certain areas to other countries around the world.
Yeah, Meli, and this is such an exciting announcement. I actually don't recall another device from the region that has attempted to tap into the consumer tech market. And exactly what this device is going to be able to achieve, I think, is going to be very, very closely watched. To a broader point, though, of course, Apple, Microsoft, Google, look, they all already dominate consumer computing. So what do you think Humane and Saudi Arabia have to offer that would make anyone make the switch to this device?
Certain that Kisame marks the island's coordinates on the map.
Decades,
so even if we move the island, we can't let our guard down.
Consumers have selected products that have redefined the experience. So, and as a business idea, what Humane has offered is quite transformational. So what they are saying is, you are no longer just going to click on an icon, but you are going to interact with the operating system in natural language, and you are going to do what you want to do.
And since you can fly, you can get there faster than anyone.
And I think the experience here is the thing that is gonna help Humane, start, expanding its presence in the market. So I think it should start with the customer experience, and then should go backwards to the hardware and other capabilities, because the experience is what's gonna matter in the equation.
I said I know.
You mentioned experience. As you say, the pitch is an agentic computer that acts on intent rather than forcing users to jump between apps using a mouse or hitting letters and numbers on a keyboard. Is that where personal computing is heading, just more broadly? What we're seeing right now from Saudi Arabia is what the future is going to look like for other major device manufacturers and compute companies globally. Is that fair?
Akatsuchi. We could be heading straight for a battle for all you know.
Because as we evolve with this technology, as we learn using this technology, right now the
So
consumers,
embarrassing.
but also the businesses. They want to do what they want to do in the fastest and the most effective way possible.
Damn that
And with
Akatsuki.
all these agent capabilities that are embedded into this,
Yes, I have
computers, these devices, we
Well,
can ask
looks like you're
for
finally
something
awake.
that we want
Now, my
from
jutsu is a little
an
different
application,
than Motorola
and it's going to make
With
the
this
decision
method, you won't be
on our
completely held
behalf.
back.
It's going to
Hear
just
me,
drive
Data?
turn
I
our
must tell
intent
you I know
into
little about
execution
art.
on the device itself.
And not a lot
so we
about
don't
you
need to
either.
click on an icon,
Yes,
but we
of
can
course.
tell the device
My
what we want.
artistic
We can
ninjutsu
tell
is
the
simply too
application what we
sublime to
want,
be easily
and it's
understood
just
or
going to carry
appreciated.
out the task. Of course, we are
However,
going
I
to
am
control.
quite grateful
We are
to
going to
you.
tell it what to do.
I've already
For
perfected
example, we
one
want to
ultimate
schedule a
art after
meeting. We
all.
can just say
But
it,
now I
we
can take
give it
my
the
art
date,
even
and it's going to
further.
schedule the meeting. It's going to
Actually,
send out the
speaking
invite.
of
And
which,
as you
that
can
final
understand,
explosion
there are
of yours,
multiple
it didn't
workflows
really
here,
create the buzz that
and
you
with your
wanted,
command,
did it?
it's all going to be executed rather than clicking on buttons or icons. Like what you tell is going to be translated into real-world action. So I think. And it's not going to be a slow transformation. I think it's going to be a rapid transformation. In a couple of years, we will probably see more, consumer devices with such capabilities. And this is going to redefine the market, I believe.
What, you want to fight again?
Any thoughts on how much it could cost?
Oh, damn it. It is way tougher than I ever thought it would be getting all of these animals inside there.
Right now, the team in Saudi Arabia is working on how they package this in the most viable way possible. But what I'm thinking is it's not going to be a standard like retail
hide the animals inside the giant turtle trap.
We can see some subscription-based pricing methods or some other alternative pricing or purchasing methods. So again, I think we should expect some business model innovation on that front. So rather than just paying the money and owning the device, we can have a subscription-based model. That's also one viable option. But this entire war is about protecting Naruto after all. On the commercial engagement model, but we will see some innovative ways of like people can get access to this,
the island should be right
it's
around
not
here.
just going to be only on a simple
And the
like
commercial
fixed price-based model.
Fair point. On the commercial side, this matters a lot because it all comes back to returns. Saudi Arabia is spending huge dollars on AI infrastructure. Where do you think the commercial return is supposed to come from? And more broadly, are Gulf governments at risk of building too much AI infrastructure before there's enough demand to use it?
What's up with that bird and digger?
Oh, it's really him.
This is something we are also working on at IDC. So the AI economics is a major challenge, as we just heard on results. So everyone is right now investing in capex in a big way, and they are expecting big returns from it. The returns, when we look at the demand in the market and the way market is growing, I think there will be enough demand. And the advantage of the Middle East market is like not only Saudi Arabia, UAE and some other countries, they're also investing in AI infrastructure. And the thing is, there's a supply chain crisis in the market, in the worldwide market still. And these are the countries who managed to build or started building such advanced AI infrastructure capabilities. And probably they will be the ones who are providing such capabilities to other countries who are constrained.
What's so
in terms
special
of the
about that
chipsets
turtle
or
island?
the cloud
The 8 and 9
services
tails are on
access.
it.
So
The 8 and 9 tails are both right here.
Another hub.
Then that damn Naruto is down there, huh?
Infrastructure hub for the
Isn't he the perfect opponent to exhibit your art to? First, we stop that island.
Are going to be delivering a return on investment. But of course, it's going to take time. But at the end, I think this country is going to be a kind of like global AI hub for the world. So it's not only going to be US, it's not only going to be Europe, or it's not only going to be, China, but the Middle East region is also going to be rising as an AI hub, an infrastructure hub.
That's interesting you said that as well, right? It's interesting you say that as well. We have heard this. We know the Gulf has the capital, it has cheap energy, but it doesn't quite have that Silicon Valley style technology ecosystem yet, right? It's still underdeveloped. So what do you think is still missing, and what's the biggest barrier to some of the ambitions that we hear about in the region?
Has always been shy, and if you're trying to check its gender, I can see why.
Silicon Valley
Who's to
is
say if it's a girl or a guy? We're speaking out against this abnormality, which reveals your purpose,
and so on and so forth. And the good thing is, I want to look at this from the buy side. The thing is, like, if you go back 10 years ago, we were talking about a startup ecosystem in the region. But right now, with
it
all
don't really matter which this one is.
are
There
also
is an
enabling
say
a
it's a
startup
girl and finish this
ecosystem.
business.
Right now, global talent started to come to, to the region. And it's not only, they're not only coming to Dubai or Abu Dhabi, they're now coming
just
to
look at
Riyadh,
this.
and they are
All
coming
these
to Saudi
markings that
Arabia
are on
as
its
well, and
back
other
make the
countries as
kanji that
well.
reads male.
So I think the
It's a
talent
coincidence,
is
just a
one
pattern.
important thing.
I have
And
a
there are a
real
number
bad
of startup
feeling about
initiatives
this
right now in
thing.
the region, and they are trying to build an ecosystem. Even Humane
Look,
has
can you
an
just ask the
organization named
armadillo, please?
Humane
You're their
Ventures who are
boss,
trying
right?
to empower startups. So
Well,
I
what's
think
the
this
story?
is the beginning. These are the early days. But I think we are going to hear more and more startups coming out of the region with all these investments
Oh, really?
and
That's the
government
way it is?
incentives.
Come on,
Because
how am I
right now
supposed to
these
finish all
startups are
this
not
stuff
being
up?
left alone.
This
The
mission's living up
governments
to
of
its
these countries
ring.
are
All right, you're
taking quite
really.
proactive
Well,
approach
male and
in
female.
enabling an
There are some
ecosystem.
species that are able
For
to
example,
switch
we
between
have
them both,
Venture
y'all.
One in
But
Abu
check
Dhabi,
it. The
which
heavens
is
and
like
earth
trying
can't
to
switch
build a
places,
huge
y'all.
portfolio of
Ooh,
startups.
yeah, ooh.
We have a number of organizations in Saudi Arabia who are trying to enable a startup ecosystem. So, of course, Silicon Valley is a very, very high ambition, but I think we are going to hear more startups from the region.
Melly, come back soon. Great to have you on today. Thanks for joining in. Melly Murat there.
My pleasure.
From
Thank
IDC
you.
live with us out of Istanbul this morning. Well, elsewhere, Micron Technology just announcing a $10 billion research center at its Boise, Idaho headquarters to develop next-generation memory chips for AI applications. CNBC's Jim Cramer spoke with the CEO. Take a listen.
We are very proud that Micron is investing in the future of Americans through this $250 million commitment to the commitment to secure the
You took me a
financial
little bit
future
by
of American
surprise because
children
I heard
with
that you were already dead,
$250 commitment in 7 different states in counties
So
where
that
the
was
income
the Tsuchikage
is below
stone clone.
$150,000.
It seems we
And
were thinking
with
the
the Trump
same
account
thing.
launched about a month ago,
Look at their data.
what we are seeing
I thought you
is
blew
that
yourself up in a
50
flashy
million
explosion.
of that
Does that mean that you
$250
didn't
million
die after all?
of commitment
Don't get
is
excited,
already
Akatsuki.
being
Why not?
deployed. Of course, we are
Merely
working with
Orochimaru's
Treasury
reanimation
to
jutsu.
get that money
It
into the
burns
accounts of
much
but
faster
than I
but
thought.
he isn't the
Already
real
$50
deal.
million, you know,
Still
in
causing
these 7
trouble,
states.
even in death.
And by the way, it's not
Youngster
only this
from the leaf
$250
defeats
million
you,
commitment
and then
to
you have
Trump
the gall
accounts.
to try to sneak
Micron,
back in amongst
here
the
in
living.
Boise, Idaho,
Just shut up!
$75
I killed that damn
million
Sasuke
commitment
Uchiha!
toward community
And
investment
because
fund
you mocked and
to
insulted my
work
art,
with
you
the
old
community
geezer!
to add
You'll
the
be
enemy of
next!
the community.
working
best
with the
friend.
community
Seems
to
Data
support
doesn't
the
know
community
anything.
through housing needs,
That's enough.
transportation needs,
You're both
and
mine. You
of
can't
course,
escape
for the
me.
welfare and quality of life.
You
improvement
actually
in the
believe you're
community.
stalling us
In
here,
Clay,
don't
New York,
you?
Micron has
I knew
commitments
there was going to be an
of
ambush.
$250 million.
Do you
Again,
think I'd
working with
saunter
the
in here
community
without a plan?
for education,
What do you
for
mean by that?
schools, for STEM education, worker training, yes,
Inconceivable.
transportation,
We've been found
as well
out
as
already.
housing. So
It can't
Micron
be.
really works closely with communities where
Motori.
we have operations.
Okay, now one last thing on your tremendous labs announcement. Jensen Huang, Micron is taking on one of the greatest challenges of the AI era, reinventing memory technologies and architectures to fuel the next generation of increasingly powerful AI systems. We won't be able to do the robots that we want without you. We won't be able to do the self-driving cars. Maybe we can't put people on Mars without you. All of this stuff is determined by memory right now.
So correct, Jim. Memory is today essential. I mean, that's why I call it strategic infrastructure.
Sorry,
of the
but
AI
we need to
era.
go over there.
Memory is
And
essential
why is that?
across devices, across technologies,
My body isn't
across
responding
product
to me.
solutions.
What
And
are
we
you
are very
doing?
proud to
Go
be
away.
able to partner
He's
with
already
this
found them.
ecosystem you see in our press release today on
Right.
Micron Research
Yes,
Labs.
sir.
Leading institutions and leading entities from US are partnering with us to drive America's leadership in semiconductor technology.
Moving on now, let's get you an update on how Bitcoin is trading right here, right now. Some appetite may be rebounding here. BTC sitting back above 73,000, actually edging towards 75,000 there, better by 3.23% this morning. Some of the other coins also catching an upward draft. The sector continuing to get a lift from President Trump's efforts to push Congress to pass legislation establishing clear rules for digital assets. CNBC caught up with the Coinbase CEO Brian Armstrong overnight to discuss some of the key takeaways from his recent meeting with the president.
The 8 and 9 tails are both down there.
Clarity Act is coming up for a big vote.
This is our opportunity to capture the both
on September 15th, and it represents a lot of bipartisan work. The president was keen to mention that, and thousands of hours from the Senate and House have gone into getting this to be bipartisan legislation. It's also a good bill for law enforcement to go protect against illicit activity. It's a good bill for the banks. It gives them 13 new powers to go grow their business. And it's good for the crypto companies. And most importantly, it's good for the 50 million or so Americans who own crypto.
Brian Armstrong there. And stay with us here on Access Middle East. We'll be right back.
Do it now. Right.
Abu Dhabi has now been branded as the capital of capital. There really are few places in the world where the concentration of sovereign wealth funds and smart investors.
It's a great place to work and live. I mean, living in Abu Dhabi, it's a very safe, secure city.
I love it so much, I don't think I'll ever leave.
Any company that's looking to grow and expand, really look at the Hub 71 Accelerator Program, the ADG ecosystem. We couldn't have found a better home.
Everything is there for you to succeed here.
The entire world might flip over. But a man
Welcome to Europe Early Edition.
This is no time to be doing an ecological survey on ourselves.
Into a record Q4. Parliament continues to stay very fragmented. Prime Minister, it's a pleasure to be back in Athens.
It's a pleasure to talk to you, sir.
Something's definitely
Here's
going on
what investors are
However,
watching this
still
morning.
have to maintain
Be there for the opening bell.
Welcome to Squawk on the Street.
What's
And
moving?
let those
The
two
biggest
go
guests, the
outside.
market action.
Right here.
We're
Squawk
just
on
going
the
to have to
Street,
handle it ourselves.
CNBC.
I was studying molecular biology, going to grad school. I started investing a little money for my dad, and I got bitten by the bug. I was a stockbroker, and it's fun, but we all wished we could
You
just
go look for the 8
follow
and
the
9
markets
tails.
and talk. My ambition was
I
to
will
be able to
fight
pay
these
my
three
bills
here.
and not have to
I owe them
constantly be
nothing
selling.
less.
In today's world,
Fine,
I would
but don't
urge
take
a lot
long.
of people to get financially savvy. Squawk Box and CNBC, it is my home. It's the greatest job in the world.
You shall feel your Great. Looks like the geezer snapped. You do remember this, don't you? This just keeps getting worse and worse. Don't tell me he's going right to particle style. This looks bad.
Okay, coming up on the next episode of Managing Middle East, we are going inside Altera. Altera was launched at COP28 here in the UAE and is now one of the world's largest private climate investment funds. I spoke to Altera's CEO about where and why its capital is being deployed and how the firm is balancing financial returns with climate impact.
Today, I can tell you, I'm extremely confident that we'll hit that target by 2030. We've been really pleasantly surprised with our mobilization ability. Why is it important? It's important as a measure because what we wanted to prove was that we could be commercial, that we could drive the private sector to invest in these spaces. And that's what, so far, we've been able to do.
What happens on the investment committee when a project has a massive climate benefit, but the financial return is, let's say, just okay? Which one wins?
Dan, when we started out, our investment committee was very clear that we were profit-focused, that we were returns-focused. We've never brought an investment to them that wasn't great financially, comparable to investments in any other sector, whether it's green or not. And so over time, our investment committee conversations changed from how are we generating more impact. So from our climate impact framework today, we create an impact score that's kind of an internal
so
score
that's the guy who's
that allows
controlling
us
the
to
giant
measure how
snake.
impactful
The
this
nerve
is,
of
and
that
that can be a
wig, pretending
combination
to be
of
a
how many
Orochimaru's
commissions
leg.
is it creating. It can be about its impact on the economy or the community. Today, our investment committee is asking us how to get higher and higher and higher impact scores on our investments.
It's been a challenging year for the Middle East, and 2026 has brought a whole variety of challenges, in particular the war with Iran. How do you think that is shaping investment decisions from the Middle East and the appetite to do business in this part of the world?
I think that what has really struck me has been how partners have doubled down on the UAE. I think that this really shows
There
how
sure
the
have been a whole
UAE
lot of
has
earthquakes
moved
today, wouldn't you
from
say so,
where we were
Naruto?
in the past, where
Yeah,
we were
you're
sort of
right about that.
subject to
But still,
macro
this is
or
way too weird.
regional
How does an
effects.
earthquake flip the
I
whole
have
world?
not seen any
Well, I suppose
difference
that it's
in
possible here on this
the
island,
partners,
although it's
the
probably an
investors.
extremely rare
They're all
event.
here today. They're all working business
What?
as usual,
Quit kidding.
and that's really a testament to
You know
how
what?
our
I
government
think I'll take a
has
look
prepared
outside.
and
No,
is moving forward.
you can't,
I see
because
that
you have to
continuing.
continue your vital S-rank mission,
I feel
so
optimistic
you gotta
about
stay
the
focused.
UAE.
Yeah, well,
Well,
maybe
that
I'll
was the
just go
Altera
up there and
CEO,
take
Majid
a quick
Al-Suwaidi
little
in
look-see.
Abu Dhabi. You can catch the
sworn to
full
do
Managing
every
Middle East
mission through
episode
until
on
completion,
CNBC
Naruto.
this
And
weekend
this
at the
particular
times
mission
on your
is
screen,
in your
or you can
hands.
catch up
Only
at
you can accomplish it.
cnbc.com.
That's why you were selected.
A quick check
Naruto.
on how Europe is set
Understood?
to open the trading day ahead here.
We'll
and
go see
like
what's
the
happening
performance that we've
outside.
seen in
That's
Asia,
honestly the
mostly
only way that
mixed
we can
overall
contribute
here.
here.
Stocks 50 futures
But let me
looking
repeat
slightly
it.
weaker.
You are
The
still
FTSE
right in the
futures
middle
up
of an important
0.01%.
S-rank mission.
And the Premier League is back. Defending champions Arsenal kick off the new season against newly promoted side Coventry City as the Gunners begin their first title defence in more than 2 decades. Big signings, new managers and freshly promoted sides are set to shake things up as England's top clubs gear up for the fight at both ends of the table. It's match day one, a new season, a clean slate, and kick-off is later today. Something to enjoy coming into the weekend. Stay with us here on CNBC. Europe Early Edition is coming up next. Have a great weekend.
Quick line, toot.
Here they are at last. There he is. There should be 5 people. Oh, that's 2.
Get it back to come. We can take care of them ourselves just fine.
Squawk Box, streaming on CNBC Plus.
Welcome to Europe Early Edition.
We've seen very strong. Wait, you're the Tsuchikandi's granddaughter, aren't you?
Parliament continues to stay very fragmented.
Now all of you
Prime
can
Minister,
just
it's a
take me
pleasure to be
right
back
to
in
where
Athens.
Naruto is.
Here's what investors are watching this morning.
I built a legacy on the court, and now it's the moment to build a legacy outside of the court. My main investments are in hospitality, in education and sports. So I believe that's the future. I see my brand as in a growing perspective and in some way building this new chapter.
You've been managing a very rare condition in your foot for much of your career. At what point do you think you seriously started to think about life beyond tennis?
You need to have goals. I think it's very important in this life to have goals ahead of you, because that helps you to wake up every day with motivation and passion.
My quick-line
I knew
jutsu
since
is
long time ago
essentially
that
like
I wanted to keep doing things that
Water
I
spreads it
learned
out and helps
after my
it
tennis
bond.
career. I have
Creating
two
a
more kids,
reaction
and
that
that's
causes it
the
to
most
harden
important
like
thing
rock.
of my life, without a doubt. But I like to work. That's how I understand this life.
Don't step
For
foot into
this
that
edition
water.
of the CNBC Conversation, I'm joined here in Milan, Italy by the Prada Group CEO, Andrea Guerra.
There is fashion waves, there is political waves, but then there is reality.
Now you're
The
all
reality
ours.
says that
I'll
younger
go extract his
generations
intel.
are looking at you, not just to what you say, but how do you behave.
You're even faster now
the
than in
way
your prime,
you
old
are
geezer.
behaving in the
You've always
society.
preferred sneaking
You are
around and fighting
behaving
from a
with
safe
your own
distance,
people
take
and
it off.
suppliers and
I never knew
stakeholders,
that.
and how you are behaving towards the planet
Finish him off with my C4.
are the three things that are part of our inner mission. So we are here to allow everything inside our group to be connected smoothly and positively towards planet, society, and our own people.
You should just
Product
worry
Group
about
CEO
not falling.
Andrea Guerra
Alba,
sits down
concentrate.
for the CNBC
Yeah,
conversation.
I know. Don't worry. I'll be fine. You remember that I'm in the intel division, don't you? I'm going to take a look now, and I'll see everything that's happened. He's molting. It's not that far. What are you? Get back! Luckily, Kurotsuchi, I recognize the hand signs for your jutsu.
Welcome to
It
Europe
helped me get all of you
edition
to lower
with
your
me,
guard.
Rishika Gupta. Let's
you
get
telling
into
me you
your
waited
headlines.
just for this
The
moment?
Bessent buyback fails to tame the bond market. Treasury yields rebounding, largely wiping out Wednesday's intervention relief.
Left side.
The U.S.
Quick line,
Treasury
Houston.
Secretary tells CNBC he's prepared to boost the operation beyond $4 billion.
We routinely do buybacks, and we're going to increase the size of the buyback. And, Sarah, I would note that it could be more than the $4 billion per issue.
The bond rout spilling over into equities. The U.S. majors closing deep in the red, while futures in Europe hover around the flat line, set to close off a down week for the region.
It's not to be cold enough.
Another twist in Italian bank M&A. Monte dei Paschi's board approves
Don't
plans to
underestimate
launch
me, old
a
geezer.
twin takeover offer for Banco BPM and Banca Generali, a deal that would create a giant valued at some 70 billion
We'll see
euros
whose art's
and
greater,
fend off
your
Intesa's
particle style
own takeover
or my
bid.
explosion style. Oh, come on, not now. I can't move.
Good morning and
Hold
welcome
on.
to the show. Let's get into our top
When that kid
story.
from the Hidden
US
Stone
Treasury
returns,
yields
she'll free
are
you.
on the rise again, rebounding
Lord-
from a
Lord
pullback on
Tsuchikage.
Wednesday, which was
David,
triggered
I got
by
away
an
from
announcement
me.
from the
Have
US
you
Treasury
fared?
Department that it will at least
Your companion
double
from
the
the Hidden
size of
Stone
its
went
government
after
debt
our
buybacks,
sailors.
starting from the 9th of September. The 10-year yield is now
Please
back
help
above the
me.
level
Just
it
get
was
me out of here
prior
and
to
I'll go
the
after him
intervention,
too. Which way
amid
did
persistent
Kabuto go?
concerns over America's
can't
debt
sense the
pile,
enemy
which
anymore.
topped $40
I have
trillion
no idea which
this
direction
week.
it went.
The 30-year
useless.
yield, that's the main
Damn it.
focus of the Treasury's
Yamato's been-
accelerated buyback,
What
also
happened here?
rising this morning. And
It's Yamato.
global bonds following
The
US
Woodstyle user in
Treasuries
Ninetales
lower,
Guardian
giving
was
up
taken.
much of the gains that we saw on Wednesday.
Salem
The
didn't go
German
after the
10-year
age
bond,
of
though, you see the
Ninetales?
outlier there,
Then it's hard to
rising
tell if
over
he
10-year
wanted
gilt yield
Yamato,
pushing
or if he
above
was simply after
5%.
any
Now,
hostage
speaking
that
to
he could then
CNBC, US
interrogate.
Treasury Secretary Scott Bessent said there is a very good
Either way,
chance that
we'll
the
have to
US
worry
has
about
seen
the
its
intel
budget
your
deficit
comrade
peak
possesses.
under President Donald Trump
Yamato
after
is
it
not
topped
that easily
$432
broke.
billion
I'm sure of that.
in
That's
July.
not the
Bessent
issue.
also hinted that the buyback of government debt could be higher than initially announced.
We
Except against
routinely
Mafia.
do buybacks, and we're
Strong
going to
visual
increase the
control.
size of the buyback.
Or
And,
someone's
Sarah,
caught
I
on
would
grit.
note that it could be more than the $4 billion per issue.
The Treasury Secretary also expressed frustration with current trading levels in the bond market.
I don't believe that's the souvenir
We believe
I
that
asked
the yields
for.
don't reflect the underlying
No, you're
fundamentals.
correct, it isn't.
This Iran
But he is the
conflict we will
Ninetales
get on
Guardian
the
who
other
possesses
side of
much
this.
classified intel.
We don't know when.
And besides,
we
I
can
can
talk
use him
about
to
the
make
economic
Zetsu and the
measures we're
others
going to
a
be
whole lot
taking
stronger.
against Iran in a minute. We believe
After I had captured
that the
I
liquidity,
elected not to
especially
take
in
any
the
further
30-year point,
risks and brought
is
him back.
very poor.
This way's better.
Let's see
for
how
you.
the bond market
Then hurry
effects
up
are
and do
seeping
it.
into equities
I'm
over here in
tired of
Europe. We're
talking.
seeing Stocks 50 futures flat
Steph
as a
died, mine
pancake
is
here.
itching
This is
for battle.
even as oil prices rise, as we see those Treasury yields rising again. It's heading towards a losing week for the major averages in Europe as well. We're seeing losses on the week of over 2% for the CAC 40 there again, as we see those yields pushing higher again. Let's take a look at how Asian markets are currently trading, and it's a mixed picture. Majority there in the green. The Kospi having some gains of 0.9%.
Make sure the medical unit is supplied with ninja tools.
Off about
Find Al in the
0.4%
sensory
of a
unit
percent.
and tell them to
This is
hurry
after
up.
Japan's
Tsuchikage.
headline inflation
These
rate
were
hit
completed while you were away.
1.9%. on an annual basis in July. That's the highest level this year as energy costs increase amid the Iran war. Fresh food prices also saw a sharp spike, jumping to 7%. Core inflation rose to 1.8%, in line with forecasts. It comes ahead of the Bank of Japan's September meeting, with the central bank widely expected to hike rates by 25 basis points. And let's see the Wall Street session yesterday, where we saw the major averages closing deep in the red. The S&P 500 closing down 0.9% lower. The Nasdaq with losses of 1%. This again, as we saw Treasury yields are rising, weighing on equities on a week-to-date picture. We're also seeing those major averages heading for losses of 1.8% for both the Dow and the S&P 500, and the Nasdaq on track for losses of about 2.5%, putting that on pace to snap a 3-week winning streak. And let's see how Wall Street gets set to open. And it's pretty much flat, just some cautious optimism there. Now, speaking to CNBC, St. Louis Fed President Alberto Musalem said the U.S. faces price pressures on several fronts.
Inflation is high for two reasons. We've had a sequence of supply shocks. We might have another supply shock in the fall with a super El Nino coming. And in addition to that, we have very persistent demand forces in the economy. The AI build directly into capex and investment, and indirectly through equity prices and wealth effects onto consumers. And we see sticky consumer price
He's still busy investigating
inflation.
the situation, that's all.
And I'm delighted to say I'm joined by two distinguished guests to help us wrap up
and now I want to go
make
back home to the Hidden
sense
Lake
of this
Village
week
and wait
in
for
markets.
Sasuke.
Thanos Papasavas, the founder and CIO at ABP
Between the
Invest
two of us,
Limited, and Julian Howard, the chief
we
multi-asset
made a
investment
promise.
strategist at GAM Investments. Thank you both so much for joining us. I mean, I want to start off with the top story this week. Bond yields moving higher, these concerns about not just inflation, but also the debt picture. I mean, what is the bond market telling us now? I'll start off with you,
about this
Thanos.
war of yours, you know.
Hi, good morning.
I
Thanks for
would be the
for
one to
having
destroy
me.
the hidden leaf.
I think one thing we haven't commented on is the fact that it's August.
You really should get
And
some
August
rest.
has
You've been
perennially
working practically
been a
non-stop
month
here.
where accentuated
Wars
trends
at our
continue.
doorstep.
There's a lack of
So right now,
volatility. There's
we
some
have to
noise in the
gather as
market.
much
We saw
intel
that
as
just
we
a couple of
possibly
years ago
can.
in 24. We've seen that
Especially
before in
that
2015.
intel
We've seen that
will
back in
save our
previous decades. So
combat.
August, as number one, is a month which tends to create these sort of tensions and for trends to elongate.
The white
So that's
snake that
number
slithered
one.
by
Number
earlier.
two, we're not
chocolate is
panicking. We think that
comatose.
if anything, we're
This is
approaching
the
attractive
hideout for
levels
sure. I had
for
my
the long
girls
end
explore
of
the
the
area.
curve.
They
We're
found
comfortable with the
significant
US
signs
10
of life
part of the
underground.
curve. We just closed this
Pilgrim, look down.
just the Tuesday,
At 4
just before
o'clock.
Scott
With your
Bessent made
Byakugan, you can
those
tell us
comments.
what's
So
down there.
there's absolutely no panic
Please
from
do
our
it,
side. We
Pilgrim.
believe the underlying fundamentals are solid. This is a pressure because of the
Yes.
US-Iran conflict. And we also believe that inflationary pressures will be kept under control with the Fed taking action in December, not before the midterms.
Right, so Thanos, you're not panicking there. Julian, I want to get your thoughts on this because despite the Treasury's intervention, that buyback
Ronka,
surprise, the
prepare to
30-year
contact
yield
headquarters.
bonds are already reversed. The
There's
bond has
so
already
many of
reversed its gains. So does that mean the intervention isn't enough to resolve the underlying issues here, or would you think it's just kind of an
Hey, how
August
come I have to
kind
stay
of
inside
issue
here?
as
But
Thanos
the
was saying
animals
as
get to go outside!
I mean, I think seasonality is part of it. But I just know that yields have been on an upward track for quite a few months, and actually, you could argue that if you look at the term premium and the 10-year Treasury, that's actually been going up for quite a few years. AQR has also noted that actually inflation is just percolating in the system in the US, and it makes life difficult for asset allocators and portfolio constructors because we're kind of used to a world where the 10-year Treasury is doing the diversifying for us. If you think of a 60-40 portfolio. And since inflation has really embedded itself in the system since 2022, it's become a much less reliable asset class, US Treasuries. So actually, we're a bit more worried about it. Clearly, the US Treasury themselves are worried about it, and they're finding that the yields are uncomfortably high. And I think the risks remain to the upside for yields. So we've actually reduced duration across our portfolios, and because the curve is actually relatively flat between the short-dated and 10-year, it makes a lot more sense to focus on the short-dated end of the curve and pick up 3.84% from 6 to 12 month Treasury bills. You're not taking any duration risk. You're not taking any credit risk.
Well,
I just think that term premium, that risk that's demanded by lenders to the US government has been creeping up and up and up. And I don't think that's going to go away anytime soon.
Damn it!
What rate should investors be pulling back from this equity market? I mean, how is that seeping through into equities? And do you think investors should be taking some profits at this time?
Well, we've done exactly that. We've taken some profit in the equity market just because it's had such a stupendous run over the last couple of years. And I think that's perfectly legitimate. It doesn't mean that we think the market is going to explode tomorrow. You know, we still think long-term trends such as the Siegel constant, we think that those are intact. We think AI will be intact, perhaps not as on an incredible pathway as everyone thinks. There's a lot of competition from China and open models and such like. But I just think it makes sense just to dial down a little bit, take a little bit of profit along the way, just because the pressures are starting to mount. The interest rate issue is not doesn't loom so large because, of course, yields have been going up all of this time, and the AI rally has continued regardless. I think what's really going to pause that rally is the idea of competition from China.
Then I will
and
go
other
and
threats,
welcome
AI
Lord
regulation,
Tsuchikage
taxation. If you look at the tone in the midterm sort of primaries, I think there's this a bit of a backlash going on. Even the Pope in May wrote about anthropological regression resulting from artificial intelligence. So I think there will be some bumps in the road, but that it will continue, and therefore it makes a bit of sense to take profits as we go along.
Right. Stefanos, let me get your view on this equity rally that we've seen. Do you also agree maybe investors should be taking a little bit of profit off the table, but especially when we see the S&P 500 trading at these really high valuations? But how much do you think really investors should care, given we have seen really strong earnings growth, particularly around AI?
That's because you keep on overdoing it. I bid you a hearty welcome, Lord Tsuchikage.
Off the table
because we
believe that the underlying US economy is safe.
However, we were attacked and the Woodstyle user who was guarding the Ninetales has been captured.
He was taken. So you're saying he wasn't killed?
The S&P and the Nasdaq are
the enemy will have more
US
intel on us.
Equity market has been the small cap value.
I'll explain more inside.
Instead, we prefer, so within the US it's small cap value, but instead our preference has been for Europe, UK, Japan, China, where the underlying valuations are very much aligned with you rather than the US large cap equity markets where valuations have been expensive.
But
so
first we have to extract intel from Yamat.
But our preference has been US small cap value and
I need him if you
in
want me to
international
make the
equity markets rather than the
Zetsu
US
stronger.
this year.
Thanos, do you also think, though, that maybe equity markets and investors are underpricing the risk of higher oil prices? I mean, Brent's about $93 a barrel today. I mean, we've seen it go to the triple digits. Do you think maybe these conditions are actually being overlooked by investors?
We were debating this point very recently, of course, with the VIX getting below 15% and considering is this a time to place some insurance in the portfolio and get some protection.
I'm using a drug on him that I developed to keep Hashirama's power inhibited.
Which have
But
continued
don't
to
worry,
increase, not just
I'm not going to
real
use it
versus the M2 and so on. So yes, there are all of these sort of indicators of potential concern and red flags, but at the same time, we believe that the inflation will remain anchored, the economy is on a very strong path, and more importantly, we believe that there will be some broad resolution in terms of the Iran-US situation, which keeps the price of oil contained. And I think this is the key point you are alluding to. Our view is that the price of oil will remain broadly contained
Even without the Renegon's
70 to 80 range.
We can extract all the intel we want using the combination of my truth serum and your Sharingan.
President Trump
and once we know who exactly we're facing,
so
I can select their worst enemies to send out against them.
Will remain broadly contained.
There's simply no sense in us wasting our chakra we don't have to.
The economy continuing to do well, and therefore we're still maintaining a risk-on attitude. However, we do have, as a counterbalance to that, the 10 part of the curve, which, as per the argument earlier, has been rising. We're aware of that, but at the same time,
a message from the lead.
2022
it must be new intel. Retrieve it at once.
Negative. We've seen a correction, an adjustment of the 10-year part of the curve, and we believe that there's going to be some protection should there be an adverse risk of event in equity markets.
Julian, why don't you jump in here as well and answer the same question in terms of what the high oil prices that we're seeing, where you see them maybe settling and the impact for inflation.
When moving such a large regiment,
so I think there's a difference between crude prices, which are not really in US CPI, and then refined oil
which means
products,
the victor will be decided by whoever
diesel,
makes the first move.
the things that go into apparel, for example, clothes that you wear, plastics, those have actually remained elevated even as the price of crude has come down. And it's those that are actually part of US
and make sure
headline
that the
CPI.
logistics and medical unit is
And they've
well
shown a
supplied with
tendency
medical ninja
to
tools.
remain
Chicago,
higher than
go and
crude.
help the
And
intel
there's some
unit check
technical
their chain
reasons
of
for that. China
communication.
is not exporting refined
Find
product,
Al in the
refined
sensory
product
unit
capacity,
and tell them to
capacity,
hurry
and
up.
also Ukraine is hitting Russia as well in terms of its refinery capacity. So, and there are some other technical reasons too. But there's a kind of, and it's got this awful expression, the crack spread, which is really the difference between crude and the refined products. And I think it just means that actually oil, insofar as consumers consume it, is going to remain elevated, potentially for a bit longer. But there are other things in inflation which are not going away. There's a severe housing shortage in America to the tune of 1.4 to 4 million units since the global financial crisis. There's that shortfall has percolated in the system, and it means that rents are just a constant feature in the US CPI readings. So I don't think this is going away, but I would just make the distinction between the inflation and the 10-year yield, because actually break-evens haven't been such a big component of that rise. A lot of it has actually been, as I said earlier, term premium, just the risk. You think of it like a credit card. If you're not repaying your debts, the credit card company very, very quickly applies a higher interest rate. And I think that's what's happening in the 10-year Treasury is actually, and the 30-year Treasury, is that more is being demanded by lenders because there's a fundamental distrust that the US is good for paying its debts, or if it is good, it will inflate them away. Which is the same as reneging, but just by another name. So we're just a little bit less sanguine, perhaps, than Thanos on in terms of the 10-year Treasury. Fully accept that the 10-year Treasury is probably useful for crash protection in extremis.
The captain's arrived.
But I just think there's you can get something so much steadier, such steadier return profile.
I've been ordered to lead the logistics and medical
unit. You don't have to take the
My
directional
name's
bets in the
Shizune.
first place.
It's very nice to meet all of
So
you.
Julian, how is that
There's
impacting
one thing I want you to remember,
the US
no matter
versus the
what.
world? How are you looking at European equities in light of this?
This
So, of course,
child
they
is
are
not
more
for
vulnerable
eating.
to the higher oil prices as well, in terms of also that filtering through to refined products.
Hi,
discuss
Yorinoichi,
US
aren't you?
versus Europe.
Who are you?
So,
My name is Tenga,
there's always
sir.
the argument that
I've
Europe
heard a great
is
deal
a lot
about you.
cheaper
I
than
was
America,
hoping I
and that
could
argument
interview
has
you and
persisted
record
for
you.
a very, very long time.
I'm sorry that I'm late.
Funnily enough, only the other day we were building some charts showing how does Europe, how European equities respond when the US sells off. And invariably, Europe it's a higher
We of the
beta
Intel
market.
unit
It tends to sell
will
off
oversee all
harder,
communications.
than
The
the
intel
US
must be
does.
transmitted
Even
accurately
when
and
the source
quickly
of
if
the
it's to
problem
be of
is
any
within the
use.
US.
That means in
every
order to
single
do our
time,
jobs well,
but
we
certainly
have
in
to
the
remain calm at all
most
times,
major
no matter
market
what information we
downdrafts
might
since
hear.
the
Understood?
mid-1990s.
Yes.
Even if the issue is originating in
this is
America, America
You said
is
that your
the
name
more
was
defensive
C, right?
market than
And
Europe.
this is your very first war,
so
isn't it?
we're very conscious of that.
We
And
are
actually, as
the
part
eyes
of
of the
our
Allied
kind of
Shinobi
reduction
forces.
of global equities
So
within
the
portfolios,
performance
we've
of our
actually
unit
taken
can
a little
greatly
bit out
influence the
of
tide of
Europe, which
battle.
surprises many because
Don't
people
let
think,
your
well,
guard
it's
down.
AI that's overstretched. It's the 10-year
Right, I understand.
it's the 10-year Treasury market where the yields are going up. But I just don't see a world where,
All of you
let's say,
stay
the
focused
S&P
and alert.
falls
Right,
15%, that somehow Europe is only going to fall 5%. I simply don't see that. So it's really born of that sort of pragmatism and just looking at the history that we are perhaps more skeptical of overweighting Europe versus US. Plus, of
I
course,
heard
there's
that they
the
were
usual
going to
arguments
split
of
all of
America,
us up into
the
5
innovation
units, but I
cycle.
figured they'd at least
Even
try
if it's
to
not
group us
AI,
together
there
by
are things
village.
coming down the
No,
pipe
that isn't going to
which
happen.
remain
This is a
really
war,
compelling,
you know.
such as how
Yeah,
we access
he's
the
right.
digital world. It's going to move away
This
from
is no
phones,
time to be competing with
possibly
other
to a
villages.
little node that you keep in your pocket, and then you access
The main
through
regiments are
glasses
made
or
up of 5
earpieces
units,
or
each specializing in different
hyper-intelligence.
areas of
So
warfare.
there's all these things coming as well
The first company,
that just make us
mid-range
feel
battle
that
unit,
America is still
contains
the place to
Shinobi
be.
excel at
Manos,
mid-distance
can
combat.
you jump in here as
It's
well? I want to
mostly
get your
those who
view on
specialize in
European
weapons.
equities.
The
There's
second
this
company,
perhaps
close-range
anti-AI
battle unit,
trade, maybe the
specializes
cheap
in
valuation. Do
hand-to-hand
you see any
combat.
specific
The
opportunities
shinobi
there?
in that unit will be
Total
fighting in the
agreement
front
with
lines.
Julian in terms of the
third
beaterness,
company,
if there's such a word,
intermediate-range
of
battle
the
unit,
European
provides
market,
support
similar
to
to
the
the
close and
Japanese
mid-range
market
units.
versus
Its shinobi
the
requires
US.
speed and strength.
But
We're the
we're still
fourth company,
maintaining the
long-range
European
battle.
and the UK markets.
We'll provide the link between intel units and those on the front lines. And in addition, we have the shield support units behind the lines.
It's not just a fundamental
special range
improvement
battle unit
in comparison to
uses
Europe and the US,
specialized
but
ninjutsu
we
and
actually
tactics.
saw the underlying
They have a
components which we're
special
focusing
unit.
on
That's
the
right.
fundamental
In war,
economic
anything can
components
happen,
of our
so you have
process.
to be prepared.
We saw the UK
Sure, we
reaching
organized
levels
into
it had not
units,
seen
but
since
it's just
August
wishful thinking to believe
2024.
that each team will
So a
operate
clear
without a hitch all
underlying
the time.
performance for the US fundamental
Also,
story. Yeah,
some
but going
units
back
may
to
find
Europe,
advantageous battlefield positions while others
valuations
don't.
are expensive in
Situations
Europe.
like
They're
that
not
are
just
where we rely
as
on
expensive
shinobi with
as
secret
the United
ninjas.
States. And yes, it is a little bit more protected than the
Well, I
AI
can't say for
story,
sure
similar to the
that they
FTSE,
thought
similar
that.
to the topics versus
But
the
considering
Nikkei, which we tend
80,000
to
shinobi have
prefer.
all been
So
organized into
we're
units
still
this
positive
rapidly,
Europe, we're still positive
seeing
UK,
Shikaku
positive
Nana
topics,
has
not
done
the
an
Nikkei,
amazing job.
and China.
You know,
All
you
right,
better
we'll
not
have to leave it there, but
embarrass your
thank you
dad.
both so much for joining us. Thanos
So this
Papasavas,
is
the
it,
founder
huh?
and CIO
The war's
at
about to
ABP
begin.
Invest, and Julian Howard, the chief multi-asset investment strategist at GAM Investments. Now, coming up on the show, US Treasury Secretary Scott Bessent vows the toughest sanctions in history against Iran as Washington ramps up its economic campaign. Dan Murphy will have those
Captain
details
of the
next.
first company, the Raikage's right-hand man, Darui of the Hidden Cloud. Captain of the second company, Kitsuchi of the Hidden Stone. Captain of the third company, our own
One of the world's
Kakashi.
largest private climate
Captain of the
investment
fifth
vehicles,
company,
Altera,
General
aims to
Fune,
mobilize
the land of iron.
$250 billion
Captain
by
of the fourth
2030.
company,
What we're
Arkham,
trying to show is
and
that
also
we
the
can align those
commander-in-chief of
objectives
all
and we
battles,
can make money doing it.
Isgara
Clean energy,
the Kaze
emerging
Kage.
markets, even the AI boom. The opportunities are vast, but how do you pick the right investments?
We have people who specialize in these investments, and that's what makes Altera unique. That's our secret sauce.
Find out more on the next Managing Middle East.
The AI boom is usually told as a Silicon Valley story, but some of the biggest winners are thousands of miles away in South Korea. And their windfall is now spilling into an unexpected place, the housing market.
Before we saw this massive rally this year, people just like to invest in the housing market because there is no alternative for savings and investment.
From January to April 2026, home buyers used about 3.7 trillion won, or roughly $2.4 billion US dollars, from stocks and bond sales to fund purchases.
The government wanted to boost the stock market so that people could move away from homes into the stock market, but people are coming back to the property market with the money that they earned in the stock market, and it's also sort of this vicious cycle.
The danger is not that one stock market sell-off would immediately crash home prices. It's that the same wealth channel pushing stock gains into housing depends on confidence.
Breaking news, market moves. Scott Wapner from the NYSE. Closing bell, weekdays streaming on CNBC Plus.
And Nagato. Then former Jinchuriki, Yugito the 2 tails, Yagura the 3 tails, Rochi the 4 tails, Han the 5 tails, Utakata the 6 tails, and Fu the 7 tails. Next, former Kage, the second Tsuchikage, the third Raikage, and the fourth Kaze Kage. And explosion-style
Welcome back, everyone. The US Treasury Secretary Scott Bessent has promised to, quote, collapse the Iranian regime, warning American allies that you are either with us or against us. Speaking to CNBC, Bessent also weighed in on the prospect of further military activity in Iran.
And a collection
If
of
we are
other
doing
exceptional
a maximum
shinobi.
economic
What's
pressure,
more, I've
then that
incorporated
means that
Hashirama's
likely there
live
will
cells
not
from
be
Yamato.
a
Looks like
large-scale
they've
kinetic
adapted
restart.
quite
But I would
nicely.
emphasize that is for now. And look, we do have control of the strait.
100,000
Dan,
white
when he talks
setsu
about
enhanced by
the
the
maximum
strongest ninja
economic
of
pressure,
all
I mean,
time.
do we know, do we have an idea yet of what exactly those sanctions would entail? And can Trump actually
Let's
stop
go.
other countries from trading with
The
Iran?
fourth
Because
great
he's threatened
ninja war
the allies as well.
No.
That is the key question. Ritika, good morning. Well, as you heard there, the Trump administration now spelling out how it plans to try and break Iran's economy, and Treasury Secretary Scott Bessent there telling CNBC the goal is to avoid a large-scale return to military operations. Bessent told CNBC that if maximum economic pressure works, a major kinetic restart may not be necessary. So the plan is a combination of the US naval blockade in Hormuz and what Bessent says will be the toughest sanctions ever imposed, with foreign countries, banks and companies warned that they will have to choose between doing business with Iran or access to the US system. Bessent says Treasury is going to lay out the details on Monday. Take a listen.
We have a combination. It is a 1-2 punch. We have the blockade, and we are going to have the toughest sanctions in history. And I will tell you, this will work. It worked in Venezuela once we put up the blockade. It is working in Cuba right now, and it is going to work in Iran, and we are going to collapse this regime.
So this is the clearest statement yet of the administration's objective here, not just to pressure Tehran back to the table, but in Bessent's own words there, to collapse this regime. Of course, important to point out, though, that Iran has spent many years building its own way around these Western sanctions, from Chinese oil buyers to shadow shipping networks to alternative payment channels. So the question now is whether Washington can actually close some of those escape routes to China and elsewhere, and also whether its allies are willing to help it, step in to help out to enforce this. And then finally, inside Iran, what does the new economic pivot mean for the duration of this war, which is going to cross the 6-month mark on Friday next week? How much economic pain can the people of Tehran really tolerate before the regime itself faces serious social and fiscal stress that could force the reopening of Hormuz or a restart of nuclear talks? And of course, all of that is very unclear still at this point. Ritika?
So Dan, in terms of the oil price reaction, I'm seeing Brent, it's off a little bit today, just 0.5%, trading about $93 a barrel. As we go into the weekend, and what should we be watching out for? And also, have we had any other reaction from countries so far reacting to what we've heard from the Treasury Secretary?
Well, just on oil, this has been interesting to watch because we saw oil prices popping through the course of the US trading day, actually moving higher off the back of the Treasury Secretary's comments here. Perhaps traders may be now pricing in a more uncertain path for the United States when it comes to its Iran war strategy. And the Secretary even alluded to some surprise that he had that prices had moved higher off the back of this plan. At the same time as well, the Axios piece this week suggesting that the US had been able to continue to covertly move barrels through the Strait of Hormuz didn't really do too much to cool prices either. And that basically tells us that this is a market that is now starting to look through this conflict and instead digging into some of the more critical issues for prices right now, including the really serious issue of the lack of inventories right now in supply. So as it stands, we have Brent now inching towards and around $93, $94 a barrel. WTI also at $86.44 this morning. A little bit of give back as we kick off the European trading day here, despite the fact that we saw prices moving about 2 to 3% higher in the US session. And then in terms of the reaction that we've seen to the Treasury Secretary's announcement, well, of course, exactly what is outlined on Monday is going to be very closely watched here in the Gulf and among Gulf and Arab leaders. They're looking for a quick resolution to this conflict, which, as I say, has now run on for 6 months as of next week. A really critical point for the administration to be shifting its strategy once again, this time focusing on the tools of economic leverage rather than kinetic activity. Now, that declaration will likely be welcomed by leaders here who, of course, do not want to see a return to war, but bigger questions now starting to emerge about the strategy and exactly how much longer this war will run.
Yeah, Dan, and China are also criticizing the president's economic D-Day push against Iran, warning that additional sanctions will fail to resolve ongoing disputes. Thank you so much for your work this week, Dan. Appreciate the update. Now, coming up on the show, the Premier League kicks off today amid a record-breaking summer of spending. We'll speak to Bill Bush, the former executive director and senior advisor to the Premier League, right after the break.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC+.
A market shaping industries. We are watching the six little dragons, the first to be listing in the Hong Kong market, supply chains, and global momentum.
Do you feel pressure to create the next Labubu soon?
This really is a business-first pivot despite the geopolitical strains. The China Connection, weekdays.
The trade heads are gathering against the backdrop of the global energy crisis.
CNBC.com and the app anytime.
Let's get to your headlines.
Only on CNBC, connecting you with China.
I think if I knew how complex was trucking, I think I would have thought again. So the unknown was very helpful.
Gaurav Biswas thought he had landed on a simple idea. Uber, but for trucks. There was just one problem. He had never moved a truck in his life. Then one day at dinner with friends, he saw a problem he had never thought much about.
He was constantly having to walk out of the restaurant, and we could see that he's arguing or shouting with somebody. I was like, hey, is everything okay? He's like, oh, I have 7 containers that have to go on the same vessel tomorrow. Then I said, hey, you should have an Uber of trucks.
That idea became Trucker, a digital freight platform that connects companies that need to move cargo with the truck owners and transporters that carry it.
Trucking is extremely important as a sector because whatever you touch and feel, consume, is all touched a truck. Whether it's a seaport or an airport or a factory, the trucking is that connector.
Watching Europe Early Edition, I'm Ritika Gupta. Let's get into your headlines. The Bessent buyback fails to tame the bond market. Treasury yields rebounding, largely wiping out Wednesday's intervention relief. The U.S. Treasury Secretary tells CNBC he's prepared to boost the operation beyond $4 billion.
We routinely do buybacks, and we're going to increase the size of the buyback. And, Sarah, I would note that it could be more than the $4 billion per issue.
The bond rout spilling over into equities, the U.S. majors closing deep in the red, while futures in Europe hover around the flat line, set to close off a down week for the region. And another twist in Italian bank M&A, Monte dei Paschi launches a twin takeover offer for Banco BPM and Banca Generali, a deal that would create a giant valued at some 70 billion euros and fend off Intesa's own takeover bid. And over here in Europe, we're seeing Stocks 50 futures hovering around the flat line, just small gains and losses that we've seen over here. But the major bourses still heading for a losing week. This is as we've seen yields rising. Now, a story we'll be closely watching at the market open is Italian bank Monte dei Paschi di Siena has this morning launched twin bids for rival Banco BPM and wealth manager Banca Generali. The offer values Banco BPM at just over 25 billion euros and Banca Generali at just under 9 billion. Monte dei Paschi said that a shareholder meeting will be convened for the end of October to approve the offers. China and Switzerland have struck an updated free trade deal that will see tariffs removed on virtually all Swiss exports. Bilateral trade between the two countries totals around 46 billion Swiss francs, and China is Switzerland's third biggest trading partner. Let's see how Asian markets are currently trading. You can see it's a mixed picture there, with the Kospi seeing gains accelerating now, up some 1.2%, along with the Hang Seng Index also higher. In the red, though, the Shanghai Composite, as well as Japan's Nikkei 225 index. This is as we got Japan core inflation showing some acceleration in July, boosting those rate hike bets in September from the BOJ. We also got Alibaba shares, those trading higher or lower in Hong Kong after the Chinese e-commerce giant posted a 75% drop in quarterly profit, mainly due to a ramp up in AI spending. US shares nevertheless closing this Thursday session in the green. Shein is reportedly eyeing September 1st for its market debut in Hong Kong. That's according to Reuters. The online fashion retailer is targeting a valuation of $26 to $27 billion, while Reuters also reporting that the asset management arm of UBS is amongst the cornerstone investors. And let's see how Wall Street gets set to open. Some cautious optimism there, even as we see Treasury yields rebounding. And after the session yesterday, where we saw the S&P 500 and the Nasdaq closing down around 1% and leaving those major averages down for the week. Now, the new season of the Premier League kicks off today as newly promoted Coventry face last season's champions Arsenal in the opening game. The opening weekend will see a record of 9 clubs with managers taking charge of their first league games, highlighting the cutthroat nature of the division. The season, however, has seen a fundamental rule change in the Premier League, but it will not necessarily affect the action on the pitch. Gambling companies have now been banned from appearing as sponsors on the front of teams' shirts, a crucial revenue stream for clubs. But could the ban offer an opportunity for a new industry to take over a key form of income for clubs? Tom Chitty has looked into the rise of cryptocurrency sponsorship in the world's most popular football league.
Football clubs are always looking for new revenue streams. During the 2010s, they began securing hyper-specific brand partnership deals for everything from noodles and deodorant to even tractors. So, when crypto companies came looking for partners, clubs were ready to listen. And in 2020, one of football's biggest traditional sponsorship categories was also starting to come under pressure: gambling and betting.
From the commencement of the 2026-2027 season, Premier League clubs are not allowed to have front-of-shirt deals with gambling companies. That vacuum has to be filled somewhere.
During the 2025-26 Premier League season, 8 clubs still had gambling companies on the front of their shirts, worth an estimated £60 million a year.
Cryptocurrencies will be licking their lips to an extent because they know that there is that revenue gap because of the regulation of gambling.
Within a few years, clubs were signing multi-million-dollar deals across the crypto industry, from blockchain platforms to major exchanges. And the data backs that up. Between 2021 and 2024, football was the biggest global category for new sponsorship deals ahead of other major sports year after year. The more popular you are, the more people want a piece of you. During the crypto boom, football became one of the industry's biggest prizes. Crypto had bought its way into football. Clubs got new money. Crypto companies got visibility, trust, and access to millions of fans. But as the boom began to fade, that bargain started to look a lot more complicated.
So Tam, talk to me more about your package there. It was a great package. And in terms of the football now kind of integrating now with the crypto industry, what are the potential gains to be had here? What did you learn?
Yeah, it was fascinating story. Morning, by the way. It all kind of started during COVID, when I think a lot of people had a lot of disposable income and they started investing in cryptocurrencies. At the same time, we had lockdowns across the UK and in Europe, and fans couldn't go to stadiums, couldn't fill the stadiums and paying for tickets, buying merchandise, and those two things collided essentially. And the football clubs needed cash, sponsors were dropping out because they weren't getting any exposure during match days, and the cryptocurrencies, they had loads of cash, but not a lot of legitimacy and sort of trust, shall we say. And the football clubs took the cash, and you still see today on the sleeves of a lot of Premier League clubs cryptocurrency sponsors sitting there. But during the crypto winter of 2022, there was a huge falling out of a lot of cryptocurrencies that basically reneged on their deals, couldn't fulfill their promises, and that's all to come in episode 2 and 3 of the series.
Exciting stuff. We'll keep an eye out for it. And you can catch the full episode of The Score on CNBC.com. Now, this summer has showcased the financial power of the Premier League, with this summer's transfer window set to once again break the record for transfer spending. So far, Premier League clubs have spent around 2.7 billion euros on buying players, dwarfing the 2.3 billion euros currently jointly spent by Italy's Serie A and the German Bundesliga and La Liga in Spain. So this period of high spending has also been tied with growing valuations, highlighted by the sale of a 40% stake in Liverpool to a consortium including Amazon founder Jeff Bezos, which valued the club at around £5 billion. Now, for more on all of this, I'm really pleased to say that Bill Bush, the former executive director and senior advisor to the Premier League, joins us now, and Tom Chitty also stays with us for this conversation. So, Bill, welcome to the show. First of all, I mean, the Premier League, this is the richest domestic league in the world by revenue, but as you've argued, it's still not necessarily the most profitable. So despite that, why is it so hard to make money?
Well, football was never designed to make money. You go right back to the 19th century, it was rich factory owners, they'd made their money, they now wanted to spend it, and they were kind of trophy assets. They wanted to be the big guy in town and beat the factory owner who owned the neighbouring club up the road. The nature of the Premier League, one of the reasons why it's so successful in generating the money, but it's also a reason why it doesn't make a profit, is it's really open and competitive. You want to avoid relegation, you want to get those European qualification spots, you want the glory of being champions. And therefore, if a challenger club to you spends some money, you have to spend some money. Alan Sugar famously called it lager economics. It comes in one end and it goes pretty well fast out the other, as he rather grumpily left his ownership of Spurs. And there's an element of truth in that. The money doesn't stick. For as long as, let's say, Real Madrid and PSG are leading the pack, and Saudi football and US football is coming in and picking up stars for quite high prices, you have to be really competitive in that market.
It's becoming, these football clubs are becoming such valuable assets globally in the eyes of many investors. So I obviously turn to the big story that we've seen is Jeff Bezos now taking a stake in Liverpool. I mean, that's the latest example of tech billionaires getting into elite football. What does he bring, someone like Jeff Bezos bring to the club that, you know, traditional sports investors wouldn't? And when we're looking at valuations of about £5 billion for that club as well, I mean, what do you see now in terms of valuations for these sports clubs?
There's a wide belief, who knows if it's going to be true, but it certainly feels like it may well be, and you can see the goings on at FIFA behind that, or part of it, which is there's market yet to be accessed, primarily cross-border competition. UK market, English market, probably pretty close to maxed out. So where's the growth going to come? And for the big clubs especially, and this is a big worry for English football because it is the big clubs that have international appeal, is get into those international markets. You see now, for many clubs in the Premier League, broadcast revenue still the most important. Big clubs, it's commercial revenue, a lot of it globally derived. So people are looking hungrily at the prospective future markets with lots of money in them. They believe that's where the growth is, and valuations are following the interests of rich people who continue to want trophy assets, and they've got lots of money to spend. They want the publicity, they want the visibility, they want the reputation, they want the fun, but they're looking at the future growth prospects and thinking, you know what, we may lose money year in, year out, but our capital valuation is going to be strong. The investors who shocked everyone by paying so much for Chelsea when Abramovich was forced out are now going to, if they do sell their shares, they will make a good return in just a few years because Chelsea's capital valuation has grown, even though lots of people are saying they're going to finish mid-table again.
Can I ask, Bill, about financial fair play rules? Because I think the attractiveness is because you've got these very well-established clubs like Manchester United and Liverpool that have this huge global following. And with the new rules, it's more about your revenue generation capabilities. And those two clubs, you know, their ability to generate revenue is baked in. Now, in the US, we have a franchise model, which is more of a level playing field. And I think the Bezos, the Batias, the Eduardo Savarins have gone, well, actually, we could potentially make more money off the back of selling our stake 10 years' time than we could if we invested in a US sports team.
I think that's true. US sports are fantastic, and the NFL is brilliantly run, it's great competition and earns an awful lot of money, much more than the Premier League does, because of the size of its domestic market. But the NFL is a great example of US sports weakness. They just don't sell that brilliantly abroad. Football is the global game, if there is such a thing as a global game. So breaking into American football, into American sports, it's expensive, and it doesn't give you that much global exposure. You break into the top football clubs, you get global exposure, which great for ego, great for reputation, and people hope it will drive revenue. The advantage of bringing in cost controls, if they can get the formula to work, and the risks are high here, is that you can see that if the big spender on your block is capped in their spending, then you're not going to be screwed for every penny you've got, because you can get closer under the cap, provided you're allowed to raise the money to challenge. Because almost certainly for most clubs, even in the Premier League, which as you said, is a very rich league, getting close to the really big guys is really expensive. It may well be that the financial regime, squad cost controls, as it comes in, is a bit of an equaliser and keeps a very strong feature of the Premier League, which is its sporting competitiveness. But if it means it's the revenues that you have already, then that reinforces the big guys, and that could weaken competition.
Yeah, I mean, it looks for the wealthy owner that wants to come in and say Newcastle, right? We're already seeing that club realise that actually there are huge limitations to what they would like to do. Obviously, whatever PIF want to put in, or whether they want to back out, they look like they're withdrawing from sport altogether. But do you think it's fair?
Well, definition of fair. A big club would say, we've built our brand over decades and decades and decades. We've had great sporting success over the long term. Last season's results may not have been great, but we're fantastic and we're known worldwide. Why shouldn't we leverage our brand, our reputation, and our players to be even better than we are now? On the other hand, I think there's a reasonable amount of evidence to suggest the Premier League is the top earning league because it is so competitive. The big guys just cannot rest. If they put out a second string because they're playing a bottom of the table team is good enough to nick points off them. So that sense of jeopardy which the Premier League has, and big names, is not really copied anywhere else, not to the extent that the Premier League has it. Premier League, Real Madrid are huge, PSG are huge, Barcelona is huge, and then interest kind of falls away. Getafe versus Real Betis, personally, I'd go to that, it's a great game. But they're minor names, no one's massively interested globally. People are interested. And the big clubs, there are so many big clubs in England, and aspiring big clubs, that sense of scale, excitement and jeopardy is what drives it. And so I think values have got, revenues have still got some way to go, but capital valuations, I think, very, very uncertain. Very rich people who want to spend a lot of money on this, prices will be very high. All depends on who's in the market and who's got the cash.
Great stuff. Well, we'll have to leave it there. Thank you so much, Bill Bush, CBE and former Executive Director and Senior Advisor to the Premier League, and of course our very own Tom Chitty for joining us as well. And at COP28, the UAE launched a $30 billion climate investment fund with the goal of mobilizing $250 billion by 2030. In the latest episode of Managing Middle East, CNBC's Dan Murphy asks Altera's CEO about his confidence in meeting that target and how the company is balancing financial returns with climate impact.
Today, I can tell you I'm extremely confident that we'll hit that target by 2030. We've been really pleasantly surprised with our mobilization ability. Why is it important? It was important as a measure because what we wanted to prove was that we could be commercial, that we could drive the private sector to invest in these spaces. And that's what, so far, we've been able to do.
What happens on the investment committee when a project has a massive climate benefit, but the financial return is, let's say, just okay? Which one wins?
Dan, you know, when we started out, our investment committee was very clear that we were profit-focused, that we were returns-focused. We've never brought an investment to them that wasn't great financially, comparable to investments in any other sector, whether it's green or not. And so over time, our investment committee conversations changed from how are we generating more impact. So from our climate impact framework today, we create an impact score that's kind of an internal score that allows us to measure how impactful this is. And that can be a combination of how much emissions is it creating. It can be about its impact on the economy or the community. Today, our investment committee is asking us how to get higher and higher impact scores on our investments.
It's been a challenging year for the Middle East, and 2026 has brought a whole variety of challenges, in particular the war with Iran. How do you think that is shaping investment decisions from the Middle East and the appetite to do business in this part of the world?
I think that what has really struck me has been how partners have doubled down on the UAE. I think that this really shows how the UAE has moved from where we were in the past, where we were sort of subject to macro or regional effects. I have not seen any difference in the partners, the investors. They're all here today, they're all working business as usual, and that's really a testament to how well our government has prepared and is moving forward. I see that continuing to grow. So I feel optimistic about the UAE.
That was Altera CEO speaking with CNBC's Dan Murphy in Abu Dhabi, and you can watch the full episode of Managing Middle East this Saturday at 3 p.m. or 6 a.m. Sunday UK time, or online, of course. Now, a US teen has dropped a lawsuit against social media companies Meta, YouTube, and Snap ahead of a trial in October. She had alleged social media addiction and mental health issues, but has dropped her claims without payment. The owners of MySpace, the early 2000s social media platform, are planning a comeback bid looking to capitalize on nostalgia and rejection of the modern social media experience. So Sorda has been reporting on this and joins me now on set. Sorda, thank you so much for joining us on this. First of all, why is MySpace attempting to relaunch now, and is it going to really realistically be able to compete with the big players and tech giants?
Yes, the current owners of MySpace, Tim and Chris Vanderhook of Viant Technology, teased that they're going to be relaunching the platform in a new documentary. They gave very little detail as to when that's actually going to happen. But that announcement went viral, and it generated a lot of buzz and excitement online, especially among the nostalgic millennials who grew up on the platform. And there's a lot of curiosity as to how this early 2000s platform will actually fare in an evolved social media environment where there's more regulation and more scrutiny. I spoke to a few analysts as to whether a MySpace comeback is actually commercially viable. And what they've said is that while MySpace may not be able to actually compete with the big players, it can be profitable as a smaller ads-based platform. And so what that means is that it really needs to think about leaning into a core demographic of users. It can't just rely on those nostalgic millennials who are older and busier now. They really need to think about attracting the Gen Z consumers and the older consumers as well. And that's how it can see profitability and success and long-term viability.
Yeah, sort of great stuff there. I mean, it also begs the question, I mean, if users are fatigued with social media, why would they join a new platform? But sort of great reporting there. Thank you so much for joining us. And stay with CNBC. We'll be right back after the break.
One hour of added insight every morning doesn't just add up, it compounds. One extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC.
In this CNBC Explains, we explore why Asia is leading the global IPO market.
We have a really big year for IPOs with SpaceX, OpenAI, Anthropic, but analysts are pointing out that there's much more volume here in Asia.
And we look at how South Korea's AI chip boom is spilling into the housing market.
In Korea is a reflection of what people consider as their safety net, as well as a symbol of success.
The show that explains the why behind the headlines, only on CNBC.
Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange, streaming on CNBC+.
From the markets to the calls. Kick back and relax while we serve up the highlights. Tackle your weekend. This weekend, race to your screen. The adventure continues. Dive into the action with CNBC Sports. CNBC Sports, afternoons on Saturday and Sunday, only on CNBC.
And before we go, a quick check of markets. Over here in Europe, we're seeing Stocks 50 futures flat at the moment. This is, as we've seen, Treasury yields rising across the board. On the week, though, we're looking at a down week for most of those, all of those major averages there, with losses for the CAC 40 of over 2%. Let's take a look at how US futures are shaping up, and it seems to be flat. A little bit of cautious optimism, though, for NASDAQ futures. This is after we saw the Wall Street close in yesterday's session, where Treasury yields rising, really weighing on equities, with the S&P 500 and the NASDAQ closing off 0.9 and 1% respectively, leaving the major averages down for the week on a week-to-date basis. The NASDAQ looking for losses of about 2.5% and putting them on pace actually to snap a 3-week winning streak. And that is it for today's show. I'm Ritika Gupta. Squawk Box Europe is up next. Have a great weekend.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show. Squawk Box, streaming on CNBC+.
Become a smarter investor with CNBC Pro. 24/7 access to market-moving news and interviews with 3 global live streams. Subscriber-only content from Wall Street pros like Josh Brown.
If you love the stock market as much as I do, you're going to love the best stocks in the market list.
Plus exclusive live events.
This is my first time at the stock exchange, and it's been awesome. To be on the floor, I just can't believe I'm here.
Become a CNBC Pro. Go to cnbc.com/GoPro now.
I was studying molecular biology, going to grad school. I started investing a little money for my dad, and I got bitten by the bug. I was a stockbroker, and it's fun, but we all wished we could just follow the markets and talk. My ambition was to be able to pay my bills and not have to constantly be selling. In today's world, I would urge a lot of people to get financially savvy. Squawk Box and CNBC, it is my home. It's the greatest job in the world.
Welcome to Closing Bell Overtime.
Get the essential post-market edge.
A very busy overtime.
After-hours action and opportunities.
The economic impact is just beginning.
What happened today?
The market had to resort to defense.
We've got a developing story out of Washington.
What's moving in real time?
What do the numbers tell you, pro or con?
Be ready for tomorrow after the bell.
There's a wait and see about a lot of things for tomorrow, Mike.
Completely.
Melissa Lee, Mike Santoli, Closing Bell Overtime, CNBC.
Listen to CNBC on the move with the CNBC app.
A check on how Europe is set to open the trading day.
Real-time market updates. A lot of strong numbers this morning. Listen wherever in the world you are. Download the CNBC app now.
Fast Money is America's post-game show.
Basically near all-time highs against the S&P.
Every single story that we pick is a tie back to the markets.
Those sort of revenue streams don't trade at a great multiple.
We want to arm people with the information to make great decisions.
Stock got whacked. I get it. People say they overpaid. I get that.
Fast Money is all about the chemistry. We've been successful for this long because we're a team.
Fast Money, CNBC, streaming on CNBC Plus.
Happy Friday, everybody. Welcome to Squawkbox with Ben Boulos and myself, Steve Sedgwick, and these are your headlines. The Bessent buyback failing to tame the bond market. Treasury yields rebounding, largely wiping out Wednesday's intervention relief. The US Treasury Secretary telling CNBC he's prepared to boost the operation beyond $4 billion.
We routinely do buybacks, and we're going to increase the size of the buyback. And, Sarah, I would note that it could be more than the $4 billion per issue.
The bond rout spilling over into equities. The US majors closing deep into the red, whilst futures in Europe hover around the flat line, set to close off a down week for the region.
Short sellers get squeezed. Bitcoin breaks past the $70,000 mark, adding around 20% since Monday. Coinbase CEO Brian Armstrong tells CNBC, we may be on the cusp of the next bull market.
We've been in a bear market on spot crypto trading for the last year or so. And if you look at the prior bear markets, they each lasted about, 370, 380 days. We're basically coming right up against that, where people, they're going to say, well, this one's about over. It's time for the next bull run in crypto.
And another twist in Italian bank M&A. Monte dei Paschi launches a twin takeover offer for Banco BPM and Banca Generali, a deal that would create a giant value at some 70 billion euros and fend off Intessa's own takeover bid.
A very warm welcome to Squawkbox Europe. US Treasury yields are on the rise again, rebounding from a pullback on Wednesday, which was triggered by an announcement from the US Treasury Department that it will at least double the size of its government debt buybacks starting from the 9th of September. The 10-year yield is now back above the level it was at prior to that intervention. amid persistent concerns over America's debt pile, which topped, as you're all aware, $40 trillion this week. The 30-year yield, the main focus of the Treasury's accelerated buyback, also rising this morning. And as you can see, 5.252 is where the 30-year paper is trading. Let's have a look at global yields. It's not just a US phenomenon, and neither is the debt profile, but neither is the deficit levels. Let's be brutally honest about this. Across the world, and it's not just developed world, it's not just the G7, it's across the world, deficits are rising, overall debt levels are increasing, and there are concerns amongst investors about who will pay for it, who will buy those bonds. And if they are going to buy the bonds, are they going to demand a greater yield for doing so? Especially when, as we all know, there is competition now. A large amount of competition from the AI industry, the technology industry, which is raising more and more money to fund its growth. Speaking to CNBC, the US Treasury Secretary Scott Bessent said there is a very good chance that the US has seen its budget deficit peak under President Donald Trump after it topped $432 billion in July. Bessent also hinted that the buyback of the government debt could be higher than initially announced.
We routinely do buybacks, and we're going to increase the size of the buyback. And, Sarah, I would note that it could be more than the $4 billion per issue.
The Treasury Secretary also expressed frustration with current trading levels in the bond market.
We believe that the yields don't reflect the underlying fundamentals. This Iran conflict, we will get on the other side of this. We don't know when, and we can talk about the economic measures we're going to be taking against Iran in a minute. We believe that the liquidity, especially in the 30-year point, is very poor.
So I suppose the idea was that intervention would have lowered yields and helped push up equities, but it hasn't worked. Look at this. We saw the yields on Treasuries climb back up. That has weighed on equities, and in a really severe fashion. Look at that, the Dow shedding more than 700 points on the day, down 1.33%. The S&P 500, the broader index, also closing the day 0.9% lower thereabouts, and the Nasdaq as well, the one that we have really seen powering some of the recent rallies. The tech-heavy index off by around 1%, and this puts the main Wall Street benchmarks on course for a down week. They're all on pace to end the week around 2 to 2.5% lower. Let's see what happens in the Friday session. In the meantime, this is the picture across the Asian equity markets, and slightly more mixed. We've got the Nikkei and the Shanghai Composite below the flat line. The Hang Seng slightly more robust, and the Kospi as well, adding to the advances that we saw yesterday, trading about 0.8% higher. In terms of what's being expected when European trading gets started for the Friday session, again, a little bit of a mixed picture, not much deviation from the flat lines, just the FTSE futures indicating to a positive open for the London market, the Pan-European blue chip stocks 50 being called lower, as is the Frankfurt DAX. Let's cast an eye even further into the future and what's being anticipated when Wall Street trading begins, and looking to recover some of those losses. Futures indicating likelihood of a rebound on the Nasdaq and to a lesser extent on the S&P and the Dow. Steve.
Speaking to CNBC, the St. Louis Fed President Alberto Musalem said the US faces price pressures on several fronts.
Inflation is high for two reasons. We've had a sequence of supply shocks. We might have another supply shock in the fall with a super El Nino coming. And in addition to that, we have very persistent demand forces in the economy. The AI build directly into capex and investment, and indirectly through equity prices and wealth effects onto consumers. And we see sticky consumer price inflation.
Now, I'm on the Treasury website. Have a look at it, please, all of you. It's really fascinating, and it's got some really good, very clear information that even I understand as well. And there is a lot of very clear information on there, including from the 5th of August. The US Treasury Department is offering $125 billion of Treasury securities to refund approximately $96.3 billion of privately held Treasury notes and bonds that are maturing 15th of August. Included in that, there was $42 billion of 10-year paper. There was $25 billion of 30-year paper. And I found another announcement as well. The US Treasury Department announced its current estimates of privately held net marketable borrowing for July to September, and then it's talking about the amount that they expect to borrow, $739 billion in privately held net marketable debt, assuming an end of September cash balance of $950 billion. My point is they are still borrowing vast amounts of money. So Bob Parker, Senior Advisor, International Capital Markets Association, good morning to you, sir.
Morning.
With due respect to the Treasury Secretary, doubling those money market operations for repurchasing of 30-year paper or longer-term paper more generally from $2 to $4 billion, when those kind of announcements I was just alluding to there are still on the cards. It seems like the analyst I read in the FT, I think read on CNBC.com, who'd commented to our team stateside yesterday, he said it's like using your credit card to pay your mortgage bill. Would you concur with that?
I wouldn't disagree with it, absolutely. And I think, you made some very interesting points, but I would just add to what you've just said that if you look at the pattern of Treasury borrowing over the last year, there has been very much a focus of new issuance at the short end of the yield curve and much less issuance at the longer end of the yield curve. And what is Bessent trying to achieve, and the Treasury trying to achieve over the last few days in this intervention, is actually to prevent a further steepening of the yield curve. Now, we've got a steepening yield curve, I think, for a range of reasons. First of all, there has been very significant corporate, and particularly from the tech sector, new issuance, and that new issuance has been at the longer end. So there has been some crowding out. And it's interesting, previously we always used to talk about governments crowding out corporates. Now we have a situation where the heavy issuance of corporate debt is actually putting pressure on the government market. So that's factor one. Factor two is obviously what's happening to inflation and inflation expectations. And with the rise in oil prices, with the rise in soft commodity prices, partly due to, or largely due to climate change, headline inflation over the next month or two inevitably is going to rise, and I think we're going to see headline inflation numbers, north of 3.5%. And the very fundamental point is that you have to ask the question, is intervention on the yield curve effective, not just when your total debt now exceeds 40 trillion, but more importantly, when your budget deficit is in excess of 6.5% of GDP and not going down. And also the vulnerability of the US Treasury is also highlighted, not just because of that clustering of new debt at the short end of the yield curve, but let's not forget that foreign bondholders own around 25%, north of 25% of US Treasury holdings. So it is very vulnerable to foreigners selling.
Yes.
Bob, do you think that the intervention, apart from not having the desired effect, even more than not having the desired effect, not even having a neutral effect, but the sense of panic that it might convey could actually end up spooking the bond markets and pushing the yields even higher than they were before the intervention?
The answer to that is it is a high-risk strategy, and it doesn't matter whether you're intervening in the foreign exchange markets or in bond markets, but successful intervention is always when a market is very stretched. And the intervention, for example, by the US and Japan on the yen stopped the yen weakening further because the market was significantly short the yen. This intervention to try and flatten the yield curve, I think probably won't be successful except for a very short-term effect, and we saw that earlier in the week. The impact was actually lasted for about 24 hours. But investors, yes, are avoiding longer duration holdings, but we don't see major short positions. So, I actually question whether this intervention is going to be successful.
Gosh, I don't know where to start. I've been told I've got about 10 minutes, so that's good. That's not quite what she said, but anyway. but look, a couple of points. I don't believe there are bond vigilantes out there targeting the US yield curve. What I believe is that people are saying we are concerned about the underlying fundamentals, and therefore we are going to demand a greater premium to own this paper. I mean, we talk about vigilantes rather glibly, but I mean, vigilantes taking on the US Treasury market, that's quite a steep ask, isn't it?
I think one theme, well, I think the answer to your question is absolutely yes. And, I think the phrase bond vigilantes is frankly sort of badly used. And,
probably buyer's strike is probably a better answer.
I think I would actually say investor caution.
Yes.
And, investors are being very cautious about markets where the budget deficit is high and there is no evidence that action is being taken to reduce it, where inflation is relatively high, and it's, if we have inflation north of 3.5%, that poses a real problem for the Federal Reserve. And we saw, what was in the FOMC minutes, which were published this week. When the market is vulnerable because of the extent of foreign holdings, and also where you have that very heavy issuance, particularly at the short end of the curve. All the warning signs are flashing. So what does that mean? It doesn't mean that bond vigilantes, and I don't like that phrase, but but it doesn't mean that big short positions are being taken on the Treasury market. It just means that investors are running very cautious duration positions. So, and that comes back to my point, Ben, that intervention only works when markets are very stretched. And is the US Treasury market stretched at the moment? And the answer is no, not at all.
Can we go back to, I think, what this is all far more important fundamentally than whether people are buying bonds or not at the moment. It's the fundamentals of the US economy, of the US balance sheet. If the fundamentals are good, then things will come back into line. If the fundamentals are bad or questionable, then people will remain with those questions that are being raised now. Plus the fact this is a long-term story. This isn't a Trump story. It's a Trump, Biden, Trump, Obama. Every pretty much government this century has increased the debt. So go back to the fundamentals. Bessent has told CNBC that he believes there is a high chance that the deficit has peaked at around about 6%. You said this morning you think actually it's going to 6.5%.
Well, that's the recent data.
Yeah. So the question is whether the Treasury Secretary's comments are accurate or not.
I think the key question is not whether the deficit is 6 or 6.5%. The fact of the matter is,
trajectory to get it down.
Is what is happening to get the deficit down. And we're not seeing any substantive cuts in public expenditure. We're not seeing any substantive increase in fiscal revenues. So if you ask the question, is the budget deficit in 2027 probably going to stay close to 6%? And frankly, it's a pretty irrelevant debate as to whether it's 6.2 or 5.9. The fact of the matter is, a rapid decline in the budget deficit is extremely unlikely, and that's particularly the case when two of the drivers of the US economy in 2026, which is the energy sector and also the tech sector, which have been real powerhouses of driving economic growth in 2026. In 2027, I think inevitably we are going to see, just because of base effects, some slowdown in the tech sector, and you see that in the corporate earnings projections. And yes, oil prices are high today, but don't forget that the IEA is forecasting an 8 million barrels per day increase in global supply in oil in 2027, assuming that the Middle East calms down. And that's a big assumption, by the way. But we could actually see less buoyancy in the energy sector, less buoyancy in the tech sector. So two of those major factors for the US economy are less powerful.
And as we saw with Walmart, the titan of retail yesterday.
Well, the consumer sector is weak.
Consumer sector is weak.
Yeah.
Which is a key part of the economy.
Yeah, and you saw that very clearly in the very good reports that come out from the University of Michigan. The Michigan Consumer Confidence Index, which had recovered in June and July, is now weakening.
Bob, is this Europe's moment, do you think, both in terms of the attractiveness of sovereign debt and
equities? Have you seen our debt to GDP?
Bob was mentioning, we were chatting in the kitchen, just outside the studio. We've got a little kitchen area. We were making a cup of tea about 5 minutes before the show, and we had the quickest of conversation. You said, what was it? You said, look at France. Look at France.
Okay, well, something's very interesting happening in Europe, which, everybody's focusing on the US Treasury market at the moment. But what's happening in the Eurozone? And two things are happening. First of all, as we have upward pressure on US Treasury yields, we also have upward pressure on Eurozone yields. So 10-year Bund yields, we're talking about, at the moment, we're trading at 3.25%. And at the moment, it looks unlikely that we are going to see a significant or short-term reversal downwards in Bund yields. So that's factor number one. Factor number two is that French yields are now trading at a higher level than Italian yields or Greek yields. And I think one has to go back a long time in history. I can't remember a time when France was trading at a higher level than Greece, and for that matter, Italy.
The answer to that, Bob?
And the answer to that's very simple. French budget deficit is 5.5% of GDP and not going down.
Because you and I sat here, well, we've sat here this entire century, well, actually upstairs, but because you and I were sitting here in 2010 saying there was a reckoning going on with the Greek economy, the Italian economy, the Spanish economy, and one or two others as well, but not the French economy as well. They never had that moment of reckoning that those other economies had.
Well, it's now happening, and you see that very clearly. Where's the pressure in the Eurozone? It's not just that yields are going up across the board, and in the short term, with somewhat higher inflation, I think that we will see somewhat higher yields, but we see now quite significant pressure on French spreads versus, you mentioned Spain. Spain is now trading significantly on a lower yield than France.
It's fascinating. And what comes around goes around, doesn't it?
Yes.
Lovely to see you.
Good to see you.
Have a superb weekend, my friend.
Thank you.
And thank you as ever. Bob Parker, Senior Advisor for the International Capital Markets Association.
Still to come on the show, US Treasury Secretary Scott Bessent vows the toughest sanctions in history against Iran as Washington ramps up its economic campaign. Dan will bring us all the details. Plus, Anthropic reportedly eyes a bumper valuation for its highly anticipated IPO. And we'll be joined by Sean Pesh to discuss his latest stock picks. Don't miss that conversation, 9 o'clock this morning, London time.
In this CNBC Explains, we explore why Asia is leading the global IPO market.
We have a really big year for IPOs with SpaceX, OpenAI, Anthropic, but analysts are pointing out that there's much more volume here in Asia.
And we look at how South Korea's AI chip boom is spilling into the housing market.
In Korea is a reflection of what people consider as their safety net, as well as a symbol of success.
The show that explains the why behind the headlines, only on CNBC.
I built a legacy on the court, and now is the moment to build a legacy outside of the court. My main investments are in hospitality, in education and sports. So I believe that's the future. I see my brand as in a growing perspective and in some way building this new chapter.
You'd been managing a very rare condition in your foot for much of your career. At what point do you think you seriously started to think about life beyond tennis?
You need to have goals. I think it's very important in this life to have goals ahead of you, because that helps you to wake up every day with motivation and passion. I knew since a long time ago that I wanted to keep doing things and learning after my tennis career. I have 2 small kids, and that's the most important thing of my life, without a doubt. But I like to work. That's how I understand this life.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
The US Treasury Secretary Scott Bessent has promised to, quote, collapse the Iranian regime, warning American allies that you're either with us or against us. Speaking to CNBC, Mr. Bessent also weighed in on the prospect of further military activity in Iran.
If we are doing the maximum economic pressure, then that means that likely there will not be a large-scale kinetic restart. But I would emphasize that is for now. And look, we do have control of the strait.
Dan joins us with more. Any response to that from the Iranian regime, Dan?
not yet, Ben, but this is going to be interesting to watch. The Trump administration clearly now sharpening its economic campaign against Iran. And you heard there, Treasury Secretary Scott Bessent says the aim is to make a major return to military operations less likely. Bessent basically telling CNBC that Washington now plans to combine that US naval blockade with what he called the toughest sanctions in history. The message to other countries is also getting tougher as well. If banks, companies or governments keep helping Iran to move oil or money, then they could face US penalties as well. The Treasury now expected to set out more details on Monday. Here's the Secretary explaining.
We have a combination. It is a 1-2 punch. We have the blockade, and we are going to have the toughest sanctions in history. And I will tell you, this will work. It worked in Venezuela once we put up the blockade. It is working in Cuba right now, and it is going to work in Iran, and we are going to collapse this regime.
And that last line is really important there because it also goes beyond forcing Iran just back to the negotiation table. Bessent now openly saying the administration wants to collapse the regime. So the big question now is whether Iran's sanctions evasions network, especially oil sales to China, for example, the shadow shipping network, the alternative payment channels, the many things that Iran has done over the last decade plus to avert Western sanctions will slowly start to be peeled away, or if that infrastructure is ultimately going to stay intact and stop the US from being able to achieve its goals and ultimately blunt the impact of what could be coming on Monday. I think the bottom line here is that ultimately this really signals how the administration stateside has firmly shifted to pulling the tools of economic leverage now towards the regime as opposed to going back to kinetic activity. Of course, we're watching and waiting to see exactly what's going to be announced and whether it's going to have any impact inside Iran beyond just hurting average, everyday Iranians. It's back to you.
Dan, is this an admission that the military effort has failed then? And obviously there's concerns about the US depletion of ballistic missiles and cruise missiles in any way, and let alone defensive capabilities with the Patriot system. But is this an admission that the war side of things is over and has failed, and now they need to turn to economics?
Well, the administration has said that its war efforts have been successful, and in many regards they have. The US has been able to degrade quite significantly Iran's ability to wage warfare in the Gulf states and elsewhere. But of course, that leverage that the Iranians have is still intact. And up until now, military activity alone hasn't been enough to get the regime back to the negotiation table. So now the White House is trying a different track here, one that ultimately will impact Iran's key trading partners, including the UAE here, and specifically China, which has long been a supporter economically and financially of the regime too. There are other countries that could potentially be in the crosshairs here, including Russia and even the EU nations, but exactly what is announced again remains to be seen at this point, and what type of support those countries that are called out will actually have for the administration's goals here also remains to be seen. Has the war effort ultimately shifted its track here? Then, if the question is, is the United States trying something different now? The answer to that is absolutely. Again, whether or not this is going to work beyond just hurting the people inside Iran who have nothing to do with this conflict remains to be seen.
Okay, Dan, thanks very much. We'll speak again a little later. We'll also be counting down to the European market open just over half an hour from now, and a positive start being called almost equally across the key benchmarks. We're back after a short break.
Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
The Score, streaming now on CNBC.com and YouTube.
Edge just opened up in Europe with a French government cooperation agreement as well. How significant is that deal for Edge and for Abu Dhabi?
Europe is where the next budget summit. We would like to contribute to the security of Europe. We feel that we have a value. We feel that Europe have recognized this value by accepting us into Europe. These are facts. We have a very nice footprint in Europe, and this would have not been possible if the UAE wasn't accepted in Europe as a partner, knowing and trustworthy with NATO and the way we firewall things. Plus, you need another player in Europe. Even the big players today, we're working with them. There is always these collaborations, but they only start when you put your ego aside. There is always someone better than you. And you need to be on this learning curve forever.
A very warm welcome to Squawk Europe with Ben Boulos and myself, Steve Sedgwick, and these are your headlines. The Bessent buyback failing to tame the bond market, Treasury yields rebounding, largely wiping out Wednesday's intervention relief. US Treasury Secretary tells CNBC he's prepared to boost the operation beyond $4 billion.
We routinely do buybacks, and we're going to increase the size of the buyback. And, Sarah, I would note that it could be more than the $4 billion per issue.
The bond rout spilling over into equities, the US majors closing deep in the red, whilst futures in Europe hover around the flat line, set to close off a down week for the region. Short sellers getting squeezed. Bitcoin breaks past the $70,000 mark. Well, look at that, past the $75,000 mark on our screen, adding around 20% since Monday. Coinbase CEO Brian Armstrong tells CNBC we may be on the cusp of the next bull market.
We've been in a bear market on spot crypto trading for the last year or so. And if you look at the prior bear markets, they each lasted about, 370, 380 days. We're basically coming right up against that, where people, they're going to say, well, this one's about over, and it's time for the next bull run in crypto.
And another twist in Italian bank M&A. Monte dei Paschi launching a twin taker offer for Banco BPM and Banca Generali, a deal that would create a giant valued at some 70 billion euros and fend off Intessa's own takeover bid. Well, it's been a sobering week, whether you're trying to find safety in the bond market or indeed you're long the equity market. I'm afraid you haven't found many ports in the storm. I guess if you're long gold, that was one place to hide. But the US markets for the week so far, I'll tell you the week-to-date moves on the Nasdaq down 2.5%, the S&P 500 down 1.9%. The Dow down 1.8%. And I'm afraid to say, if you're looking for ports in the storm for non-AI related stocks, then it wasn't particularly great data from the likes of Walmart yesterday, whose shares slid on the back of slowing consumer appetite. Let's have a look at the European equities as well and the futures where they're trading. Again, the FTSE actually for the week, beg your pardon, Asian equities. There we go. In the current session, the Hang Seng up 1%, the Kospi up 0.9 of 1%. Let's move on to the European futures. For the week to date, the DAX is down 1.7%, the CAC 40 down 2.1%. And looking at the Treasury story as well. And one thing I do want to point out here, a lot of the stuff we are talking about on a daily basis now regarding the debt levels, the debt to GDP, the deficits, etc., it's not a brand new story. Any of you are surprised about what's going on, it's not particularly new. What is new, of course, is the highs we're seeing in the yields on a 15, 20-year basis. But the story hasn't dramatically changed in terms of the profile of the debt in Europe, and especially in this case in the United States, in a very long time, okay? So nobody should be particularly surprised about what we're seeing. It's become far more of a focus for the markets now. European yields and the 10-year gilt, let's have a look at where they are trading. So the 10-year German paper, 3.25%, the UK 10-year gilt, 5.07%, and the French paper that Bob Parker was talking about earlier on, trading at a premium to the Italian BTPs.
UK consumer confidence jumped to its highest level in 2 years in August as expectations on the performance of the UK economy next year grew. The GfK Consumer Confidence Index rose by 3 points to -14 against expectations of a fall of 1 point for the month. Meanwhile, house prices in the UK fell for the first time this year in June, according to the ONS, with the property market weighed by rising mortgage costs from the war in Iran. The average price of a home has fallen to £272,000, partly due to prices in London stagnating. Ollie Creasy, head of property research at Quilter Cheviot, joins us now. Ollie, I suppose this data on the house prices is slightly out of date by now, because we've had this jump in government borrowing costs in the US. That's filtered through to the UK government borrowing costs as well, potentially going to push mortgages up. Do you think we're going to see even further downward pressure on house prices in the weeks and months to come?
Good morning. Yes, I think that would be a reasonably fair assumption, actually. When you consider how the ONS works and how that data is collated, and also the mechanics of the property market in general, a June print is based on house sales that are potentially agreed before even March 2026, when obviously the Iran war started in earnest, and mortgages and gilt yields and all of the other interest rates took a beating as a result. It would be quite a reasonable assumption to say that since all of that started, interest rates have continued to go up, and there's been some variation, but the trend has definitely been upward. That pressure is on mortgage rates, and that will be filtering through to house prices. Clearly, there's other moving parts, so I wouldn't want to say house prices definitely going down from here, but I think there is definitely downward pressure from those issues.
Home builders have had a really tough time, haven't they? The energy price inflation, building materials, the market perhaps not being as enthusiastic and resilient as they might like. What's your reading on the situation for some of the UK's big house building names now?
Yeah, the situation is pretty tough, as you describe. Since the past 4 years or so, build cost inflation has been pretty high. I think it's been sort of 30% plus cumulatively over those 4 years. You've seen similar issues in energy prices, in labour costs as well, and house prices haven't matched that move. So there has been downward pressure on the companies who are building those homes, their profitability. That situation is continuing. I would actually suggest that it's probably getting worse incrementally. We've seen some half-year results from a number of the big house builders, and there's been further deterioration in profit margins even since last year end. There is a really difficult situation brewing, and actually the difficult part really is that there's no obvious sign that it's going to come to an end anytime particularly soon.
Ollie, I seem to remember there was a government pledge that we'd have 1.5 million new homes by the end of the decade, by the end of the Parliament. Where are we with that?
I actually don't know the number, but I can confidently say that we're some way behind it. I think that forecast, that target is more or less completely unreachable unless something quite miraculous happens in the next couple of years. I would suggest that actually those targets they've been set by successive governments and successive prime ministers. I can't actually remember the last time that they were reached, but I do think we're going to find ourselves even further behind than we have historically when it comes to that reckoning. And if you think of 1.5 million over 5 years as 300,000 per year, we can see the run rate, and we're, to be honest, we're probably not even halfway there over the last couple of years at least.
Yeah, Ollie, I agree with you. Every government I can remember has never got anywhere near the figures they promised as well. But look, in terms of the house builders themselves, it's a hard own for many people as well. And people very often say the bull case is because they trade at a big discount to their NAV, to their net asset value, to the value of their underlying property and land holdings as well. How looks that discount compared to history at the moment?
The discount is there, and it is probably below average, i.e. cheaper than average. What I would caution when looking at that number is that it's based on an NAV which is, as you say, largely derived from land prices, and land is generally held on those books at the price that it was bought for. Now, land prices over the last 4 years or so have been falling quite consistently. I wouldn't necessarily assume that fall is baked into those numbers, or rather, if it's baked in, it's baked in on the price rather than the NAV side of the equation. So that's just a note of caution there. And I think what you're seeing in that cheapness is in part a reflection that the land carrying value on the balance sheet is perhaps not the most up-to-date number.
Yeah, so a degree of caution, absolutely. Look, we know that some of those previously prime areas, in fact still prime areas, but less prime than they were, are really suffering. The central London, the West London place as well. Is there any sign that downtick is going to end? I know a lot of our viewers are very keen on learning about that belt, but as far as I can see, we've seen tens of thousands of units of very, very similar properties being built in the last 20 years, all the way down the Thames and what have you. It just seems to me that there's a lot of property that looks exactly the same that actually needs a clearing price.
Yes, I think that's probably fair, and I would say that there's early signs of, how can I best put this, a degree of pragmatism in the second-hand housing market. I think there's been a sense, particularly within London, when I suspect it extends across the rest of the country as well, that historic prices are something of an anchor point for would-be sellers. I get the sense that there's early signs, and I wouldn't want to oversell it here, but I would say there are early signs that those sellers are coming to terms a little bit with the issues that are perhaps affecting house prices over the last 3-4 years, let's say, and that what their house might have been valued for in 2021 or so may not be a useful number in 2026.
Yeah, absolutely. It's very painful for a lot of people, isn't it? Okay, final question, and going back to the point that you and Ben were talking about in terms of the government's prospects of actually building the number of houses they promised to do. I mean, I think we can fairly say they're not going to, and that's not political, it's just no government ever does. But one thing Andy Burnham has done, he said we're going to build more public housing available for lower income tenants and what have you, more public housing than has been built since the Second World War, since that phase then as well. Who's going to build those buildings if the house builders can't sell full price properties that in the private market? Who's going to build that public housing and do it profitably?
And that is a fantastic question that very much cuts to the heart of how difficult, how big a challenge that remark will perhaps launch on that pledge. I would say that it's possible, but you clearly need two things, well, probably need more than two things to build a house. You need the land, you need the skill set to build it, you need the money to finance that build. And whether you are building for a private seller, private buyer, or indeed building for a social housing purpose, those three factors are more or less non-negotiable. Now, there are house builders, in fact, most of the large cap house builders out there are selling houses in bulk to buyers, and some of those buyers are private landlords, some of them are akin to social housing, whether it's housing associations or local councils or whoever. Those sales are happening. They tend to take place at a lower price point because they're buying in bulk, and it's perhaps a repeat contract type of situation, and they happen at that lower price point equals lower profitability for the builder. The builders aren't making a huge amount of profit at the best of times in the current environment. So putting together a situation where they're selling more in bulk at that lower price point is going to put further challenges on their profitability and as you say, their willingness to do so. When you own attractive land, you only get to build on this and sell the outcome once. And so those house builders will be very tempted to hold back. And in fact, I think they already are quite tempted to not overbuild, not try and chase volume too hard, because in, let us say, 5 years' time, they might wish that they'd kept hold of some of that land and could build in a better place. Now, what I would just add is that the government clearly has some levers that it can pull, and it has pulled in the past. We haven't heard any recent rumblings about a renewed Help to Buy scheme or any other types of incentives, but those levers do exist and they can be pulled, and were they to be so, there's a big potential that it could flip this market pretty much on its head and change the profitability story quite quickly. So it's just something to be aware of. I do imagine that it comes up quite frequently behind closed doors in government's offices. We haven't heard anything, but we are keeping a close eye on any developments in that area.
Yeah, I remember I had MyRest when I first bought a place in '89, mortgage income relief at source. So there are tools available. As you say, Ollie, if I was selling your house, I would say lovely east-facing lounge, high ceilings, lovely Victorian fireplace. Looks very, very nice place, very marketable.
It's very kind of you to say thank you. I'll pass the message on to the designer.
Is that your boss, your wife?
Yes and yes, yeah. She's the architect. That's her area of expertise.
Brilliant. She's done a very good job. It looks lovely. Nice to see you, Ollie. Thanks very much indeed for joining us. Ollie Creasy, Head of Property Research at Quilter Cheviot. You can't beat the high ceilings, can you?
No, I think you've probably secured yourself a part-time job there with that.
I might need one the way I'm going with the viewers at the moment. Okay, thank you very much. Brilliant. Alibaba shares trading higher. Well, it says here trading higher, lower. I don't know. Take your pick. Let's have a look. Trading lower in Hong Kong. There you go. Trading lower in Hong Kong after the Chinese e-commerce giant, that was not me, that was the producers, for once, posted a 75% drop in quarterly profit, mainly due to a ramp up in AI spending. US shares, nevertheless, closing the Thursday session in the green. I can guarantee you, Ben, if I go back on that read now, they'd have already changed it.
Do you think so?
Shall I go backwards?
They're very quick like that. There we go.
Shall I go back? Look, it's gone. What's gone?
What do you mean it's changed? It's always said trading lower.
Yes, I knew
it's
it.
Always said.
They do that. They gaslight me the whole time. Did I just read that?
In defence of the producers, it always said low. I don't know what you're talking about.
Oh, of course. I was wrong. I apologise, Brett. Emily filed this report.
An earnings slump for Alibaba in the June quarter, with profits down 75% as it ramps up AI capital expenditure to preserve its lead in the AI sector. The tech giant is making investments to build out compute capacity, with capex surging 75% to $10 billion in the June quarter, which reflects fluctuations in procurement cycles, increase in CPU capacity, and higher pricing of chip components. CEO Eddie Wu says as they ramp their own proprietary chips, which will replace commercially procured chips in the data centers, this will result in higher gross margins and profitability. Alibaba also made a strategic alignment of its reporting segments in the quarter to better integrate its commerce and AI businesses. E-commerce now combines domestic and international operations, and their grocery chain Fresh Hippo. Revenue there up 4% to $30 billion. AI Cloud and Compute Services covers the cloud business and its T-Head chip unit, which is a portfolio of proprietary silicon spanning GPU, CPU, storage, and networking chips. Revenue jumped 45% to more than $7 billion. Its Genwu chips have achieved broad commercial adoption and have over 650 external customers spanning 20 industries, including autonomous driving, internet, and financial services. AI Labs and Applications cover AI Model Labs and Qwen Consumer Business Group, with revenue at $462 million. It's Qwen 3.8 Max, which was recently rolled out and is now one of the world's largest open source models. Alibaba's open weight models have accumulated more than 3 billion global downloads in the last 6 months, eclipsing Meta and Alphabet and even domestic peers to become the world's #1 AI model. Alibaba shares down as much as 3% in Hong Kong trade. I'm Emily Tan. It's back to you.
Still to come on the show, the Premier League kicks off after another summer of record transfer spending so far amid sky-high valuations for clubs. We'll discuss the financial power of football's most popular league. And we'll look into the growth of crypto sponsors in football as the sector looks to gain credibility. We'll have more from the latest episode of The Score after the break. And which political strategist said it would be reincarnated as the bond market rather than the president or the Pope? You can find out if you subscribe to CNBC's The Daily Open EMEA newsletter. Today, giving you a quick and succinct recap of the key markets-related stories from overnight, as well as a look ahead to what's coming up in the trading day.
I grew up a news junkie. It's really the only thing I ever wanted to do. I like holding people to account. You can't just show up and say, I like XYZ stock, because I'm going to ask you why. And then if you say you sold it, I'm going to say, well, why'd you sell? Get away from talking your book and tell me the real story. Ambition is a fuel and a fire. They call me the judge for a reason. I'm supposed to make people squirm, as long as I get the goods at the end of the day. We're talking about people's money. I feel the weight of that, the responsibility, and I love it.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show. Squawk Box, streaming on CNBC Plus.
Now, let's take a look at the crypto market because Bitcoin, for one, has had this most enormous rally to 75,488. A lot of people saying it's also due to the concern in the bond market. I think it's less so personally, but, you know, beg to differ if you like. I think it's more to do with this Clarity Act announcement as well. But look, this week it's been a phenomenal move to the upside. There is no doubt about it. And a lot of the crypto advocates now are saying it's part of a new bull market. But look, we're up 20% for the week. And yes, a lot of shorts have got very badly hurt. Now, the new season of the Premier League kicks off today. My team's not involved. As newly promoted Coventry face last year's season's last champions, Arsenal, in the opening game. The opening weekend will see a record of 9 clubs with managers taking charge of their first league games, highlighting the cutthroat nature of the division. This season, however, has seen a fundamental rule change in the Premier League, but it will not necessarily affect the action on the pitch. For the first time, Premier League clubs have collectively agreed to remove gambling companies from the front of matchday shirts, a crucial revenue stream for clubs. But could the ban offer an opportunity for a new industry to take over a key form of income for clubs? Well, Tom Chitty has looked into the rise of cryptocurrency sponsorship in the world's most popular football league.
Football clubs are always looking for new revenue streams. During the 2010s, they began securing hyper-specific brand partnership deals for everything from noodles and deodorant to even tractors. So, when crypto companies came looking for partners, clubs were ready to listen. And in 2020, one of football's biggest traditional sponsorship categories was also starting to come under pressure: gambling and betting.
From the commencement of the 2026-2027 season, Premier League clubs are not allowed to have front-of-shirt deals with gambling companies. That vacuum has to be filled somewhere.
During the 2025-26 Premier League season, 8 clubs still had gambling companies on the front of their shirts, worth an estimated £60 million a year.
Cryptocurrencies will be licking their lips to an extent because they know that there is that revenue gap because of the regulation of gambling.
Within a few years, clubs were signing multi-million-dollar deals across the crypto industry, from blockchain platforms to major exchanges. And the data backs that up. Between 2021 and 2024, football was the biggest global category for new sponsorship deals ahead of other major sports, year after year. The more popular you are, the more people want a piece of you. During the crypto boom, football became one of the industry's biggest prizes. Crypto had bought its way into football. Clubs got new money. Crypto companies got visibility, trust, and access to millions of fans. But as the boom began to fade, that bargain started to look a lot more complicated.
Now, I'm told I've got to be very nice to our correspondent on soccer because he's also my producer on Executive Decisions.
That's true.
Thomas, it was brilliant. It's brilliant. No, but actually, I'll go to what I think is the question for me. Is I can't see the difference between gambling companies and crypto companies.
I mean, it's a good point, Steve. If you think about the history of sponsors, front of shirt sponsors for football clubs, I mean, you could argue that it's gone from tobacco to alcohol.
When was the last time there was tobacco?
Well, that not for a long time, but I mean, give you the secret: tobacco, alcohol, gambling.
Well, Carlsberg and Liverpool was a very famous shirt, wasn't it?
Yes, it was. Yeah, and now we're going to see a whole host of new players. Considering that last season, 11 of the Premier League clubs all had gambling sponsors on the front of their shirts. So it's all going to be all changed for this season.
But those are I suppose, for want of a better phrase, the sin companies, the alcohol, tobacco, the things that are bad for you, they're the ones that are often the most profitable, that have the money to invest. But where does that, if they then clamp down on crypto, where else can the clubs turn?
Well, I spoke to someone who works at ClickHouse, which is a AI data infrastructure company, and they are going to be the front of shirt sponsors for Fulham Football Club this season. And I had a really interesting conversation with her because she talked about how that it is a bit of a buyer's market at the moment because you've had this huge vacuum of space on shirts that needs to be filled. But still, the Premier League is such a premium product and such an international product that they're still paying premium prices for them.
I suppose if they don't, they may just have to look to the sorts of investors like we've seen with Liverpool and Bezos's.
Yeah, well, that's it, isn't it? The new minority owners consortium led by Amit Bhatia, who happens to be the son-in-law of Lakshmi Mittal, the steel billionaire, along with Eduardo Saverin, the co-founder of Facebook, and Jeff Bezos. They've invested £1.4 billion. And if you think about the return for FSG, Fenway Sports Group, who in 2010 bought Liverpool that was about to go into administration for £300 million. They put about 200 million pounds of their own money in. So they've put 500 in, and they're getting essentially they've made £1 billion and they've only sold 38% of the club. I mean, it's pretty impressive.
I'll move on quickly because there's another point to this, and you can catch the full episode of The Score on CNBC.com.
Thank you for that.
You're very welcome. I'm very happy to tease it. This summer has showcased the financial power of the Premier League, with the summer's transfer window set to once again break the record for transfer spending. So far, Premier Leagues have spent around €2.7 billion on buying players, dwarfing the €2.3 billion currently jointly spent by Italia's Serie A and the German Bundesliga and La Liga in Spain. But Tom, going back to your point about the amount of money that Fenway have made on this, and adding in that how much the players and the agents get vast amounts of money. I think it's like somewhere between 60 and 80% of the revenues goes back to the players. It's the only industry where that happens. I get that the underlying asset keeps going up for soccer clubs, but is the profitability, and I struggle with this, and I have lots of debate with this, is the profitability of these clubs improving, or just the underlying asset going up in value?
Exactly, that's it. It's bizarre, isn't it?
It is bizarre.
I mean, you need someone much more clever than me to explain how those two.
They all disagree with me.
Well, that's what's happening. I mean, you're seeing these clubs that their valuations are through the roof.
Yeah. Are you coming back later?
Yeah.
Wow. Look at you doing a full day's work.
I want to talk about Diego Maradona's shirt that's gone for auction and how much.
We'll do that afterwards. Here's the futures. We'll be back after a short break.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC+.
Never miss a moment.
We think there is a huge opportunity for AI in the UK and Europe because it is that middle ground between the United States and China.
Andy Burnham has committed himself to the Labour manifesto, so I don't think that that's going to change in the immediate future. I think our historic destiny is to be back in the European Union.
The world is taking you at your word, sir. What happens next?
We're never going to see Iran have a nuclear weapon.
American soccer legend Landon Donovan. He'll explain how the 2026 World Cup could shape the future of Major League Soccer and the inner demons that drove him to greatness.
I was constantly chasing this insatiable desire to be noticed.
He's the man behind Apple's sports ambitions. In an exclusive interview, we talk about the tech giant's unique sports strategy and whether a blockbuster acquisition is on the horizon. This is CNBC Sport on the Record.
1 hour of added insight every morning doesn't just add up, it compounds. 1 extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC.
The world has opened up to the possibility, the rare possibility that governments are running big deficits. That is shocking. That the governments are running large debt to GDPs. That is shocking. That the vast amount of money being raised in AI may be having a crowding out effect on the government bond market. Who'd have thought it? Well, in the meantime, that means that equities, well, what position do equities hold? Does it mean equities sell off because there is a general risk off? Or are they potentially beneficiaries of concerns in the bond market? It's a question which we'll continue to ask. Maybe we'll ask Nick Nelson that as well in a few moments' time. But in the meantime, the open of the markets. Ben.
Yes, let's check in on the best performing sectors. One notable absence on the board here was the outperformer yesterday, which was oil and gas, which closed the session on the Stock 600. That basket around 1% higher, tracking the price of Brent crude, which jumped above $93 a barrel. But not on the board of outperformers this Friday morning. Basic resources leading the way higher, more than 1%. Autos and parts, 2/3%. banks advancing this morning as well, and telecoms there rounding off the board of best performing sectors. To the downside, this is where the steepest losses are to be found, and it's healthcare that's giving up the most ground, around about 0.4%. Media stocks down 1/3% as well. Oil and gas, there it is, giving up some of the gains that we saw in the Thursday session, and industrial goods also off by a degree there, by a fifth of 1% there. Just say yesterday's biggest fall, it was retail, but it's somewhere in the middle, not on the outperformers, not on the underperformers. In terms of the regional picture, this is where things stand in the first couple of minutes of Friday trade. Bit of a mixed picture. Investors moving fairly cautiously as the CAC 40 is the one that's below the flat line. The London and Italian markets just above the flat line, but no big shakes there. You can't really blame investors for moving cautiously, can you, given all we've seen this week? And Steve has more on that.
The US Treasury yields are on the rise again, albeit modestly, rebounding from a pullback on Wednesday, which was triggered by an announcement from the US Treasury Department that it will at least double the size of its government debt buybacks, starting from the 9th of September. The 10-year yield is now back above the level it was at prior to the intervention, amid persistent concerns over America's debt pile. It's not just America, it's global debt piles, I would say, but in this case, the American debt pile, which has topped $40 trillion this week. The 30-year yield is the main focus of the Treasury's accelerated buyback, also rising this morning, around about 5.25%. To be fair, it's kind of staying where it's been for the last few hours. Let's have a look at global yields and where they are currently trading. And the 10-year paper in the UK, which is elevated, let's be honest about it, long talked about concerns, 5.07%, and the bunds at 3.25. Let's have a look at this from a different lens with Nick Nelson, who is head of global equity strategy at Absolute Strategy. Nick, again, it's like all my old friends today. I had Bob Parker early on as well, and we're lucky to have you. And you and I have been talking about the relative valuation of equities compared with bonds for a very long time. Yeah. What does this mean for what we're seeing in the bond market now, which I hasten to add is not new news?
No.
It might be new highs on the yields at the moment, but there is no new news about these deficits and debt loads on a global basis. But it is now in lens, it is now in focus. So what does it mean for your world?
Look, it is a good question because there's two ways of looking at it, as you were sort of hinting at. I mean, firstly, in our asset allocation, we have been steadfastly overweight equities, underweight government bonds, because we see this sort of sticky inflation, more volatile inflation, not getting down to the targets from most central banks, notably the Fed, who've missed for, 4 or 5 years now for their target. And that's a world, combined with these big deficits, that makes it maybe pretty precarious to be in government fixed income assets. So from that perspective, it is obviously, in our view, better to be in equities. However, having said that, of course, there comes a point, if we were to see, determined by both the scale and the pace of the sell-off in the bond market, that could cause a problem for equities, right? And certainly with the yields moving up at some point, of course, as you mentioned on the valuations, they start to become more attractive relative to yields that you would get from equities. So for now, very happy staying in equities, very happy to see equities outperforming bonds, but clearly there's a point where that could infect the equity trade, as it were.
Yeah, and just going back to the Bessent put, kind of put, not really much of a put, sticking plaster. Yeah. He says it's from 2 to 4, and now has told CNBC in the last 24 hours it can be more than 4. But the Treasury still plans to sell net $97 billion of long bonds, 20 to 30 year paper, in the August to October quarter. So you're buying back a little bit, but you're selling an awful lot at the same time. The market isn't stupid.
No. And you're spot on here, right? It's not the gross buying, right? It's what the net issuance is. And the net issuance, when you're servicing deficits that are, way over 6% of GDP, and as you pointed out, $40-odd trillion, that's a big deficit to service. That's a lot of debt you've got to issue. And playing around with the maturity of that, which of course is what we're talking about here, at the margin may have some effect on particular bond issues, right, in terms of liquidity, but it's not going to change that supply demand and this need week in, week out for investors to buy US debt.
But as Ben was pointing out earlier on, if you're going to be buying back more of the longer end, then you're going to have to pay for it by perhaps issuing more of the shorter end. And if you're issuing at the shorter end and the interest rates are near zero, great. But if you're issuing at the shorter end and interest rates are still pretty high and people are asking a large premium for that short paper, it's not actually that much of a win-win trade.
It's not as effective, but maybe the idea is if you have the Fed keeping rates relatively low, I mean obviously we're not at zero, that can anchor the shorter end of the curve. And thinking about the US, where a lot of the mortgage market, unlike here in the UK, right, we're all the long end, there's the 30-year mortgages that reset. So maybe it's the 10, 20, 30-year that's more important for things like housing markets. And so that can maybe be one way where they can kind of twist the curve a little bit from that perspective.
What does all of this do to your view on asset allocation then, geographically and sector-wise? Does it change anything?
Well, look, I think, as I said, I think it still keeps us a preference for equities. And the other thing we'd look at is other assets outside government bonds, because the traditional old 60-40 portfolio that people have been running for decades with 60% equities, 40% government bonds, I think that's not working right now. Partly because of the issues we've got with government debt, but also over the last 2 or 3 years, equity returns and bond returns have become more positively correlated. So you haven't had that diversification with your bond market. So that's why we think in a world of higher inflation, it's not government bonds, maybe it's real assets, maybe it's commodities, maybe it's industrial metals, maybe it's gold, maybe it's real estate. But it feels like we should be looking elsewhere rather than just government bonds for the other part of the portfolio.
What about the outlier being Chinese government bonds? I mean, it's extraordinary to be thinking about that, but they seem to be the one defying all of the other upward pressure on global sovereign debt yields.
Yeah, and there's a big disconnect there. The economy is doing something slightly different, and of course it has just come out of deflation. We had GDP deflators, CPI, PPI, all the inflation stats were all in negative territory. They've just kind of crept into positive territory. We think they might fall back into deflation again, actually. So it's in a different world. There's less inflationary pressures there, maybe, than there is in certainly the US and the UK.
What does this do in terms of, just keeping the focus in the Asia region for a moment, what does all of this do to the prospects for the Japanese market? Because the government had planned this big stimulus, but if its borrowing costs are going up, and we saw the inflation print come in at 1.9%, it's below target, but it's going to start hurting the Japanese consumer. They may stop, having patience with the government and what's going on. What does this do for the attractiveness or otherwise of Japanese equities at the moment?
Yeah, so look, I think from the bond market, we'd be very underweight JGBs. We think that, that Japan has had a period of obviously very, very low inflation or disinflation for the last 3 decades, basically. But as you say rightly, these inflation numbers are picking up, and I think they're cloaked by the fact that the government's doing all these fiscal subsidies to protect the consumer from the energy prices. So actually the real underlying inflation is significantly higher. Bank of Japan have been moving at a glacial speed to raise rates, a sort of 50 basis points a year type pace. We don't think that's enough. We think they need to do more. We would be underweight JGBs. Having said all that, I think the equity market looks very interesting, because I do think some of those growth stimulus at a macro level, the improvement at corporate governance at a micro level is coming through. And we can see that where Japanese companies are now doing more share buybacks than any major region in the world, more than the US. And that's the first time we've seen that for a while.
Nick, I know your focus is equities, but just any brief thoughts on crypto and the Bitcoin jump that was 20%? I mean, does that make a Bitcoin ETF an attractive prospect, or do you feel there's a degree of caution needed still?
Well, look, having said we've been looking at other assets outside government bonds, and I'm happy to entertain commodities, I'm happy to entertain gold, real estate, infrastructure, and so on. I think crypto may be a step too far. So it is a diversifier. I'm not sure it's necessarily going to diversify in such a helpful fashion, would be my personal view.
It certainly has a bit of volatility in the portfolio anyway, that's for sure.
Yeah.
Nick, really good to see you.
Good to see you.
Lovely to see you. Thank you so much indeed for your time. And Nick Nelson, Head of Global Equity Strategy at Absolute Strategy. Speaking to CNBC, US Treasury Secretary Scott Bessent said there was a very good chance that the US has seen its budget deficit peak under President Donald Trump after it topped $432 billion in July. Bessent also hinted that the buyback of government debt could be higher than initially announced.
We routinely do buybacks, and we're going to increase the size of the buyback. And, Sarah, I would note that it could be more than the $4 billion per issue.
And the Treasury Secretary also expressed frustration with the current trading levels in the bond market.
We believe that the yields don't reflect the underlying fundamentals. This Iran conflict, we will get on the other side of this. We don't know when, and we can talk about the economic measures we're going to be taking against Iran in a minute. We believe that the liquidity, especially in the 30-year point, is very poor.
Italian bank Monte dei Paschi di Siena has this morning launched twin bids for rivals Banco BPM and wealth manager Banca Generali. The offer values Banco BPM at just over 25 billion euros and Banca Generali at just under 9 billion. Monte dei Paschi said that a shareholder meeting will be convened for the end of October to approve the offers.
Still to come on the show, US Treasury Secretary Scott Bessent vows the toughest sanctions in history against Iran as Washington ramps up its economic campaign. Dan will bring us the details.
Listen to CNBC on the move with the CNBC app.
A check on how Europe is set to open the trading day.
Real-time market updates. Strong numbers this morning. Listen wherever in the world you are. Download the CNBC app now.
One of the world's largest private climate investment vehicles, Altera, aims to mobilize $250 billion by 2030.
What we're trying to show is that we can align those objectives and we can make money doing it.
Clean energy, emerging markets, even the AI boom. The opportunities are vast, but how do you pick the right investments?
We have people who specialize in these investments, and that's what makes Altera unique. That's our secret sauce.
Find out more on the next Managing Middle East.
My earliest ambition was to be a teacher, but I felt I couldn't afford it. My mother thought it was the highest calling, and I gave her a promise that one day I would be a teacher if I did well enough in life. It was my ambition, and I was able to achieve it. So now I can teach you so that you can be as ambitious as you want about whatever you want to do. CNBC is my home. If you love your work, well, maybe it's life itself.
Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange. Streaming on CNBC Plus.
Interesting talking to Bob Parker earlier on for many reasons, but not least the fact that he was just pointing out once again that French 10-year paper trades at a premium to Italian 10-year paper now, which historically is unprecedented. But so very interesting to get a barometer now on the French data. And I can tell you that the French PMIs are looking very, very weak. Services PMI fell to 48.4 in August. The forecast was 49.8, so firmly in contraction territory. And yet, the second bit of data hitting the wires is rather encouraging, which is extraordinary, isn't it? Services weak, but the flash PMI rose to 51.5 in August versus a forecast of 50. Now, the services side perhaps larger in terms of dominance than the manufacturing side, but it does show that despite the fact that we've got contraction of activity in the services side, the services side going to a 2-month low, the manufacturing side of the ledger was rather positive. The team over at S&P Global Market Intelligence says the flash PMI report revealed another month of frail economic conditions, with some firms, mainly in the service sector, highlighting the extreme heat as a reason for lower activity demand. Ben.
US Treasury Secretary Scott Bessent has promised to, quote, collapse the Iranian regime, warning American allies that you're either with us or against us. Speaking to CNBC, Bessent also weighed in on the prospect of further military activity in Iran.
If we are doing the maximum economic pressure, then that means that likely there will not be a large-scale kinetic restart. But I would emphasize that is for now. And look, we do have control of the strait.
Well, Dan joins us with more now. Do we know who those comments were particularly targeted at, Dan?
Likely China, Ben, but of course the full extent of these details is likely to be revealed on Monday when the administration outlines exactly how it plans to try and break Iran's economy. The Treasury Secretary Scott Bessent there telling CNBC the goal now is to avoid a large-scale return to military operations. Bessent also saying there that if maximum economic pressure works, a major kinetic restart may not be necessary. Now, what's interesting is that oil prices actually rose off the back of this announcement. So the Treasury Secretary suggesting that the US is less inclined now to go back to war with Iran. However, prices popped in the order of 2 to 3% stateside. We are seeing some give back now, both contracts down just over 0.5%, but Brent crude still holding on to 93 USD. The plan here is a combination of the US naval blockade and what Bessent says will be the toughest sanctions ever imposed, with foreign countries, banks and companies all being warned now that they'll have to choose between doing business with Iran or access to the US system. Bessent says Treasury is going to lay out those details on Monday. Take a listen.
We have a combination. It is a 1-2 punch. We have the blockade, and we are going to have the toughest sanctions in history. And I will tell you, this will work. It worked in Venezuela once we put up the blockade. It is working in Cuba right now, and it is going to work in Iran, and we are going to collapse this regime.
Scott Bessent there, and that is perhaps the clearest statement yet of the administration's objective here, not just to pressure Tehran back to the table, but in Bessent's own words, as you heard there, to collapse this regime. What we do know is that Iran, for many, many years now, has been building ways around these Western sanctions, from Chinese oil buyers to shadow shipping networks to alternative payment channels. It's a pretty sophisticated back-end operation that ultimately protects the Iranian economy from this Western onslaught. So the question now is whether Washington can actually close some of those escape routes to China and to elsewhere, and whether or not allies of the US are willing to step in here and help to enforce it. Finally, as well, what does the new economic pivot mean for the duration of this war? Next week is actually going to mark 6 months since the war began. It's a milestone that we will hit on Friday next week. How much more economic pain can the people of Tehran really tolerate before the regime itself faces some serious social and fiscal stress that could potentially force the reopening of Hormuz or the restart of nuclear talks? I think that remains pretty unclear at this point. It's back over to you.
It's a very important and human point to look at as well. Dan, here's a question for you. The UAE obviously is furious at being targeted, and they thought they had some form of détente with Tehran as well. So they've broken off pretty much those negotiations, those trade relationships as well. But if Iran and the UAE were to, again, find some form of rapprochement, and actually there are no more missiles fired at the UAE, will the UAE then rejoin in terms of some of those activities, financial and trading activities, or will they be forced now to actually have a longer pause in relations with Iran because of what the US has just done?
Well, I think what you're tapping into is really important, and the UAE, of course, has to navigate this not just from a political perspective, but also from a geographical perspective. Iran isn't going anywhere. It's going to continue to be a country that the UAE will need to work with in the region moving forward. And for many, many years now, the UAE has acted as somewhat of an economic and financial facilitator for the people of Iran. Bank accounts here, businesses, home sales, for example. And then beyond that as well, Dubai in particular has long been a major re-export hub for Iran's economy. So whether or not we will see a significant impact as a result of the curbing that the Foreign Ministry announced this week here in the UAE remains to be seen. Again, we're waiting on more details on exactly what that's going to look like. And then casting your mind into the future as well, because Iran isn't going anywhere, how the political climate also shifts could perhaps determine what type of relationship the UAE is going to have with whoever is leading Iran into the future. So those details still to emerge. I think that is perhaps a more long-term consideration at this point. In the short term, the focus for the Gulf states here is reopening the Strait of Hormuz to ensure that their energy and products can continue to reach customers around the world, and of course ensuring peace and stability in this part of the world too, so that capital and investment can continue to flow and people here can still consider this place to be a good place to live, work and thrive.
Great work, Dan. Thank you very much indeed for that. So let us move on. At COP28, the UAE launched a $30 billion climate investment fund with the goal of mobilizing $250 billion by 2030. In the latest episode of Managing Middle East, CNBC's Dan Murphy asked the Altera CEO about his confidence in meeting the target and how the company is balancing financial returns with climate impact.
Today, I can tell you, I'm extremely confident that we'll hit that target by 2030. We've been really pleasantly surprised with our mobilization ability. Why is it important? It was important as a measure because what we wanted to prove was that we could be commercial, that we could drive the private sector to invest in these spaces. And that's what so far we've been able to do.
What happens on the investment committee when a project has a massive climate benefit, but the financial return is, let's say, just okay? Which one wins?
Dan, you know, when we started out, our investment committee was very clear that we were profit focused, that we were returns focused. And we've never brought an investment to them that wasn't great financially, comparable to investments in any other sector, whether it's green or not. And so over time, our investment committee conversations changed from how are we generating more impact. So from our climate impact framework today, we create an impact score that's kind of an internal score that allows us to measure how impactful this is. And that can be a combination of how much emissions is it creating. It can be about its impact on the economy or the community. Today, our investment committee is asking us how to get higher and higher impact scores on our investments.
It's been a challenging year for the Middle East, and 2026 has brought a whole variety of challenges, in particular the war with Iran. How do you think that is shaping investment decisions from the Middle East and the appetite to do business in this part of the world?
I think that what has really struck me has been how partners have doubled down on the UAE. I think that this really shows how the UAE has moved from where we were in the past, where we were sort of subject to macro or regional effects. I have not seen any difference in the partners, the investors. They're all here today, they're all working business as usual, and that's really a testament to how well our government has prepared and is moving forward. I see that continuing to grow. So I feel optimistic about the UAE.
Yeah, I've met Mr. Al Suwaidi many times. He's a great CEO and a really, really fascinating guy. So I thoroughly encourage you to look at the whole of the episode of Managing Middle East this Saturday, 3 p.m. or 6 a.m. Sunday UK time, or online, of course. Coming up on the show, a perfect storm brews for global food suppliers. Russian-Ukraine exchange strikes in the Black Sea. We'll discuss.
From London, Paris, Munich, and
less.
We've seen very strong demand all summer long. End users are using our AI even more frequently.
Are you heading into a record Q4?
We are gearing up for the biggest IPO of the year.
Prime Minister, it's a pleasure to be back in Athens.
It's a pleasure to talk to you.
It's becoming a very competitive market in the EV space.
Parliament continues to stay very fragmented. This Bank of England decision certainly got more interesting over the last couple of months.
Here's what investors are watching this morning.
As the Asia trading day begins, join me for Squawk Box Asia. What are you watching? Nobody would be thinking that level of a benchmark is possible. We're live across the region, covering what you need to know from here and around the world that would shape the business day.
We know there's two winners in AI. It's going to be China-US.
Let's stay away from these companies that are selling it at 40, 50 times sales.
Join me for Squawk Box Asia, only on CNBC. On market shaping industries, we are watching the six little dragons, the first to be listing in the Hong Kong market, supply chains, and global momentum.
Do you feel pressure to create the next Labubu soon?
This really is a business-first pivot, despite the geopolitical strains. The China Connection, weekdays.
The trade heads are gathering against the backdrop of the global energy crisis.
CNBC.com and the app anytime. Let's get to your headlines. Only on CNBC, connecting you with China.
The day's top stories driving Wall Street. Up-to-the-minute developments. Kelly Evans, Brian Sullivan, Powerline, streaming on CNBC+.
Welcome to Squawk Box Europe. I'm Ben Boulos with Steve Sedgwick, and these are your headlines. The Bessent buyback fails to tame the bond market. Treasury yields rebounding, largely wiping out Wednesday's intervention relief. The US Treasury Secretary tells CNBC he is prepared to boost the operation beyond $4 billion.
We routinely do buybacks, and we're going to increase the size of the buyback. And, you know, Sarah, I would note that it could be more than the $4 billion per issue.
Short sellers get squeezed. Bitcoin breaks past the $76,000 mark, adding around 20% since Monday. Coinbase's CEO Brian Armstrong tells CNBC, "We may be on the cusp of the next bull market."
We've been in a bear market on spot crypto trading for the last year or so. And if you look at the prior bear markets, they each lasted about, 370, 380 days. We're basically coming right up against that, where people, they're going to say, well, this one's about over, and it's time for the next bull run in crypto.
And another twist in Italian bank M&A. Monte dei Paschi launches a twin takeover offer for Banco BPM and Banca Generali, a deal that would create a giant valued some 70 billion euros and fend off Intessa's own takeover bid.
We're talking to our next guest about a potential perfect storm in many of these soft markets, in the agricultural markets as well, and it's going to be a great interview. But very interesting looking at what the weather is doing elsewhere in the economy, and the French business activity shrank more than expected in the last half an hour or so, in the last 20 minutes or so, on the back partly of that weather, of the extreme weather. Now, that's having a really dramatic effect on the Rhine as well, and remember I did this earlier in the week, 6 centimetres is the depth of the Rhine at one key choke point. You can't get any shipping through at that kind of level as well. So real concerns in Germany, not only about the broader weather, but also what it's doing to activity on the manufacturing front. In fact, so much so that we've just had a couple of the flashes, and the flash composite figure is actually coming nearly on line of expectations at 51 for Germany, as opposed to the forecast of 51.3. Once again, the flash services figure, underwhelming at 48.5 as opposed to the forecast of 50.1. I haven't actually got the individual breakdown of the German manufacturing data. It's here. And actually, despite all of those concerns about the Rhine and the shipping and what it's doing to logistics in the country, it's coming at 54.1, which is above expectations, above 52.1. So similar to what we're seeing in France. Overall, the activity underwhelming on a service front, but broadly, German business activity expanding in an upturn in manufacturing, which is offsetting the other decline. Let's see what S&P Global Markets say about it. They say the recovery in the manufacturing sector has regained momentum after it showed signs of stalling in the second quarter, although the service sector continues to act as a drag on the growth. Let's move on.
Let's see how things are playing out on European equity markets, and they have taken a turn for the better in the first half an hour of trade. You saw a bit of a clouded picture, lacking direction at the open, but all of them turning positive to a greater or lesser extent. The FTSE 100 and the Italian MIB both advancing by the biggest amounts. The DAX there responding perhaps positively to those PMI figures Steve was just running you through. The CAC 40 is the laggard. It's only just above the flat line. Again, perhaps investors reacting to the French PMI figures we had earlier, which showed that weakness in the French economy. In terms of the sectors, this is the board of outperformers. Basic resources, look at that, storming away to the top of the best performer board, 2.25% higher, that basket of stocks, half an hour into the Friday session. Banks also advancing handsomely there, 0.75%. Construction and utilities also on the front foot this Friday morning. To the downside, this is where we're seeing the biggest losses. Healthcare is the sharpest faller, down almost 1% there. The media basket of stocks giving up a similar amount of ground. Financial services just below the flat line, and household goods also just below the flat line as well. How does this all tee things up for the US markets? Well, they're looking to open more positively. This is after a session in which the three benchmarks lost ground when we saw the yields climb back up again. We saw oil jump yesterday, Brent crude up above $93 a barrel, gold was up as well. That all weighed on equities, but they are looking to regain some ground there. Let's keep tracking that as we get closer and closer to the Wall Street Open. In the meantime, analysts are warning of a perfect storm brewing for the global food supply this winter as Russia and Ukraine continue to exchange strikes on infrastructure in the Black Sea, which, combined with extreme weather, is putting food security under additional pressure. Noel Fryer is the founder of Fryer's Report. Noel, just explain what's going on there and when the effects of this will start to be felt, if they haven't already.
Yeah, good morning, Ben. Nice to talk to you again. The biggest change in the market since we last spoke, I think back in March, is the Black Sea, because up until a couple of months ago, civilian targets and vessels were kind of not part of the game. They were largely allowed to work freely, and supplies kept coming out of the Black Sea. What has changed is that both Ukraine and Russia are hitting the other side very hard, and that has led to an almost complete halt in Black Sea execution, basically because vessel owners either can't get insurance at all, or it is just prohibitively expensive, and so they're not going in there. And that's been the biggest change, and that is what provides the major threat to supplies in the coming year, whether it be grain, wheat, corn, oilseeds, vegetable oils. These two countries represent huge percentages of world trade.
And I've seen it written that this is worse for the wheat market than Hormuz was for the oil market. Does that tally with your view?
Yes, it does. The wheat market is. The problem is that you've got the USDA in their monthly reports are effectively saying that there's no problem. They have Russian and Ukraine combined exports for the coming year down just 2 million tons on last year. Well, Russia alone will have lost 3 million tons by the end of August. My numbers suggest that you're going to lose at least 15 to 20 million tons of Russian wheat. You're going to lose 5 to 10 million tons of Ukraine wheat, and that for the world, as a percentage of the world market, is huge. How that lost demand gets allocated between other exporters remains to be seen. And the difficulty at the moment is that both the EU and US, that their data of exports to date are well down on what on last year and what the market might expect.
Noel, good to see you, my friend. Are we seeing a combined problem that's actually masked by West's richness, and actually it's really playing out in more emerging and developing worlds at the moment? I mean, I noticed from your, I think the comments of the rice prices up 25%. Is it the case that whilst we're concerned about inflation in the West, we haven't actually seen the real dramatic effects of this, but it is being felt elsewhere?
Well, I think that's true. Good morning, Steve. The food inflation will always be felt the worst in the poorer countries, in the developing countries, because they spend a much larger percentage of their income on food. Food inflation, if you believe the research, doesn't kick in until 3 to 6 months after a global climate or political event. Well, I would argue that it is much too early to say that food inflation is kicking in, because, like I said, the impact in the Black Sea in terms of export is really only a couple of months old. El Nino, which everybody's talking about, hasn't peaked yet. We don't know what the long-term effects of the fertilizer problem will be. What we do know is that there are severe shortages of fertilizer in Asia for the rice crop. We do know that Brazil, which is going to plant its first corn and bean crops in September, they only have about 50% of their needs bought. So it's not clear whether they're going to buy the rest or whether they're going to use less, and what that means for yields. So yes, it is the inflation, the food inflation thing is very difficult to pin down. I saw another report the other day that it's going to hit Europe in the fourth quarter of 2026 by 2 to 3%. It's going to hit first half of 27 by another 5%, and maybe by early 2028 it'll be 10%. Now, I don't believe any of those numbers for the simple reason that I live alone and I do my own shopping, and I can guarantee you that my food bill is up 15 to 20% this year.
Yeah, that's fascinating. So look, tying this into the bigger picture, and you and I correspond all the time, Noel, as well, but in terms of what it means for inflation markers, and I guess inevitably we look at the United States as well, and this big debate about whether there is real inflation in the US or not. It was something that was a major issue for Biden, is appearing now to be a major issue as we go into the midterms for President Trump as well. Do you see any likelihood, given what you've said, of prices going down and there being a strong supplier response from the enormous agricultural sector in the US and elsewhere, or actually will food inflation continue to go up?
I think that there will be, if the war in Ukraine were to end tomorrow, there would be a knee-jerk reaction to grain prices, that's for sure. How soon that could filter down to real shipments and real supplies in the consuming countries, I'm not sure. One aspect that I didn't mention is that one of the big reasons that the market has not been stronger on wheat is that what we term the MENA region, MENA, Middle East, North Africa, and Turkey, their crop their production this year has been about 30 million tons above last year. So they have been cushioned from having to move into the market in a big way earlier in the season. The question everybody is asking now is, how long can this go on?
Yeah, and we'll have to keep asking that question, Noel. A lot longer than many of us expected, that's for sure. Noel, nice to see you. Have a great day, my friend. Noel Fryer, founder of the Fryers Report. OK, for more on how blocked shipments from the breadbasket of Europe are piling pressure on global food security, head online to CNBC.com. Now, something I didn't need to worry about with my team, but the new season of the Premier League kicks off today. Mine got demoted last year. As newly promoted Coventry, good luck to them, face last season's champions Arsenal in the opening game. The opening weekend will see a record of 9 clubs with managers taking charge of their first Premier League games, highlighting the cutthroat nature of the division. This season, however, has seen a fundamental rule change in the Premier League, but it will not necessarily affect the action on the pitch. For the first time, Premier League clubs have collectively agreed to remove gambling companies from the front of matchday shirts, a crucial revenue stream for clubs. But could the ban offer an opportunity for a new industry to take over a key form of income for clubs? Tom Chitty has looked into the rise of cryptocurrency sponsorship in the world's most popular football league.
Football clubs are always looking for new revenue streams. During the 2010s, they began securing hyper-specific brand partnership deals for everything, from noodles and deodorant to even tractors. So, when crypto companies came looking for partners, clubs were ready to listen. And in 2020, one of football's biggest traditional sponsorship categories was also starting to come under pressure: gambling and betting.
From the commencement of the 2026-2027 season, Premier League clubs are not allowed to have front-of-shirt deals with gambling companies. That vacuum has to be filled somewhere.
During the 2025-26 Premier League season, 8 clubs still had gambling companies on the front of their shirts, worth an estimated £60 million a year.
Cryptocurrencies will be licking their lips to an extent because they know that there is that revenue gap because of the regulation of gambling.
Within a few years, clubs were signing multi-million-dollar deals across the crypto industry, from blockchain platforms to major exchanges. And the data backs that up. Between 2021 and 2024, football was the biggest global category for new sponsorship deals, ahead of other major sports, year after year. The more popular you are, the more people want a piece of you. During the crypto boom, football became one of the industry's biggest prizes. Crypto had bought its way into football. Clubs got new money. Crypto companies got visibility, trust, and access to millions of fans. But as the boom began to fade, that bargain started to look a lot more complicated.
Well, the busy man that Tom Chitty is has managed to find some time to pop along to Scorebox. Morning.
Morning.
I do love the fact that your piece to camera starts with you in front of a West Ham shirt. Is that just to wind me up that we're not in the Premiership?
No, I thought it was an honour.
Homage to Dr. Martins. Dr. Martins, pretty innocuous, really. I mean, not so much in the 70s, but these days they are. Yeah. Deodorants, tractors. Yeah. What was the other one you said? Noodles. They're all pretty innocuous. But what is... But to the hub of the issue, what is the difference between a gambling company and a cryptocurrency company?
Yeah, it's a good question. I think, I'm not sure I'm going to answer that question, though, because I'm going to get myself in trouble. But what I would say is that these crypto companies, whilst there has been a huge sponsorship boom into football, particularly in the early 2020s, off the back of COVID, and these football clubs needed cash, needed to fill the hole that was left. I mean, look, Manchester United were losing £4 million a home game every match day when there weren't any fans there. It's the biggest capacity stadium in the Premier League, so you can understand that they were keen to, open their doors to new investment from these crypto companies.
So my question is, which is the better product, score or executive decisions? No, sorry, that's another tough question that you could get yourself into trouble by answering. My question, Tom, is if the shirt space is vacated then by the gambling companies, if there's then a crackdown on the crypto companies, where can they look to get the funds that are necessary? Because as I understand it, the losses on the Premier League last year were several times bigger than what we've seen in the year before.
Look, I think the companies that will want to get onto the front of shirt for match days will be tenfold. It's still a premium product. The Premier League. The exposure you get is incredible. What's interesting is that it's not these B2C companies that we've seen previously, like gambling companies, for instance, right? The fans see the gambling company, or this is the idea, on the front of their team shirt or another team shirt and go, yeah, okay, I'm going to use that betting company or to place a bet, and it's direct to consumer. What's interesting is that now a lot of these new companies that are investing into football and into those front of match day shirts are B2B, right? And you're like, well, why are they doing that? What's the appeal? And it's two things. One, it's the exposure to the international exposure, putting yourself as a global brand. But the other thing, which is interesting, is hospitality. And to be able to have hospitality boxes, to be able to bring your clients to Premier League matches is a massive cachet for these companies. And I thought that was particularly interesting when I spoke to Tanya Bragin, who works for ClickHouse, which will be the new front of shirt sponsor for Fulham Football Club this year, who used to have a gambling sponsor on the front of their shirt last year. So direct swap.
Very interesting, the evolution you were talking about earlier on, isn't it? From tobacco companies, alcohol companies, gambling companies, it's how the zeitgeist changed. I mean, one thing I think is quite interesting is the only time I've been in a box.
Come on, Steve. You've been in a few boxes.
No.
Let's be honest.
Let me clarify.
The only time I've been in a box. I'm sorry, I can't. I know there's a lot of BS that comes out on this show, but that takes.
I say those letters. The only time I've been in a box at football for a long time was with an alcohol company, but the alcohol company was promoting their 0.0 products as well. So they'd reinvented themselves and their sponsorship to the zero offering.
Ben's still laughing about this.
Well, I hasten to add, it's not the only time I've been in a box.
Okay, so just clarify that and get that on. Yes. No, back to your point. I don't know what your point was, but...
No, it's just how the companies themselves evolved. So, for instance, the tobacco companies, the controversy there is how they evolved from tobacco companies purely to vaping companies, for the alcohol companies to go to zero as well.
So what's the 0% version of gambling or crypto companies, for instance? I think what's interesting is the FCA published a letter at the end of last season to all football clubs saying how they were concerned about football clubs promoting these essentially crypto companies which may not have been regulated, and that I think has given some distance to football clubs because there is no crypto companies on the front of shirts this season. They're on sleeves, they have crypto partners, but not on the front of the shirts. And I think that FCA letter was a big part of maybe just making the football clubs think twice about putting a big crypto company on the front of the shirts.
And you can catch the full episode of The Score on CNBC.com. And I know you want to mention the other thing later, but we can't do it now because...
It's clear which you think is the stronger piece of content. Clearly.
The Score.
The Score. There we go. It's the one you've teased, isn't it?
Yeah,
You've spoken. It's all right. There's no doubt.
Let's have a look at where the crypto's currently. I'm lost, as ever. 76,000, look at that. We had Coinbase saying we're on the verge of a bull market. I think we are actually in a bull market on the official terms, given the 21% rally we've seen in the last few sessions. Let's take a look at the cryptos for the week as well. They are, there you go, up 21% in the last week. That looks like a bull market to me. Ben.
Coming up on the show, rising AI costs cut profits at Alibaba as the Chinese tech firm posts results. And, do you remember, Tom, everyone's friend, not the Tom sitting at the desk with us, but the Tom from MySpace, could be back. Could Naughty's nostalgia help relaunch the site? We'll find out after the break.
American soccer legend Landon Donovan. He'll explain how the 2026 World Cup could shape the future of Major League Soccer and the inner demons that drove him to greatness.
I was constantly chasing this insatiable desire to be noticed.
He's the man behind Apple's sports ambitions. In an exclusive interview, we talk about the tech giant's unique sports strategy and whether a blockbuster acquisition is on the horizon. This is CNBC Sport on the Record.
The AI boom is reshuffling the global equity market rankings, with Taiwan and South Korea leapfrogging past long-established markets. Taiwan has climbed past Canada and India to become the world's 5th largest equity market, while South Korea has moved into 6th place.
All this happened within the span of just a few months, because last December, they were in the 9th and 11th places respectively. Now, such a shift is not unprecedented, but what is unusual is the speed at which these two have been climbing.
But this reordering isn't necessarily being driven by broad economic growth. Instead, it's about 3 companies at the heart of the AI hardware supply chain.
It's the AI theme which is driving things. So we have this kind of perfect positive storm of industry fundamentals which are resulting in very, very rapid profit growth.
So what does this reshuffle tell us about how AI is changing global stock markets? And what are the risks?
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
Alibaba shares trading lower in Hong Kong after the Chinese e-commerce giant posted a 75% drop in quarterly profit, mainly due to a ramp-up in AI spending. US shares, nevertheless, closing the Thursday session in the green. Elsewhere, SpaceX shares closed in the red on Thursday after another post-IPO lockup expired. CNBC's Seema Modi has the details.
About 319 million SpaceX shares have become eligible for sale. This is SpaceX's second lockup as part of the company's staggered approach to unlocking shares for early employees and investors over the course of 1 year versus all at one time. Bankers often recommend this strategy to limit volatility. Investors can choose to hold their shares, so the actual impact on the stock really depends on how much they sell. SpaceX shares did rebound following its first lockup in early August and are still up about 22% since then, though the stock has pared some of those gains. Driving today's price action, Chinese startup Landspace launching and recovering the bottom part of its rocket. Till now, SpaceX and Blue Origin were the only companies capable of reusable rocket technology. So it's seen as yet another sign of China attempting to narrow the gap with the U.S.
A US teen has dropped a lawsuit against social media companies Meta, YouTube and Snap ahead of trial in October. She had alleged social media addiction and mental health issues, but has dropped her claims without payment. Now, the owners of MySpace, the early 2000s social media platform, are planning a comeback bid, looking to capitalize on nostalgia and rejection of the modern social media experience. Soda Bimia joins us now. Soda, what's this all about? Nostalgia? I mean,
yes.
Social media, isn't it?
Yes, so the current owners of MySpace, Tim and Chris Vanderhook, said they're going to relaunch the platform in a new documentary.
Does it exist at the moment?
It doesn't exist, but they're planning to bring it back. But they haven't decided exactly when that's going to happen. So there's very little detail around it at the moment. But the announcement itself went viral, and it generated a lot of excitement and buzz, especially among the nostalgic millennials who used it in the early 2000s. And there's a lot of curiosity as to how this platform will actually navigate a 2026 environment where there's more regulation and more scrutiny around these platforms. I spoke to a few analysts as to whether a MySpace comeback is actually viable. And what they spoke about was that while it may not be able to challenge the big players and actually compete with the big tech giants, it could be profitable as a small ad-based platform, but it really needs to nail that demographic of users that it's trying to attract, lean into the Gen Z users, the Gen X and the boomers, and if it can really sustain user engagement, then advertisers will be more inclined to allocate budget there.
I'm trying to work out what Gen I am. I always forget. I think I'm X.
But it just needs to balance. It just needs to balance the nostalgia for the early 2000s with...
I can't remember what I was doing on social media in 2000. Probably nothing. What did MySpace do that the others didn't in the 2000s?
Yes, so the thing about MySpace was that it was the early experience of social media. It was a time when social media was actually social. And so what we see now is that the big social media platforms like Instagram and TikTok, they've said that they'd create a more connected world. People would be able to talk to each other and actually connect with their friends and their community. But that didn't happen. They didn't deliver on that promise. And so people are feeling incredibly fatigued by the dominant social media platforms. They feel like their mental health has deteriorated. There's addictive features also. And so that has all contributed to exacerbating loneliness and this fatigue around the social media platforms.
But if there is that pushback, it's a really tough climate then for MySpace to try and get a share of the market, because if people are pushing back against social media, why would they want a new entrant? And also, if MySpace couldn't survive when it was had the early advantage before all of these competitors emerged, what makes them think they can survive now? Is it just the nostalgia?
Yeah, so it's not just that people don't want to use social media at all. You know, they want to go out in person, they want more in-person experiences, but they also want a different, more conscious, more mindful experience of social media as well. And if MySpace can deliver on that aspect and really differentiate itself from the big social media platforms, then it has a chance at succeeding.
Great. Do you know one of the features, Will, our director, reminded me, on your MySpace page you could showcase your top 8 friends.
Yes.
And you could change the rankings weekly. So you'd sometimes get a message from someone saying, what have I done to you to be dropped out of the top 8?
Well, let me turn that on its head. I've got to try and find top 8 friends.
Oh, sure you've got plenty. Sure you've got plenty. Do you want to tease for the break?
Coming up on the show, we'll be joined by Sean Pesh. I'm friends with all of you lot, of course, to discuss his latest stock picks. Don't miss that conversation after the break. Thanks, though.
Become a smarter investor with CNBC Pro. 24/7 access to market-moving news and interviews with 3 global live streams. Subscriber-only content from Wall Street pros like Josh Brown.
If you love the stock market as much as I do, you're going to love the best stocks in the market list.
Plus exclusive live events.
This is my first time at the stock exchange and it's been awesome.
To be on the floor, I just can't believe I'm here.
Become a CNBC Pro. Go to cnbc.com/GoPro now.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show. Squawk Box, streaming on CNBC Plus.
You know, for me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. You want to learn more about it. And I think CNBC allows our viewers to fulfill their passions. There's no doubt that the people who watch us care. I am very much focused on trying to land interviews where there is something at stake and asking them fair but tough questions in which their answers are important. I could not imagine covering anything else.
Very warm welcome to Squawk Box Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. The Bessent buyback failing to tame the bond market. Treasury yields rebounding, largely wiping out Wednesday's intervention relief. The US Treasury Secretary, though, telling CNBC he's prepared to boost the operation beyond $4 billion.
We routinely do buybacks, and we're going to increase the size of the buyback. And, Sarah, I would note that it could be more than the $4 billion per issue.
Wall Street looks to close the week on a high note, rebounding from Thursday's pullback as jitters in the bond market had seeped into equities. The US majors still on track, though, for a down week. Short sellers get squeezed. Bitcoin breaks past the $76,000 mark, adding around 20% since Monday. Coinbase CEO Brian Armstrong tells CNBC we may be on the cusp of the next bull market.
We've been in a bear market on spot crypto trading for the last year or so. And if you look at the prior bear markets, they each lasted about, 370, 380 days. We're basically coming right up against that, where people, they're going to say, well, this one's about over, and it's time for the next bull run in crypto.
All right, US Treasury yields are on the rise again, rebounding from a pullback on Wednesday, which was triggered by an announcement from the US Treasury Department that it will at least double the size of its government debt buybacks starting from the 9th of September. The 10-year yield is now back above the level it was at a prior level to that intervention amid persistent concerns over America's debt pile, which topped $40 trillion this week. It's not actually the debt pile that matters. You can have $200 trillion of debt. It's the size of the economy versus that debt pile. We must really make that point because it's all about the relative position, isn't it? The relative deficit as well. Now, the 30-year yield, the main focus of the Treasury's accelerated buyback, also rising this morning. Let's take a look at global yields and where we are across the board. Here we go with the bunds at 325. 10-year paper in the United States at 4.7, and the gilts elevated as well in the United Kingdom at 5.06. And if anything, that UK figure shows you this is not just a US issue. It is not just about a flight out of the US bond market. It is about concerns about global bond markets. Speaking to CNBC, the US Treasury Secretary Scott Bessent said there is a very good chance that the US has seen its budget deficit peak under Donald Trump, after it topped $432 billion in July. Mr. Bessent also hinted that the buyback of government debt could be higher than initially announced.
We routinely do buybacks, and we're going to increase the size of the buyback. And, Sarah, I would note that it could be more than the $4 billion per issue.
The Treasury Secretary also expressed frustration with current trading levels in the bond market.
We believe that the yields don't reflect the underlying fundamentals. This Iran conflict, we will get on the other side of this. We don't know when, and we can talk about the economic measures we're going to be taking against Iran in a minute. We believe that the liquidity, especially in the 30-year point, is very poor.
So as the equity session ploughs on, we are an hour into the Friday trading day. Equities across Europe have turned far more positive than where we started the session. All of them firmly now into positive territory. The CAC Camera had been lagging behind its peers. We got some rather weak French PMI data, but they have since climbed up around 0.1%. The other markets in London and Frankfurt both advancing a similar amount, 1%. The Italian market, though, the standout leader this morning, up more than 0.4%. In terms of the best performing sectors, it's basic resources leading the way higher this morning, more than 2% up. Some of the names jumping to the top of the list of gainers on the Pan-European Stock 600 are the big mining companies, the likes of Antofagasta, Anglo American, Fresnillo, Glencore, all of those helping, of course, to lift the London index, but also banks on the front foot as well. That basket of stocks advancing almost 1%. Construction moving higher this morning, and tech also rounding off that wall of outperformers. Where are we seeing the biggest losses? I'm glad you asked, because I have another wall to show you, the wall of red, and it's healthcare giving up the most ground this morning, 1% lower. Travel and leisure down as well. Media stocks down 0.7%. Food and beverage just a whisker below the flat line, not much in terms of a dramatic move there, but still in negative territory. We saw on Wall Street yesterday a sell-off all the indices closing firmly in the red after the Treasury yields climbed despite that intervention by the Treasury Secretary to try and calm the bond market. Well, it looks as though the Wall Street equity markets are going to stage a bit of a rebound. The futures indicating a positive start to the Friday session across all main benchmarks, with the Nasdaq looking to lead the way, being called 0.5% higher.
Speaking to CNBC, the St. Louis Fed President Alberto Musalem said the US faces price pressures on several fronts.
Inflation is high for two reasons. We've had a sequence of supply shocks. We might have another supply shock in the fall with a super El Nino coming. And in addition to that, we have very persistent demand forces in the economy. The AI build directly into capex and investment, and indirectly through equity prices and wealth effects onto consumers. And we see sticky consumer price inflation.
Let's get some stock ideas for you now. Sean Pesh is the portfolio manager over at Ranmore Fund Management and joins us now. Sean, nice to see you. Thank you for rejoining us on Scorebox. Yeah, look, very interesting point in your notes as well, before we get on some individual stocks, is like you want to capture the upside, but you also don't want to have the same exposure to the downside as well. And that puts into context relative performance versus absolute performance. Tell me and our viewers why that's so important for you.
Steve, I think the reason it's important is that you want the upside, not the downside, because we all want positive volatility. We just don't want negative volatility. And so if you are a very long-term buy and hold strategist, generally, or holder, generally you're going up and down, okay? Whereas with us, we are happy when stocks reach what we think is fair value, we sell.
Yeah.
So we are unashamedly active managers, and I think that's what people pay us for. That's why our clients pay us. And so if you can, buy stocks when they're very out of favor, and we value investors. So, for example, in recent, in current climates, we're not buying air conditioners, we're buying ski jackets, okay? If you buy ski jackets in summer, you get a good deal. And then if you sell them in winter, well, then you get full price. And that's what we basically do. So we're trying to buy stocks and companies below fair value, and then when we sell them at fair value. So we miss out on some of the pullbacks. And so, that's what we do.
I mean, people talk constantly about concentration risk in these markets and the sectors that are in vogue, and we all know what they are as well.
Yeah.
Most of the stuff surrounding AI as well. Is it easy for you at the moment to find value out of favour sectors?
Yes, there's always sectors that are out of favour, and regions actually as well. So for example, we have some 40% in Asia, and it's interesting at a time when everybody's talking about AI and technology, and you're looking at the large US companies, we've got Tencent. We've been buying Tencent. Tencent's at the same price as it was in 2018, and yet earnings have tripled. And if you look at the costs of token usage in China, it's a fraction of what it is in the US. And so, the power cost is lower, the infrastructure costs are lower. And so we just think they're pretty well positioned, and yet you're paying 12, 13 times earnings, net cash, being more disciplined on capex than the US counterpart. So Asia's very features largely. We don't worry too much about benchmarks. We go where the value is, and benchmarks don't typically tell you where, benchmark weightings don't tell you where the value is. But also software. Software has been very out of favor in recent months, and we have a number of software holdings in our top 10. And the thesis was that AI was going to destroy software, and it's going to make it challenging for some. But actually, we think it's an opportunity for others, in that it's an extra add-on that they can sell. And companies like Intuit, which is a large holding of ours, and we don't take big positions, that people are not going to get ChatGPT to recreate an accounting system when you're paying $50 a user.
Okay, let's find some individual stocks and names.
Yeah, I was going to ask you. I mean, obviously, some of the names you've mentioned very familiar to people. Which is the bit of your portfolio you're most excited about that may not be on people's radar, that may not be something that people have come across, that you think, oh, we're onto something here?
Well, I mean, a company that reported yesterday is Ping An, and that's actually a top 10 holding of ours at the moment. And you wouldn't have seen it in last month's fact sheet because we have been buying, and it's deeply out of favor. Now, this is one of the largest insurers in the world, but you can buy it on a 6% dividend yield. It's trading below book value in Hong Kong, And most of the companies, most of the other insurers elsewhere in the world are trading at premiums book value and are not yielding those kind of rates. And so, yeah, so something like that, where you've still got a growing market, we think is very attractive.
I mean, there's all the excitement when you get a new IPO. We had Unitree this week, surged, what was it, 450-something%? Do you go in for those, or do you sort of wait till the dust settles and then see if it's reached a value that you think makes sense?
Yeah, no, we don't, Ben. We don't, because there's too much of a spotlight on that. You know, that's where the excitement is. We don't play in the excitement game. We prefer spin-offs, because when companies are spun off, you know, typically they're not well covered by investment banks, because there's no corporate activity to be involved. People end up with a small percentage in the portfolio of the spin-off, and so just dismiss it or sell it just to get rid of it. And that's where you can get some good value.
Yeah, yeah. Sean, it's probably saved me a lot of money that I'm not allowed to buy individual stocks.
Yeah.
Apart from one, well, actually two now. One of those that I'm allowed to own is Comcast.
Yes.
It's not been the easiest own over the last 5 years, as the board on the screen showed. I hasten to add, the reason why I'm allowed to own it is because I have a very minimal amount of stock from my tenureship here at CNBC, and Comcast, our former owner as well. Why is Comcast your second largest holding?
Well, Comcast it's in our portfolio. It's not currently our second largest holding.
I've got a 2.3% weighting.
Yeah, no, it's definitely there. And we like Comcast because if you think about the business, okay, it's not in favor, but it's got annuity income. You've got a huge client base. You're not going to wake up tomorrow and find that they've lost a customer and 50% of their revenue is disappearing. Very savvy management. You look at how the deal that they did with NBC way back when. So great cash flow. So yeah, we think, and very out of favor.
Yes.
And so maybe that's a ski jacket in summer.
Yes, I noticed it's very out of favour. But as you say, it has rallied a little bit off its lows on the right-hand side of the screen as well. Diageo is one that funny enough, we've got a viewer who always says to me, why aren't you talking about Dave Lewis? Why aren't you talking about Diageo as well? And yet it has had a bit of a rally off its lows since Dave Lewis joined, but it's still under a lot of pressure, isn't it?
Yes, and so we didn't own it at the highs. And we were buying it down when it was deeply out of favour. And of course, the one-liner is that people are drinking less, and you've got GLP-1s and all the rest.
I should remind viewers it's the owner of Guinness as well, and a whole host of premium spirits.
That's right. And Guinness is a growing brand. Guinness Zero, extremely popular. That is a less crowded space than lagers. You've got a new Dave Lewis, very experienced, cost-cutting. They've got lots of brands, and they've done some decent deals recently, selling their East African breweries, selling the cricket team in India. You know, that all helps, and we think that those kind of transactions make sense. So that's how we evaluate management: is what kind of deals are they doing? Do they make sense? And we think so. We think it's in good hands.
Right.
Where's the defensive element within your portfolio?
Well, I mean, the defensive element, Ben, is buying stocks that are out of favour. So this week has actually been quite good for us, because if you look at some of these software stocks, they've been going up when everything else has been falling. And so we have consumer staples as quite a big percentage of our portfolio. We have very little in information technology. So we have nothing in these semiconductor stocks. So when those sectors were running hard this year, we struggled a bit.
Do you have any sort of worries about what we've seen with the yields climbing, that actually that may pull capital away from equities, and we could see markets start to feel the brunt of that?
Yeah, we're not macro guys, but I think that's a big issue. I really do. And when you see that, is it Alphabet who was looking at raising some money in Australia at 7%.
Australia dollar.
You know, that is, and now we've got last night, Broadcom announced they're raising 60 billion of debt. And you've got Anthropic, they're coming to the market. So that's all sucking money out of the market. It's competition for equities. And when you can get, 5%, 7% from Alphabet, you've got to be pretty convinced about the companies.
We have talked a lot on this show and this channel about Nike and a lot about Adidas as well. We haven't spent so much time looking at Anta Sports. And I think it is a really fascinating company, because it's traditionally a Chinese branded sportswear manufacturer, but it's also got its fingers in a few pies of very well-known brands. I think Arc'teryx was one of the latest that it's got to deal with as well. It's a hard space to have dominance in nowadays, the way that Adidas and Nike used to have as well. Why do you like Anta Sports?
Yeah, Steve, great questions, because not many people know about Anta. And as you rightly said, they have 40% in a company in America called Amer Sports. And Amer owns brands like Arc'teryx, Salomon, Atomic, Wilson. They released results the other day, and I think I'm right in saying revenue was up some 30%. They were extremely strong results. Now that values $8 billion in Anta's $26 billion. Now Anta's $26 billion it's got net cash, and it's got the stake in Amer, and actually another interesting point: the founder of Anta Sports owns just over 40%. Okay, his take-home pay, if you have a look, is $250,000.
Wow.
Okay,
wow.
So that management team is, we think, on our side. Whereas if you compare that to some of the CEO salaries, at Nike, I mean, I think we're talking over $30 million. You've got a management team who, on our side, who've got fast-growing brands, are in a strong financial position with net cash, and at a fraction of the price.
Yeah, and the other thing is, not only have they got the exposure to those brands via Amer Sports as well, is that I'm hearing in running communities that actually some of the Chinese branded running shoes are actually really good. And it kind of reminds me a little bit of what we're seeing in the auto sector, where traditionally we have all these very, very expensive marks, European, the US names, the Japanese names, but actually now people are saying, well, actually, with the Chinese cars, you don't necessarily need to have these famous historic marks in order to have a good product. And I'm wondering if in sportswear, Anta is the kind of company that actually will benefit on that trend as well.
I think you're absolutely right. And if you read their annual report, they're using AI in design and in distribution and advertising. So they're very much at the forefront. And what they've done historically is taken out of favor brands. They bought that stake in Puma, and then revamp it, put it through their model, generate high return on assets, but no one thinks about it.
Well, Sean, when it comes to the movements in equities at the moment, how much of a concern is the momentum trade there and the sentiment-driven trade when people are perhaps paying less attention to the fundamentals?
I think that's a real factor. You have these short-term day trading shops effectively. Okay, whereas if we worked at some of these pod shops, let's say, and our little portfolio is down 3%, we lose our jobs. So what do we want to own? We only want to own what is working right now. And when you've got that together with the passive flows focused on momentum, that creates great opportunities for guys like us who are doing something completely different.
Okay, Sean, thank you so much.
We probably should say that every stock we've mentioned here, you own in your portfolio, don't you, as well?
Yeah.
Just for disclosures, yeah.
Not except Nike.
Except Nike, of course, yeah, that was on a different foot. Brilliant. Thank you.
Sean, thank you very much. Sean Pesh, Portfolio Manager at Ranmore Fund Management. Stick around, still to come on the show, US Treasury Secretary Scott Bessent vows the toughest sanctions in history against Iran as Washington ramps up its economic campaign.
You can master your strategy, but performance could be limited by your instrument. Precision trading starts with the right instrument. Over the past 3 years, Interactive Brokers clients outperformed the S&P 500 on average. Like returns, trading costs compound. Interactive Brokers is built to lower costs through smarter execution. Access stocks, options, prediction markets, and more across 170+ global markets. The best informed investors choose Interactive Brokers.
Closing Bell, weekdays streaming on CNBC+.
I personally risked everything to make Hyrox happen for me. For whatever reason, I went all in, literally, and I didn't have a plan B.
Moritz Forsta had already reached the top of his sport. Olympic gold in Beijing, Olympic gold again in London, then bronze in Rio. But after he left field hockey, he was searching for something most athletes never get back, a second arena. The idea became Hyrox, a standardized indoor fitness race built for the millions of people who train in gyms but did not have a sport of their own.
In 2026, we currently sold 1 million tickets, and with roughly another 500, 600,000 to be sold till the end of the year. And we're operating 34 countries.
The format is simple and unforgiving. The same race, the same order, anywhere in the world.
If we would change the format, it would just not be Hyrox anymore.
US Treasury Secretary Scott Bessent has promised to, quote, collapse the Iranian regime, warning American allies, you're either with us or against us. Speaking to CNBC, Bessent also weighed in on the prospect of further military activity in Iran.
If we are doing the maximum economic pressure, then that means that likely there will not be a large-scale kinetic restart. But I would emphasize that is for now. And look, we do have control of the strait.
Bessent also vowed the toughest sanctions in history on Tehran.
We have a combination. It is a 1-2 punch. We have the blockade, and we are going to have the toughest sanctions in history. And I will tell you, this will work. It worked in Venezuela once we put up the blockade. It is working in Cuba right now, and it is going to work in Iran, and we are going to collapse this regime.
How can Alibaba shares be both up and down at the same time? Let me explain. They were trading lower in Hong Kong after the Chinese e-commerce giant posted a 75% drop in quarterly profit, mainly due to a ramp up in AI spending. US shares, nevertheless, closing the Thursday session in the green. Look at that. Emily filed this report.
An earnings slump for Alibaba in the June quarter, with profits down 75% as it ramps up AI capital expenditure to preserve its lead in the AI sector. The tech giant is making investments to build out compute capacity, with capex surging 75% to $10 billion in the June quarter, which reflects fluctuations in procurement cycles, increase in CPU capacity, and higher pricing of chip components. CEO Eddie Wu says as they ramp their own proprietary chips, which will replace commercially procured chips in the data centers, this will result in higher gross margins and profitability. Alibaba also made a strategic alignment of its reporting segments in the quarter to better integrate its commerce and AI businesses. E-commerce now combines domestic and international operations, and their grocery chain Fresh Hippo. Revenue there up 4% to $30 billion. AI Cloud and Compute Services covers the cloud business and its T-Head chip unit, which is a portfolio of proprietary silicon spanning GPU, CPU, storage, and networking chips. Revenue jumped 45% to more than $7 billion. Its Genwu chips have achieved broad commercial adoption and have over 650 external customers spanning 20 industries, including autonomous driving, internet, and financial services. AI Labs and Applications cover AI Model Labs and Qwen Consumer Business Group, with revenue at $462 million. Its Qwen 3.8 Max, which was recently rolled out and is now one of the world's largest open source models. Alibaba's open weight models have accumulated more than 3 billion global downloads in the last 6 months, eclipsing Meta and Alphabet and even domestic peers to become the world's #1 AI model. Alibaba shares down as much as 3% in Hong Kong trade. I'm Emily Tan. It's back to you.
NVIDIA is reportedly in early talks with Korean AI chip firm Rebellions over the possibility of a collaboration between the two, or even an investment or acquisition of the company. It's according to Bloomberg, speaking to people familiar with the situation, adding that the head of Rebellions met Jensen Huang at NVIDIA's headquarters this week. In early June, CEO Sung-hyun Park told CNBC the company was targeting an IPO in South Korea in the first or second quarter of next year. Still to come on the show, the Premier League kicks off after another summer of record transfer spending so far amid high valuations for clubs. We'll discuss the financial power of football's most popular league. And we'll look into the growth of crypto sponsors in football as the sector tries to gain credibility. We'll have more from the latest episode of The Score after the break.
My ambition is to get the story and to help the viewer connect the dots, to understand the context so that we, all of us, can actually make our own judgments. Oh, I love what I do. I can't imagine doing anything else.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC+.
Edge just opened up in Europe with a French government cooperation agreement as well. How significant is that deal for Edge and for Abu Dhabi?
Europe is where the next budgets are. We would like to contribute to the security of Europe. We feel that we have a value. We feel that Europe have recognized this value by accepting us into Europe. These are facts. We have a very nice footprint in Europe, and this would have not been possible if the UAE wasn't accepted in Europe as a partner, knowing and trustworthy with NATO and the way we firewall things. Plus, you need another player in Europe. Even the big players today, we're working with them. There is always these collaborations, but they only start when you put your ego aside. There is always someone better than you. And you need to be on this learning curve forever.
A very warm welcome to Scorebox Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. The Bessent buyback failing to tame the bond market. Treasury yields rebounding, largely wiping out Wednesday's intervention relief. The US Treasury Secretary telling CNBC he's prepared to boost the operation beyond $4 billion.
We routinely do buybacks, and we're going to increase the size of the buyback. And, Sarah, I would note that it could be more than the $4 billion per issue.
Wall Street looks to close the week on a high note, rebounding from Thursday's pullback as jitters in the bond market seeped into equities. The US majors still on track for a down week. Plus, short sellers getting badly squeezed. And every time we've looked at this, it's gone up by another 1,000. Look at that, 77,000, up 6% in the session. Week to date, Bitcoin is up 22%. Coinbase CEO Brian Armstrong tells CNBC we may be on the cusp of the next bull market.
We've been in a bear market on spot crypto trading for the last year or so. And if you look at the prior bear markets, they each lasted about, 370, 380 days. We're basically coming right up against that, where people, they're going to say, well, this one's about over. It's time for the next bull run in crypto.
Well, quite a fascinating set of headlines. I mean, Brian Armstrong, they're talking about we may be on the cusp. We are in a bull market. If it's up 22%, that's a bull market on the cryptos. And we've got a great guest we're going to talk to about this in a few moments' time as well. Look, the bigger picture story is the fact that the bond market is failing at the moment to respond to what Treasury Secretary Scott Bessent had to say. But I think the point I really want to make as well is that this isn't a new underlying story. The attention that the market is giving it is new. The attention that we're seeing with multi-year highs on the yields on not just treasuries but elsewhere is newish. But the story has been the slowest burn of slow burn stories for a very, very long time. We've had large deficits, not just in the States. This isn't picking on the US bond market for a very, very long time. We've had large debt to GDPs growing for a very, very long time. So there is nothing new about the underlying story. The attention the market is giving it is new.
Yeah, you made the point yesterday, the sums involved, 2 billion to 4 billion per operation of purchase. It's trifling in the grand scheme of things in the context of the overall amounts involved, and maybe that's what the markets are reacting to. Hence, Scott Bessent then saying that actually they could go beyond that 4 billion figure when it comes to the buybacks. And I think the message that's been coming through from our guests is the way to solve it is to deal with the fundamentals. What would ease those inflation concerns? Maybe an end to the conflict with Iran, an easing of the oil price, those fundamentals trimming the deficit. That's what would solve it more robustly in the long term.
Meantime, data is non-committal in many ways. In fact, if anything, some of the data we're seeing today in terms of European PMIs is quite encouraging. 3-month highs for the Eurozone flash PMIs, beating expectations. Now, the United Kingdom has just dropped as well, so let's go through it. The composite flash PMI in the UK also bucking expectations, so moving to the upside, 52.5 versus a forecast of 51.6. Even the service sector in the UK, as the copy says, perking up in August, showing some form of resilience. The S&P Global economist Chris Williamson says the expansion is being helped by sunny weather and tech investment, though, as expected, we have seen some softening in growth in the manufacturing sector as a precautionary stock-building clause. Let us move on and take a look at the markets.
They're also perking up. Look at this. I've got a board of green for you at 9:30 London time, an hour and a half into the trading session. The market's responding fairly positively, despite the pressure that we've seen on sovereign debt. And the oil price had ticked higher, which was weighing on equities in the Thursday session. It has eased slightly today, but it's still Brent crude holding above $93 a barrel, not seeming to cause much distress for equity investors. Look at that. All of the markets up between a fifth and 2/3 of 1% there, with which one's leading the way? It's the Italian market that's advancing most strongly this morning. Let's have a look at which sectors are performing best. Basic resources. We've got a whole clutch of mining companies jumping to the top of the stock 600. Big names, Antofagasta, Anglo American, Glencore, leading that basket of stocks higher as well. Banks advancing strongly, almost 1% up. Construction gaining ground this morning, and car makers and parts as well, 0.8% up. In terms of the biggest drag on the pan-European index, these are the ones where we're seeing the sharpest falls. Healthcare stocks off 0.9%. Media stocks giving up 0.4%. And to underline the strength of the session as things currently stand, even on the board of underperformers, we've only got two that are actually below the flat line. Oil and gas. Although it's underperforming, it's above the flat line. And similarly with travel and leisure. Let's see if that positive sentiment generally across equities can be sustained in a week in which all of the key European benchmarks are currently pacing to end the week lower than where they started. What's being expected on Wall Street? Well, a bit of a rebound from yesterday's falls. Again, the US markets on course to end the week lower, but pairing some of those losses if the futures are borne out once trading gets underway. We saw equities all closing lower on the three benchmarks yesterday on Wall Street. Walmart's update creating a bit of concern, and Moderna shares falling yesterday about 24%, of course, in the context of the previous day's 170% rally. We're approaching the US market open several hours now. We'll keep tracking the futures and any significant shifts there for you.
Very nice. Right, let's take a look at crypto and specifically where Bitcoin is currently trading. There you go. Bitcoin is up 6.5% in session. Incredible volatility. In fact, this week, really interesting, and I'll give you a quote from Brian Armstrong in a few moments' time. He's talking about potentially a bull market. That to me looks like a bull market. 20% plus, ticks the box. But the CEO of Coinbase, Brian Armstrong, told CNBC Bitcoin is on the cusp of the next bull market.
We've been in a bear market on spot crypto trading for the last year or so. And if you look at the prior bear markets, they each lasted about, 370, 380 days. We're basically coming right up against that, where people, they're going to say, well, this one's about over, and it's time for the next bull run in crypto. They're also looking at this September 15th vote for the Clarity Act. And then traditionally, following the Bitcoin halving cycles like October, November, December, these tend to be good months for Bitcoin.
Let's get a view on this. Delighted to welcome back to the show Lucy Gazmamarian, who is the founder and managing partner at Token Bay Capital. Lucy, lovely to see you. Here's the simplest of questions. Why has Bitcoin and the rest of the cryptos gone crazy this week to the upside?
I think it's a little bit, if you recall back in October 2025, the market was expecting that final pump before the bear market started. And so there were a lot of leverage longs that then got spectacularly wiped out. And now we're sort of seeing the flip side of that. We're coming into the end of the bear market. We're expecting one final flush and for it to drop sort of another 20% so that it's in keeping with prior cycles. So the market was heavily leveraged short and they've been wiped out. So I think it's the market expectation. They're very savvy to the cycles now of Bitcoin and they position accordingly sort of in those final months before the cycle turns from bull to bear and vice versa.
If it is about leverage shorts being squeezed, it's less than about the fundamentals, because other people have been saying to me, it's about the Clarity Act, it's about the concern about fiat currencies and about the lack of quality in sovereign bond markets. That's why Bitcoin is having its day. Is it a bit of those other factors as well?
I think it is. I think there's sort of the shorter term catalysts and the shorter term sort of reflexivity in the crypto market versus the longer term thesis. So if you're an investor, if you're buying Bitcoin at any point, you should really be holding the longer term thesis, you know, that it's a play against monetary debasement, currency instability, a new form of digital gold. But in the shorter term, it's very much moving along these cycles because it's still a very volatile asset. So it's, you know, it's a great playground for traders, and now we have so many tools to sort of place bets either way on this Bitcoin now. So it can be very volatile in the short term. So I think both can be true.
Lucy, it's probably an unfair question, but I'm going to ask it anyway because I'm curious as to what your answer will be. Given the rally we've seen in Bitcoin, how much further do you think it could go?
These explosive moves. I think, well, the question is whether there's going to sort of be a very vicious reversal to the downside and it's going to catch everyone unawares, for the reasons being that everyone's saying we've got positive momentum on the regulatory front. You know, the US has embraced it. It's also part of a broader tokenization story, a new financial markets infrastructure story. So Bitcoin sits at the center of that alongside ETH and stablecoins and other such assets. So there is a chance for a nasty reversal. But if you're a believer that we are at some point going to move into the bull market, then you know, you've got to question whether you can stomach that volatility. The other thing that I'll say is, in anticipation of the change, the switch from the bear to the bull market, a lot of investors have been sort of dollar cost averaging into the market, sort of starting to do this, thinking about it in the summer with a view to October, you know, the market to be really turning. So maybe there's an acceleration of dollar cost averaging, maybe it's going to shorten the cycle. You know, we'll have to wait to see if it really sustains above the 70K level and consolidates above that level. There's a good chance that the lows were in the end of June at 58K.
This is maybe something that's a bit further off on the horizon, but with the advances in AI capability and quantum computing, how concerned is the crypto sector that there's a potential for these very powerful computing models to potentially crack the code that underpins the value of these cryptocurrencies and actually destabilize the whole thing? How much of a concern is that?
I think the bigger threats to crypto, the threats that we don't know about, and quantum's been on the map and sort of understood to be a threat for many years. And the great thing about crypto is that you can come up with a plan to be quantum resistant cryptography. So there are solutions there, and the timeline for implementation can be accelerated by developers. So there is a path to solving this. And I think that is the view that has really sort of now been accepted by the crypto industry is that while this is an extreme threat, the crypto industry is able to handle it. And actually, if you extend quantum into not just crypto, but into, any online systems, cloud, etc., it's something in terms of the biggest cybersecurity theme that everyone needs to figure out. Particularly now, the quantum threat is being turbocharged with AI and all these AI agents that are sort of let loose on blockchains and the internet. It's really increased the timeline that we need to figure this out. But I think the good news is we can figure this out.
Lucy, I think it's fair to say you're probably very well plugged into the crypto world and those within it. I just wonder, we're about to talk to our sports correspondent, Tom, about whether the removal of prediction market platform brands from football shirts could leave those spaces open for crypto companies to perhaps step in. Do you get the sense that's something that crypto and crypto adjacent companies would be interested in at all?
Yes, I mean, I think to a large degree, sort of Polymarket and Kalshi, the likes of the sort of two biggest prediction markets out there, sort of fall into the crypto sector anyway at this point. So absolutely, I mean, we're seeing a merging of crypto technology and traditional finance technology, and now prediction markets is a whole new arena. So it's really all blending. I think crypto is becoming the new fintech and the new technology that's really providing that value layer on top of the internet that's being utilized by AI and AI agents. And it's all coming together for a variety of use cases, not just limited to traditional finance, but also to prediction markets and many other use cases that we'll start to see pop up.
Final question for me, Lucy. I've asked you every time we've ever spoken, is do we need all these crypto coins? I thought last time I asked you it was about 12,000. According to what I'm looking at here, it says there's a CoinGecko list. There are 18,000 actively monitored coins. There can't be much liquidity in 17,500 of those, can there?
No, and those are only the ones that are listed on CoinGecko. I think the official figure of tokens that have been generated is sort of in the tens of millions. So, obviously the reason for all of that was the meme coin mania, which surprisingly, even though everyone gets wrecked in crypto, still seems to rear its head every cycle. So they just seem to be a feature of the crypto space. And, at the end of the day, anybody can launch a token. You or I can launch a token tomorrow. And so that trajectory of the number of tokens out there is going to continue. But the market is now savvy to all of these sort of rubbish coins. And I think it just puts the spotlight even firmer on the higher quality names. It actually makes it easier because you just need to look at the tokens that are actually doing something fundamental in the space and, have a credible business model behind it and credible teams behind it. And with the onset of US regulations really coming into play, with or without the Clarity Act, by the way, on the 15th of September, both the CFTC and the SEC have said we're going to implement rules and give builders guidelines regardless. Again, that's going to make it much easier for these credible crypto tokens with associated business to really take hold in financial markets.
All right, I'll do that over the weekend. I'll set up my Sedge coin. Lucy, lovely. Thank you very much indeed. Not sure there's much demand or liquidity in that one. Although there might be quite a very big short position on that one. Lucy, lovely to see you. Thank you for your time. Lucy Gazmararian, who is the founder and managing partner at Token Bay Capital. And it says Bitcoin this week. I think are we looking at that again or are we not bothering? No. Okay. Bulos coin.
Couldn't compete with Cedric coin, I don't think. Let's see.
I don't know.
Anyway, let's talk about the Premier League. New season kicks off today as newly promoted Coventry face last season's champions, Arsenal, in the opening game. The opening weekend will see a record of 9 clubs with managers taking charge of their first league games, highlighting the cutthroat nature of the division. This season, however, has seen a fundamental rule change in the Premier League. It won't necessarily affect the action on the pitch, though. For the first time, Premier League clubs have collectively agreed to remove gambling companies from the front of matchday shirts, a crucial revenue stream for the clubs. But could the ban offer an opportunity for a new industry to take over a key form of income for the clubs? Tom Chitty has looked into the rise of cryptocurrency sponsorship in the world's most popular football league.
Football clubs are always looking for new revenue streams. During the 2010s, they began securing hyper-specific brand partnership deals for everything from noodles and deodorant to even tractors. So, when crypto companies came looking for partners, clubs were ready to listen. And in 2020, one of football's biggest traditional sponsorship categories was also starting to come under pressure: gambling and betting.
From the commencement of the 2026-2027 season, Premier League clubs are not allowed to have front-of-shirt deals with gambling companies. That vacuum has to be filled somewhere.
During the 2025-26 Premier League season, 8 clubs still had gambling companies on the front of their shirts, worth an estimated £60 million a year.
Cryptocurrencies will be licking their lips to an extent because they know that there is that revenue gap because of the regulation of gambling.
Within a few years, clubs were signing multi-million-dollar deals across the crypto industry, from blockchain platforms to major exchanges. And the data backs that up. Between 2021 and 2024, football was the biggest global category for new sponsorship deals, ahead of other major sports year after year. The more popular you are, the more people want a piece of you. During the crypto boom, football became one of the industry's biggest prizes. Crypto had bought its way into football. Clubs got new money. Crypto companies got visibility, trust, and access to millions of fans. But as the boom began to fade, that bargain started to look a lot more complicated.
Well, Tom joins us now. Tom, so really interesting this move by the clubs, taking the gambling companies off the shirts. But I suppose if it's prediction markets, crypto companies, there's still potential there for a bit of a backlash from some quarters.
100%. I think there's significant concern about, and I mentioned previously about the FCA writing a letter to all these football clubs, particularly to the Premier League, saying that they had concerns around how teams were getting or partnering with crypto firms that weren't even regulated, and selling products that maybe they shouldn't be, or the education wasn't there amongst the fans about what they were maybe getting involved in. One thing that was interesting in your previous guest talking about tokens is fan tokens have been the best example of this. So back in 2020, a lot of
fan token?
Well, it's essentially a cryptocurrency, but what the clubs did, what they realised, it was when kind of meme tokens were all coming out, and football clubs were contacted by all these crypto companies saying, why don't you do a fan token? And what we'll do is the fans will buy the token, and we'll take a little bit of percentage fee off every sale of the token, as will the club. So we'll all make money, and if the price goes up, great. If it goes down, none of the crypto company won't lose money. But obviously the fans did. So at one point, so initially these fan tokens were selling, they went onto the market about $2. They then skyrocketed to about $60 in the space of weeks. And currently most football fan tokens are trading at around 0.25 cents. and it's across the board, and it's an absolute shocker.
Why is it a shocker?
Because all these fans are just, they were selling them as like, oh, you'll get exclusive access, you'll get VIP events, you'll get, and those things were oversold really, and they didn't know that what they were investing.
Emptor. Did you not? You did Latin at school, so did I. You went to the same kind of school I did. Caveat emptor, buyer beware. Come on.
Yes, but I don't think there were the knowledge, even from the football clubs, as to what they were really selling or promoting.
Yeah, but it reminds me of NFTs. I mean,
Yeah.
Same old, same old.
Yeah.
You want to do this other story?
Maradona.
Yeah.
Hand of
You
God.
wanted to do it for 2 hours.
Yeah, I know.
But it's because he's a professional at Maradona economics now. So
I know.
And he knows all about
Maradona
it.
week.
Right.
There you go.
So what happened then? This ball sold
so
for a lot of money.
from the controversial Hand of God
You
goal.
mean where Argentina cheated?
In the interest of impartiality, we'll say it was a controversial goal.
No, I mean,
You can't.
no. I mean,
it's
he did
soccer.
have.
Apart from the goalkeeper, you can't use
soccer.
your hand.
Yeah. True.
It's not controversial. Even he admitted, because he called it his hand of God.
Well, yeah.
Part head, part hand of God.
Which is sad, because he also scored one of the best goals of all time in the same game.
Yes,
but you know what? Interestingly, it's the same ball that he scored that goal as well as the hand of God goal.
Yeah.
So I thought it should go for double the price, personally. But
for all the audience who have no idea what we're talking about, as usual, this is the hand of God ball expected to fetch X at US auction.
About $10 million it's expected.
It is the 1986 World Cup match, England versus Argentina. There was one cheated goal and then there was one brilliant goal. Yeah?
Yeah.
Well, my words. It's
it's
not controversial.
I just feel like the market's probably not going to be in England for this one.
Yes. Something tells me it won't. I mean,
would you? I don't think I would want that hanging around.
I don't buy
my
much
living
sports
room.
memorabilia, to be honest.
Actually, do you know what would be great is if it was bought in the UK by, let's say, Banksy, who then installed it at Wembley Stadium as a trolling gesture. That would be fantastic.
Well,
we
it's
can burn
expected
an
to fetch
effigy
around
of the
$10
ball
million
or something like that.
Yeah. And your show, The Score, is on CNBC.com.
Yeah.
And you can catch the full episode after you've seen the latest episode of Executive Decisions.
I knew you
It doesn't matter, you make money on both. You're the executive producer of the former and the reporter on the other.
Just make time for both. Make time for both.
Coming up on the show, bond yields paring back but still dominate investor attention. Thanks, Tom. As Scott Bessent says, he's ready to step up support.
From London, Paris, Munich, and Milan.
We've seen very strong demand all summer long.
End users are using our AI even more frequently.
Are you heading into a record Q4? We are gearing up for the biggest IPO of the year.
Prime Minister, it's a pleasure to be back in Athens.
It's a pleasure to talk to you.
This is becoming a very competitive market in the EV space.
Parliament continues to stay very fragmented.
This Bank of England decision certainly got more interesting over the last couple of months. Here's what investors are watching this morning.
American soccer legend Landon Donovan. He'll explain how the 2026 World Cup could shape the future of Major League Soccer and the inner demons that drove him to greatness.
I was constantly chasing this insatiable desire to be noticed.
He's the man behind Apple's sports ambitions. In an exclusive interview, we talk about the tech giant's unique sports strategy and whether a blockbuster acquisition is on the horizon. This is CNBC Sport on the Record.
The day's top stories driving Wall Street. Up-to-the-minute developments. Kelly Evans, Brian Sullivan, Power Lunch, streaming on CNBC+.
To me, ambition is drive. It's the fire in your belly. I didn't go to college right out of high school. I worked full-time while doing school full-time. Somewhere along the way, I got bitten by the journalism bug. No one's going to give you your dreams. You have to roll up your sleeves and work hard to achieve them. Money doesn't make the world go round. Information does. And CNBC is the great economic equalizer because we provide that information so you can make the decisions that are right for you. CNBC is an adventure beyond my wildest dreams.
Some slight relief for Treasury yields this morning. This is after they'd rebounded Thursday, triggered by an announcement from the US Treasury Department that it will at least double the size of its government debt buyback starting from the 9th of September. The 10-year yield rose back above the level it was at prior to the intervention amid persistent concerns over America's debt pile, which topped $40 trillion this week. However, the 30-year yield, which was the main focus of the Treasury's accelerated buyback, is still rising very modestly this morning. We can have a look at a picture on global bond yields, and you can see for the most part some of that pressure is easing, with the exception of the Japanese 10-year yield, which is still climbing. Speaking to CNBC, Treasury Secretary Scott Bessent expressed his frustration with current trading levels in the bond market.
We believe that the yields don't reflect the underlying fundamentals. This Iran conflict, we will get on the other side of this. We don't know when, and we can talk about the economic measures we're going to be taking against Iran in a minute. We believe that the liquidity, especially in the 30-year point, is very poor.
I mean, there's no doubt about it. Everybody hopes that the Treasury Secretary is correct, that we get on the other side of the Iran conflict sooner rather than later, and that we see a resumption of peace in that region. The same goes, of course, for the Russia-Ukraine war. But with respect to the Treasury Secretary, I don't believe that's the only reason why Treasury yields are trading at the levels they are. And by the way, it's not just Treasuries, it is bonds around the globe are very concerned about deficit levels, about net debt issuance levels as well. And despite the fact that the Treasury Secretary is talking about 4 billion, maybe more, of buyback in the long end, the fact remains that that is a small amount compared to the net $97 billion of long bond issuance that is probably going to be enacted by the Treasury, their data, in this current quarter. So I hope he's right. And look, nobody wants to see the Iran conflict going on any longer than it has, and the inflation impacts it. But it's not just about the inflation impact, and it's not just about the lack of liquidity in the long end. It is very much about the fact that deficits by both types of administration, Democrat and Republican, have been too high for too long, and the debt to GDP and the net debt issuance keeps going up.
Yeah, I mean, there are some things that are within the administration's power to deal with, and the most obvious one is the deficit. And I don't think the bond markets are impatient. They wouldn't expect to see it dealt with immediately, but even just a credible plan for reducing the deficit would perhaps be enough to calm bond investors. The other big factor is trying to bring an end to the conflict with Iran, which has stoked those fears of inflation because of the higher oil price. I think if that came to an end and the oil prices eased, we could see that ease the pressure on
and has potentially tied the hand of Kevin Walsh in the Federal Reserve. We will continue to pontificate on all these issues throughout the trading week next week, but in the meantime, after your working day, have a lovely and restful weekend, and Ben and I will see you on Monday. See you soon.
One hour of added insight every morning doesn't just add up, it compounds. One extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC.
Ambition doesn't always look like you think it might look. I've just always been super fascinated by what's happening in financial markets and what is that telling us about where the world is going. That's what drives me. I love being part of this.
One of the world's largest private climate investment vehicles, Altera, aims to mobilize $250 billion by 2030.
What we're trying to show is that we can align those objectives and we can make money doing it.
Clean energy, emerging markets, even the AI boom. The opportunities are vast, but how do you pick the right investments?
We have people who specialize in these investments, and that's what makes Altera unique. That's our secret sauce.
Find out more on the next Managing Middle East.
Listen to CNBC on the move with the CNBC app.
A lot of strong numbers this morning. Breaking news.
We got a big IPO, something for the private markets. Could it be a rate cut scenario?
Real-time market updates.
A check now on how Europe is set to open the trading day ahead.
Your favorite programs live 24 hours a day.
Welcome to Squawk Box Europe.
Welcome to the China Connection, Squawk Box Asia.
Listen wherever in the world you are. Download the CNBC app now.
Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC.
I built a legacy on the court, and now it's the moment to build a legacy outside of the court. My main investments are in hospitality, in education and sports. So I believe that's the future. I see my brand as in a growing perspective and in some way building this new chapter.
You'd been managing a very rare condition in your foot for much of your career. At what point do you think you seriously started to think about life beyond tennis?
You need to have goals. I think it's very important in this life to have goals ahead of you, because that helps you to wake up every day with motivation and passion. I knew since a long time ago that I wanted to keep doing things and learning after my tennis career. I have two small kids, and that's the most important thing of my life, without a doubt. But I like to work. That's how I understand this life.
I'm Morgan Brennan, and this is your morning call. Good morning and a happy Friday. Let's get a start with a check on U.S. stock futures, with all three indices coming off their fourth negative session in the last five. I saw some pretty stark selling yesterday. We finished at lows of the session, and you can see we are bouncing back here this morning pre-market. All the major averages are poised for gains. S&P poised to open up 23 points, the Dow 208 points, the Nasdaq 168. Keep in mind, though, we are still on pace for losses for the week. The Dow on pace for its second negative week in a row. S&P, Nasdaq, and Russell 2000 are all on pace to break 3-week win streaks. The big factor in all of this, what we're seeing in the bond market. So Treasury yields on the rise again, shrugging off the Treasury Department's intervention this week. Treasury Secretary Bessent on CNBC yesterday was discussing that intervention, even using the word twist at one point.
We believe that the yields don't reflect the underlying fundamentals. This Iran conflict, we will get on the other side of this. We don't know when, and we can talk about the economic measures we're going to be taking against Iran in a minute. We believe that the liquidity, especially in the 30-year point, is very poor.
Well, as you can see just now on your screen, we see yields taking a bit of a breather here this morning. But in general, here's what we've seen play out in Treasury yields this week and how the market has received his messaging. Look at the moves in the 30-year yields this week, hitting a new 19-year high on Tuesday, 5.33%. Then coming off that a bit before the Treasury announcement, falling below that much more aggressively as bonds were bought into. Again, following that Treasury announcement on Wednesday, falling to a low of 5.18% on Wednesday, as you could see right there. And then we began to see a move higher, and we saw yields retrace their steps here, even as the Treasury Secretary was explaining the impetus for that intervention on CNBC yesterday. As I mentioned, you could see bit lower here this morning, 5.23% versus where we were in trading yesterday. We'll check on the 10-year as well. It was a very similar situation. We were above 4.7% on Tuesday, falling just below that ahead of the announcement. And then from there, yields moved lower before a reversal again yesterday and retracing steps post-intervention. You could see right now, though, as well, a bit lower here this morning, the 10-year Treasury yield. What's fared better? Gold. Up over 4% this week, on pace for its fifth positive week in a row. And as you can see right now, well, that's the Bitcoin chart. But if we were to show you the gold chart, you'd see that it was higher this morning as well. So let's take a look at Bitcoin. Bitcoin's up another almost 8% this morning. We're now at $78,300 and almost $59. And that is now on track for the best weekly gains in more than 2 years for Bitcoin. A huge short squeeze really triggered this week, given what we've seen in terms of the shift into some of these non-Treasury, non-stock assets. Let's get a check on energy as well. Treasury Secretary Bessent also telling CNBC yesterday that the U.S. will impose, quote, the toughest sanctions in history on Iran, suggesting details could come early next week. We hear there might be a meeting. He said this on CNBC yesterday. as soon as Monday. So if you look at oil right now, we're actually a bit lower here. WTI is down more than 1%, trading just below $86 a barrel. Brent is also down 1%, trading just below $93 a barrel. But keep in mind, we are on pace for 2 straight weeks of gains when it comes to crude oil. Let's see how Europe and Asia are closing out the trading week. JP Yong is in Singapore. Ben Boulos is in London. JP, let's kick this off with you.
Good morning to you, Morgan. And we'll start off with these bond markets because it seems that the impact of the Treasury's recent actions to keep bond yields lower or easing seems to have faded somewhat. And you can see this actually playing out in Japanese markets. In fact, we're seeing the Nikkei 225 today taking a step back, in part because of that slightly stronger yen. But we're also seeing core CPI for the month of July showing that core inflation in Japan is starting to tick up once again at 1.8%. But it is bolstering the case for a possible rate hike from the Bank of Japan in September, and that's putting pressure once again on these 10-year and 30-year yields up, alongside some of the pressure and the impact being felt from Treasury yields moving up in lockstep. Now, we want to take a look at the longer end of these yield curves here in Asia because of something interesting cited by the Korean Finance Minister, Koo Yoon-chol, earlier today. And we're seeing it also impact 10-year and 30-year yields out in South Korea. He did mention that increased fiscal borrowing and also uncertainties from the Middle East war, actually, the war that is in Iran, impacting energy prices, is keeping bond yields on the longer end of yield curves higher. And they will be closely monitoring this and try to keep borrowing costs in South Korea lower. Despite that, though, we saw the Kospi actually defy that rise in bond yields, mostly due to the recent share buybacks announced by the likes of Samsung and SK Hynix. Elsewhere in the region, we saw stocks mostly outperform the Australian markets, ASX 200 just taking a slight step back, and greater Chinese markets in Hong Kong and China actually outperforming. I do want to leave you guys with this. Take a look at the 10-year Panda bond yield out in mainland China, which is actually going the other way and actually continuing to stay rather subdued. In fact, this is due to the fact that we're seeing signs of economic growth slowing down and also price wars and involution keeping China deflationary, and thus also supporting the case made by some strategists we've spoken to that perhaps these panda bonds have room in someone's portfolio for diversification. And really, who doesn't love a panda, right? Morgan, it's back to you guys, and happy weekend in advance.
Thank you. You too. JP Yong, thank you. Let's see how Europe's shaping up. Ben Boulos is in London with the early trading there. Hi, Ben.
Hi there, no pandas here, but we have got some green on the board for the European markets, edging higher in early Friday trade. Looking to end the week on a positive note, the Pan-European Stock 600 looking to rebound after having posted its 7th straight negative session for the first time since 2023. France's CAC 40 also looking to recoup losses, with the index on an 8-day losing streak for the first time since 2017. The basic resources basket of stocks is the one powering gains, with mining companies among the top performers on the FTSE 100, helping to lift the broader London index. About to the same extent on the CAC 40. It's the German DAX, though, that is powering higher, and the Italian market, look at that, surging around 0.5%. We'll see if these gains are sustained throughout the session, because at the moment, all of the markets, perhaps with the exception of the London FTSE, are pacing to end the week lower than where they had began. Front of mind for investors, though, throughout the week has been the bond market. Eurozone bond yields easing slightly this morning, as you can see, after yesterday's rebound, as intervention by the US Treasury failed to ease those market jitters. The yield on Germany's 10-year bond is set for its second straight weekly climb. We're going to keep tracking these and monitoring these, as I'm sure, indeed, you will be doing with the US Treasuries, Morgan.
We sure will. Ben Boulos, have a wonderful weekend. Thank you. Let's dig further into the market action we have seen this week, whether it is in the U.S. or whether it is abroad, because there's some similar dynamics playing out, as you just heard Ben say. Let's bring in John Stoltzfus, Chief Investment Strategist at Oppenheimer Asset Management. John, it's great to have you back on the show. I mean, I got to start right there. Bond, is this a new 4-letter word, especially if you're an equity investor?
You know, I think it certainly is the new 4-letter word, and I think we've really got a normalization of interest rates taking place that shocks a lot of people who weren't born when we last had rates about this high. This is not uncommon. I mean, just think about it. As a bond investor, do you really want to lend somebody money for 30 years below 4.5%, 5%? Even at that, it's not a heck of a lot compared to what we've seen in terms of gains in equity markets, metals markets, and other markets. Generally speaking, past performance will be no guarantee of future results.
You just used a word I want to hone in on here, and that is normalization. Do you think we're trading where we should be, whether it's in the 30-year Treasury, whether it's in the 10-year? We'll just say the longer end of the curve. Are we seeing normalization there? Is this where we should be, given all the fundamentals that are factoring in?
I really have to think so, Morgan. You know, I've been in this business for 43 years. So when I came in to the business in 1983, about a year and a half before I'd gotten in, the 10-year yield on the Treasury almost hit 16%.
Wow.
And I can remember periods when rates were much higher than they are today, when stocks could still go up. I can remember very new in the business, 1984, 85, when clients were complaining because they could no longer easily find a 12% yield on junk debt or on mortgage-backed securities. And yet stocks were going up. They were offering competition. So go figure.
So in light of this, I mean, we've seen some big moves in gold that happened before this week, but it just continues. Obviously, Bitcoin is spiking here and seeing renewed interest. And then the dollar has softened as well. So in terms of just looking across asset classes, how do you want to position yourself, especially as we go into the rest of the year that is going to be injected with other elements of volatility here, including midterm elections?
Well, we've got to say we expect volatility. Volatility is very natural. You've got traders on a day-to-day basis going risk on, risk off, risk on, risk off, depending what kind of news crosses the tape, how they interpret it, what have you. But against that, you have very serious investing these days, and serious change in structure of the private investor who's really investing for longer, intermediate to longer term goals, 3, 5, 7, 10 years and beyond, to maintain their lifestyle in retirement. And that goes across many generations behind the boomers as well as the boomers. That creates an environment where you would get the volatility that some investors will just buy the dip. We suggest buying the babies that get thrown out with the bathwater, the better quality issues that get thrown out in downdrafts. It appeared to us that the market still has a lot longer to run, and its fundamentals, its outstanding innovation that is expensive, but as it gets cheaper to offer, we'll likely see even greater adaptation that we're already beginning to see both by business and consumers.
Okay. John Stoltzfus, appreciate it. Great to have you on to start the hour. I keep waiting for a summer slowdown, at least in terms of the news cycle. It just hasn't happened. All right, we got a lot more to come here on Morning Call, including much more on the Treasury Department's intervention into the bond market, what Secretary Bessent's endgame may be, how markets are interpreting all of this, what it means for your money, plus diesel margins hitting a new record. As the energy supply crunch continues, we've been talking about it all week, the diesel crack spread, the potential wide-reaching economic ramifications, how that could hit your wallet, especially as we look to inflation readings next week. And later, President Trump touting a new golden age for the American space industry, taking fresh steps to help lift off that sector, pun intended. We're back after this.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
The Exchange, streaming on CNBC+.
Don't miss the highlights of the PGA Tour. Catch the action from the PGA. The biggest hits and misses. Join us on the green, Saturday and Sunday afternoons, only on CNBC.
Fast Money is America's post-game show.
Basically, near all-time highs against the S&P.
Every single story that we pick is a tie back to the markets.
Those sort of revenue streams don't trade at a great multiple.
We want to arm people with the information to make great decisions.
Stock got whacked. I get it. People say they overpaid. I get that.
Fast Money is all about the chemistry. We've been successful for this long because we're a team.
Fast Money, CNBC, streaming on CNBC Plus.
As the Asia trading day begins, join me for Squawk Box Asia. What are you watching? Nobody would be thinking that level of a benchmark is possible. We're live across the region, covering what you need to know from here and around the world that would shape the business day.
We know there's two winners in AI. It's going to be China-US.
Let's stay away from these companies that are selling it at 40, 50 times sales.
Join me for Squawk Box Asia, only on CNBC.
We've talked about this all week. War and weather. The Iran war, ongoing droughts around the world, disrupting global shipping, causing freight prices to surge and further complicating the inflation picture. Pippa Stevens is here on set, and she has more for us. Pippa, break it down.
That's right, Morgan. So the trifecta of the Iran war, Russia's war with Ukraine, and drought in Europe and beyond is creating, as Argus's John Oled put it, the single greatest disruption that the shipping market has seen on record. So at the beginning of the year, it cost about $1.50 per barrel to move Arab light oil from the Gulf to Asia Pacific. That's according to Argus Media. It now costs more than $13 per barrel. Ooh. Now, that is below May's high, but as ships reroute and look elsewhere, that's raising global prices. Freight prices for the Red Sea have jumped 85% since the Houthis announced a ban on Saudi Arabian transits through Bab el-Mandab, while historic low water levels in the Rhine and Main rivers have pushed freight rates in Europe to record levels per Argus. And it's not just energy, but container shipping too. Spot rate charges for a container heading from the Far East to the U.S. East Coast is up 287%. That's according to Zenada, with the West Coast route up 271%. And as the war stretches into its 6-month, long-term rates are being renegotiated more than 40% higher. So this spillover is key, according to Zenada chief analyst Peter Sand, who said the war is, quote, becoming a deep-set and structural problem that will not go away anytime soon. And Morgan, that's the key here. It's no longer just the spot rates, but also the long-term contracts are being repriced higher.
Yeah, I mean, that's a key point that you make, too, because that had been one of the talking points earlier in this conflict with Iran, the fact that, you had a market that wasn't pricing in, future elevated levels here. I want to just dig in a little bit more with you, Pippa, on diesel and the crack spread we've seen, because we could talk about, and we certainly track it, we do, the price of crude. Crude's up 50% since the start of the year. But if you look at ultra-low sulfur diesel, which is what the diesel crack spread is tied to, it's up 100% this year. How does that speak to the refining piece of this and how much it actually is impacting more broadly the markets?
Yeah, so refining margins are now at a record high, the 3-2-1 crack as well. You look at some of the numbers, a barrel of diesel is now trading, north of $190 per barrel. And that's what we've really seen, is that you can have all of the oil in the world, but if you don't have the means by which to turn it into an end product, it's useless. And so that's really where the shortness is now concentrated on the refining side, because of course it's not just what's not coming out of the Gulf, but it's also now in Russia. We keep seeing these Ukrainian attacks on Russian refining infrastructure. More than 90% of Russia's refineries have now been hit since the start of the year. And so that's really where the tightness is. And then you look in the U.S., utilization rates above 97% in the latest week. We cannot sustain those levels forever, given that there has to be turnaround season, there has to be maintenance. And so that's where the problems right now are concentrated. I will say that if China were to further relax some of their export fuel bans, then maybe that would help the global picture somewhat. But it really is that Russian side, especially, that even if the Strait of Hormuz were to open tomorrow and all that refining capacity magically comes back online, the Russian situation is going to be here maybe longer term.
All right, Pippa Stevens, thank you.
Thanks, Morgan.
It's a great breakdown. Ahead of our next guest, John Kilda, founding partner at Again Capital, a CNBC contributor. And John, I mean, this is going to radiate out into a lot of parts of the global economy. It arguably already is. But let's just start right there with what we've seen with the diesel crack spread and what we've seen here with U.S. refining capacity in the midst of all that, the fact that you're going to have to see some maintenance happen at some point, could we actually see this spread continue to widen from here, or at some point do you hit a level of demand destruction?
I do think you'll hit a level of demand destruction, Morgan, and good to be with you this morning. No doubt. Not only just from the price, but also just from the availability. I mean, we should start to be seeing increased shortages out in Asia, especially as we move forward here. I can tell you, as somebody who's been in this business for, long time now, these crack spread levels are just something you never even would have dreamed about, or if you put them in a scenario out to company leaders or market participants, you would have been laughed out of the room. But to show you the extent of this, and as Pippa so rightly broke it down, I mean, we have two major problems, not just the Middle East refiners and not getting that refined product out through the Strait of Hormuz or any which way, but the situation in Russia is particularly bad. Russia used to be a major supplier of diesel fuel to the global market, even to the U.S. East Coast, and they have shut that all down because they are now facing shortages themselves in country, and they're also having to import themselves now refined products. So we're all competing with the Russians. The pricing here, though, since we're in uncharted territory, it gets bid up, only as much as we can. I think there's an expectation, or there's been throughout this war, that things could end tomorrow, as we've seen, particularly with President Trump's various statements about it. But now this thing is starting to set in big time, and we're going to have a demand spike here as we get into very late August, September, when they start to the farmers start to bring in the harvest. We always see a spike in diesel demand here in the U.S. then. So I would expect even more upward pressure on the retail diesel price as a result of that new factor that's coming at us.
Yeah, I mean, we're already seeing upwards of $7 a gallon for diesel in places like California right now. We're flirting with that in Hawaii too. Other parts of the country, upwards of $5. I do want to get into the broader economic impact of all this, but just one more question as we do look to the possibility of what I think President Trump has referred to as economic D-Day, where Iran is concerned, as soon as next Monday. If you see big, broader, wider-reaching sanctions on Iran, if that also impacts China, since China is Iran's largest trading partner, and there's some questions about that ahead of a Trump-Xi meeting, but if that were to happen, what does that do to this entire conversation around the global energy complex?
Well, interestingly, China's Iranian crude oil imports are down by about 2/3 at this point. The one thing that works on Iran is these economic sanctions that we've seen over the decades. When you squeeze them really, really hard, they tend to come to the negotiating table and cut a deal. So, that is what we need. But you need a uniform global group on that. Everyone has to have buy-in to a degree, although the U.S. started to implement secondary sanctions. So if you're a country that trades with Iran, you could get shut out here. That needs to be done. This thing needs to end. All these workarounds you're hearing about pipelines and oil going out through Turkey into the Med and through the Suez Canal, it's not going to do the trick. We need that Strait back open. That's where the volumes of scale occur and get delivered to the world. It's what lowers the prices of everything. That needs to happen immediately. And I do think, though, that since the bombing campaign seems to have limited success here, the economic sanctions will work on Iran, in my view.
Okay, and just to bring this all full circle, economic impacts as we look to PCE inflation reading next week. We're going to hear from Fed Chair Warsh next week. We know the Treasury Department is intervening in longer dated treasuries right now as well. Where do you see the impact of this? Because we can talk about gas prices, certainly in a week like this where we've had retail earnings, but diesel is much more prevalent and actually arguably hits the economy much more quickly and aggressively when you see levels like this.
It does. As I like to joke, you can do all the virtual shopping you want. It's all going to come to your house. They want a truck that ran on diesel fuel more than likely these days. So there's no way around it. This diesel price in particular feeds right into the producer part of the inflation readings, PPI and tomorrow's PC. The Fed is in a box here because they are going to be staring down an inflation pulse now from this renewed price spike higher. Keep in mind, diesel prices and crude oil prices did back down there for a few weeks, if not a month or so, and now they're right back up. The national average for diesel fuel knocking on the door of the all-time record. So the Fed is going to have a problem on its hands. It's not going to be able to cut. They might be able to stave off a hike, but this is going to shave about 0.5% at least off GDP, although GDP is quite strong these days, so maybe not so much of a worry. But this is definitely an inflation pulse coming through to the PPI. And then the CPI, as the shippers and the manufacturers roll these price hikes for shipping in particular out to the consumer for the goods that end up on the shelf or at your driveway.
All right, John Kilduff, great to have you on. Appreciate it. Have a wonderful weekend.
You too.
And our thanks to Pippa Stevens as well. Well, straight ahead, Walmart's latest earnings raising questions about the consumer. We're going to dig into whether Americans' spending power may, in fact, be at a tipping point. And speaking of the consumer, let's get a check on shares of Ross stores. Second quarter results topping estimates as same-store sales rose 10%. The off-price retailer also raising its guidance for the year. The company saying it's attracting new customers across all income levels, and existing customers are visiting and spending more. You can see shares are jumping 9%. Bit of a bifurcation here in off-price when you think about this and compare it to TJX earlier this week. Morning Call, I'll be right back.
All right, let me tell you about ambition. To me, too much is not enough. You have only one life, so go all out. The only way you're gonna accomplish all the big goals is if you have a vision. Find out what you want to do, set the goal really high, and go all out. And then you create another vision, and another vision, another vision. So that's being ambitious, be useful. That's what my father always said. Don't just waste this life away, be useful, help other people. This is what it's all about.
Listen to CNBC on the move with the CNBC app.
A check on how Europe is set to open the trading day.
Real-time market updates.
Strong numbers this morning.
Listen wherever in the world you are. Download the CNBC app now.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
From the markets to the courts. Kick back and relax while we serve up the highlights. Tackle your weekend. This weekend, race to your screen. The adventure continues. Dive into the action with CNBC Sports. CNBC Sports, afternoons on Saturday and Sunday, only on CNBC.
Welcome back. Let's get a check on some of the morning's latest headlines. China announcing new measures to help boost its economy as it faces slowing growth. Leaders there saying a greater share of fiscal spending will be directed towards households and consumption as policymakers seek to shore up weak domestic demand. We started the week talking about this very dynamic. And in South Korea, Hyundai's union there beginning its first full strike in a decade. This after wage talks stalled as the union seeks a higher retirement age and job protections against AI and automation. The development comes as Hyundai CEO tells CNBC that the company is considering plans to further expand its U.S. production at a new multi-billion-dollar vehicle assembly plant in Georgia. Well, Bloomberg is reporting that Broadcom is in talks with a group of lenders to raise at least $60 billion in debt. The report says that figure could climb to $100 billion and that Blackstone and Apollo Global Management are in talks with Broadcom to participate in the financing. That has been something that has factored into what we've seen in the Treasury market, as well as all of this corporate debt issuance. Competition there for investors. NVIDIA is denying a report in the information that it plans to begin shipping chips made for Chinese customers by the end of this year. The company telling Reuters it has no China-specific chips in its plans. And President Trump signing a memo to help drastically increase the number of U.S. commercial space launches. That includes directing government agencies to look at federal land for new launch and re-entry sites. The White House says it wants to see at least 1,000 launches and re-entries by 2030. That's up from 178 launches last year, which was already a record. Well, still on deck, we've got more on Treasury Secretary Bessent's bond endgame, the big questions our next guest has about the intervention and the credibility issue he says the U.S. is increasingly facing. Morning Call. We'll be right back.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC Plus. The day's top stories driving Wall Street. Up-to-the-minute developments, instant analysis, essential business news. At the intersections of power and money. Kelly Evans, Brian Sullivan, Power Lunch, streaming on CNBC Plus.
In this CNBC Explains, we explore why Asia is leading the global IPO market.
We have a really big year for IPOs with SpaceX, OpenAI, Anthropic, but analysts are pointing out that there's much more volume here in Asia.
And we look at how South Korea's AI chip boom is spilling into the housing market.
In Korea is a reflection of what people consider as their safety net, as well as a symbol of success.
The show that explains the why behind the headlines, only on CNBC.
Welcome to Closing Bell Overtime.
Get the essential post-market edge.
A very busy overtime.
After-hours action and opportunities.
The economic impact is just beginning.
What happened today?
The market had to resort to defense.
We've got a developing story out of Washington.
What's moving in real time?
What did the numbers tell you, pro or con?
Be ready for tomorrow after the bell.
There's a wait and see about a lot of things for tomorrow, Mike.
Completely.
Melissa Lee, Mike Santoli, Closing Bell Overtime, CNBC.
I'm Morgan Brennan. Welcome back to Morning Call. Let's get a start here with U.S. stock futures, which are rebounding this morning as oil prices come down. Treasury yields take a breather here. You can see after a down day yesterday, all the major averages are poised for gains. At the open this morning, the S&P poised to open up 21 points, the Dow 192 points, the Nasdaq 164 points. We're still on pace, though, for losses on the week as of right now for the major averages. Let's get a check on what we're seeing with treasuries because, as I mentioned, yields are taking a little bit of a breather here this morning after a retracement that we saw yesterday after the Treasury Department stepped in and doubled the potential for its funding at the longer end of the curve. You can see the U.S. 10-year Treasury yielding 4.68% right now, so we're actually above the levels that we were pre-Treasury announcement on Wednesday, and the 30-year Treasury 5.23%. So we're well off the highs that we saw earlier this week. Fed sensitive 2-year 4.18%. We're going to have more on treasuries and that intervention in just a moment, what it means for the markets. Look at gold, because that's had another stellar week, up over 4% so far this week, on pace for its 5th positive week in a row. And you can see up another 1.5% this morning, $4,640 an ounce. That's where we're trading right now. Let's take a look at Bitcoin, too, because we continue to see a climb higher there, well past the 70,000 mark, on track for its best weekly gains in more than 2 years. And that's before the 7% move that we're seeing here in early trading. We're now just below $78,000 for Bitcoin. And if we get a check on energy, as we do see crude prices take a little bit of a breather here this morning, although still elevated. You can see WTI is down about 0.6% trading around $86 a barrel. Brent is down about 0.5%, trading around $93 a barrel. And if we turn now back to what we've seen with the Treasury markets and the Treasury Secretary, the Treasury Department aimed at easing pressure on longer-dated government debt with its intervention or its announcement of an intervention this week. Treasury Secretary Bessent speaking with CNBC yesterday and calling the liquidity, especially in the 30-year, quote, very poor, also discussing the size of this buyback.
We routinely do buybacks, and we're going to increase the size of the buyback. And, Sarah, I would note that it could be more than the $4 billion per issue.
Well, Bessent would not give an actual amount on potential future bond interventions in terms of going above that $4 billion number, saying it will depend on market conditions. Here's how the market has taken his messaging. Look at the moves that we've seen in the 30-year yield this week, hitting a new 19-year high on Tuesday, 5.33%. Came off a bit Wednesday morning. That was before the Treasury announcement, and then fell further from there, down to 5.18% on Wednesday after the news. And then, as I mentioned earlier, retracing yesterday, climbing back above that pre-intervention level, even as the Treasury Secretary explained the impetus for the intervention. But you can see in general, we're at 5.23% right now on the 30-year. And so taking a breather again this morning. But for more, let's bring in Chester Spatt, professor of finance at the Tepper School of Business at Carnegie Mellon University. He's also the former chief economist at the SEC. And it is great to have you on, Professor. Welcome to the show. Let's start right there. I would love your thoughts on the signal that the Treasury Department put out there to the market, and then perhaps even more importantly, how the market itself received that signal.
Happy to be here. The Secretary has highlighted that the signal reflects the information that the Treasury and the government has, and that the long-term Treasury is mispriced. But fundamentally, the markets have been where they are, reflecting massive long-term deficits that haven't been shrinking, and actually in the background, obviously huge problems with the Social Security and Medicare trust fund, and an unwillingness of many administrations and many Congresses to tackle these issues. I think so. I think the signal is not being really viewed so favorably by the market. It's also interesting that here in this context, the Treasury feels that it should signal to the marketplace. In contrast, the new Fed chair has weighed in very strongly against the use of forward guidance because the Fed wants to learn from the markets. It's really striking to me that these are just the opposite approach. The Treasury wants to signal to the markets because it feels that the markets are off base. The Fed doesn't want to provide any forward guidance because the Fed wants to learn from the markets. This is exactly, in fact, the opposite approach.
There was a note out from Citigroup in the wake of the Treasury news that we got this week. And one of the things, actually, it might have been Barclays. Let's see. Yeah, Barclays. One of the things that they noted was that by choosing bonds and implicitly stocks, the risk is that Treasury has started us on a slippery slope of dollar weakness, an inflationary commodity cycle, and thus more bond intervention. I mean, is that the real risk here right now, that you could end up in a self-fulfilling cycle of having to intervene and the market reacting and having to intervene some more?
Well, I'm not sure that I would have characterized it quite that way. I do expect if these interventions are ineffective, and the one this week seems to have been ineffective, then I suspect the Treasury officials will likely back off because of concern of adding to credibility problems. So I'm not sure I see those risks as seriously as the bank. Now, also the Secretary referred to the liquidity problems that he sees in the 30-year, but it's interesting from my perspective that the discussion has been about relatively small changes in the supply, and also that the Treasury is proposing to reduce in effect the quantity of 30 years that are out there by buying some back. If one feels that a market is illiquid, you would think you would want to add to the liquidity in that market.
One of the other things that came out of that conversation with the Treasury Secretary on CNBC yesterday was he basically suggested that we've seen peak deficit in a week where we've hit $40 trillion in U.S. debt. Assuming we start to see some cuts come into the picture in a more meaningful way, what does that mean to this entire conversation?
Well, I think if we truly are at peak deficits, that would be very healthy and helpful. I do see the issues here as fundamentally about the long-term aspects of the debt, not about relatively modest changes. The Secretary, in his comments on CNBC yesterday, referred to, for example, the tariff refunds. I think that's a relatively small issue, for example. So if the administration is able, and it's not, I wouldn't blame this administration so much, as I think it's a bunch of administrations and a bunch of Congresses over the last 2 decades. If there's a move towards seriousness, that would actually be incredibly helpful. I think some of the market reaction was that they view this as kind of the opposite. It's a little bit like kind of rearranging the deck chairs. If you think about it from the point of view of a homeowner or some other borrower, if you were borrowing $300,000 on a house and you change the maturity, let's say you move from fixed rate to adjustable, you'd still owe $300,000 basically. The real issue is, can you either have a house that is not quite as expensive, or can you earn more money? And this is part of the issue that the federal government confronts. And what's happened over time, one of the challenges, in fairness to the administration, one of the challenges has been, obviously over time, interest rates have risen dramatically, in part because the interest rates for a long time were artificially low in the aftermath of the financial crisis. And as they've been renormalized, that's obviously, as they've been renormalized, and also as the debt has increased, that has made the portion of the federal budget devoted to servicing the debt huge.
Yeah. We could spend hours talking about this. We're going to leave the conversation there for now. But Chester Spat, it's great to have you on. Thank you.
A pleasure to be with you. Thank you.
A lot more to come here on Morning Call, including growing questions around the health of the American consumer. Why our next guest says many may be underestimating American spending strength and the factor he says could derail it. Morning Call, be right back.
Interactive Brokers pays up to 3.14% on instantly available U.S. dollars in your brokerage account. How much interest can your bank or broker pay? Interactive Brokers' conservative and prudent risk management uniquely positions us to pay up to 3.14% on uninvested, instantly available U.S. dollars in your brokerage account. The best informed investors choose Interactive Brokers.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
This is not just good content, this is good business. It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
I'm with Becky. This is the greatest show on earth.
Squawk Box, streaming on CNBC Plus.
Become a smarter investor with CNBC Pro. 24/7 access to market-moving news and interviews with 3 global live streams. Subscriber-only content from Wall Street pros like Josh Brown.
If you love the stock market as much as I do, you're going to love the best stocks in the market list.
Plus exclusive live events.
This is my first time at the stock exchange and it's been awesome.
To be on the floor, I just can't believe I'm here.
Become a CNBC Pro. Go to cnbc.com/GoPro now.
The Exchange, streaming on CNBC Plus.
Listen to CNBC on the move with the CNBC app.
A check on how Europe is set to open the trading day.
Real-time market updates.
What a strong number this morning.
Listen wherever in the world you are. Download the CNBC app now.
If you're watching CNBC, it's because you want to get an edge. You want to get ahead. It's our job to deliver that. My ambition is just to be the best that we can possibly be. More often than not, I kind of forget that the cameras are there, but when there's really a burning question, I'm thinking about what my mom would want to hear. I've been thinking about some of the investors I know who are watching. Those are the same questions we have. People always ask me what I want to do next, and I always think they're a little crazy. This is what I want to do. It's the best job you could possibly have.
Fast Money is America's post-game show.
Basically, near all-time highs against the S&P.
Every single story that we pick is a tie back to the markets.
Those sort of revenue streams don't trade at a great multiple.
We want to arm people with the information to make great decisions.
Stock got whacked. I get it. People say they overpaid. I get that.
Fast Money is all about the chemistry. We've been successful for this long because we're a team.
Fast Money, CNBC, streaming on CNBC Plus.
Welcome back. U.S. consumers are showing some clear signs of strain, but overall spending hasn't completely fallen off as households make a sharp pivot in their habits. Retailers, consumer product makers, food companies, all talking about the pressure being felt by shoppers. Walmart, which reported its slowest same-store sales growth, at least here in the U.S., in more than 6 years, noting consumers are feeling pinched by high gas prices and are making trade-offs. Joining me now is Jan Kniffen, CEO of J. Rogers Kniffen, a consultant to investors in retail companies. Jan, it's great to have you on. I mean, look, it wasn't horrible this week with earnings, but it also wasn't the greatest, whether it was Walmart, whether it was Coty, whether it was Advanced Auto, Lowe's, La-Z-Boy, TJX, JD Sports, even Home Depot with that big, boost from tariff refunds. It only reiterated full year guidance.
Yeah, it's pretty messy out there. And I think that comes sort of from what's happening right now with the consumer, right? I mean, Walmart, okay, they got hit by 125 basis points on pharmacy. They weren't bad. Their earnings were great, and their stock still went down 10%. And that's because that lower-end consumer is still struggling. Walmart still had really great business with that high-end consumer that they've been capturing. So it depends on where you're dealing right now. But yeah, TJ Maxx, why did they have a tough number? Well, could it be Ross stores turning in a 10% comp? Maybe that wasn't the consumer at all. Maybe that was just competitive pressure. But we are seeing the consumer change. They're trading down. They're being more conservative in the way they think about what they're going to spend on. But they haven't quit spending. And they won't quit spending despite the parade of horribles we've seen this morning on your show, like the Strait of Hormuz, like diesel prices, like inflation, like the fact that the country owes more money than anybody could ever pay back. We've heard all of that, and the consumers looked at that and said, I don't care, I've got a job, I'm going to keep my job, it's only 4% unemployment, I'll be fine, and they've just kept spending. They have reacted to that $4 plus gas, and if we don't get that down, we're going to see more strains on where they spend their money. But they certainly haven't given up on spending or on borrowing money to spend because their payback ability is just as good as it was in 2019. And when that's true and they have a job, they just keep spending. The American consumer is really hard to stop. But boy, we've done everything we can to stop them.
Yeah, and actually we've seen that continue to show up repeatedly in Visa and MasterCard and American Express earnings too, to your point. Look, I'm a bright-eyed optimist, and when you lay it out like that, it makes me very sad that I'm talking about so many, difficult things here. In light of that, though, I am curious about this trade down that we're seeing with higher-end consumers, because Walmart, this has been a dynamic for a long time, but Ross Stores is talking about it too. And so we talk about a K-shaped economy, but should we be looking more at what we're seeing at the upper end of the middle class as well in terms of areas of strain?
Well, it's surprising how strong the top 20% is. No, it's not surprising because the stock market's been fabulous, right? So the top 20% is doing really well and they're spending. And if you're Ralph Lauren, if you're Tapestry, you're turning in good numbers, right? If you're Walmart and you're trying to do business with a $100,000 household, it's working for you and you're getting more business. Ross Stores has done something different. We're not trading down to Ross. Ross is trading up to us. They basically said, we're going to have better product, we're going to do a better job for that consumer, and the consumer has reacted. So they have been willing to move, but you had to give them something they wanted to buy. Ross wasn't doing that. They were only dealing with that lower-end customer before. They have said, we're going to get up a little higher, and that is going to put pressure on TJX. And the secret is, Ross has done it and it's worked. Just like Walmart crawled up and it worked. They were able to capture that higher end consumer. There was a time when that couldn't have happened, but today that consumer will talk to you as long as you're giving them the product they want.
All right, Jan Kniffen, we got to leave the conversation there. It's great to have you on and see you as always.
You too.
And we'll get more results next week. Straight ahead, though, Morning Call crew going to tee up the day ahead. We're back in a moment.
In this CNBC Explains, we explore why Asia is leading the global IPO market.
We have a really big year for IPOs with SpaceX, OpenAI, Anthropic, but analysts are pointing out that there's much more volume here in Asia.
And we look at how South Korea's AI chip boom is spilling into the housing market.
In Korea is a reflection of what people consider as their safety net, as well as a symbol of success.
The show that explains the why behind the headlines, only on CNBC.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show. Squawk Box, streaming on CNBC Plus.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
The Score, streaming now on CNBC.com and YouTube.
For me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. You want to learn more about it. And I think CNBC allows our viewers to fulfill their passions. There's no doubt that the people who watch us care. I am very much focused on trying to land interviews where there is something at stake and asking them fair but tough questions in which their answers are important. I could not imagine covering anything else.
Call sheet. Crew members today: Peter Bookvar, Ryan Dietrich, Gilbert Garcia. Okay, we're rapid fire here today. I don't know how we got crunched up against the end of the show, but we did. But we're going to get it all in. Peter, want to get your thoughts on what we've seen with the Treasury this week?
So Scott Bessent clearly drew a line in the sand. I think a few of his challenges is the market is much bigger than he is. He does not have a printing press like the Fed. I think that the trade-offs are he's buying debt probably at well below par, which is a positive, but he's giving up low interest rate debt by doing so because the bonds he's buying back were when rates were at zero, and he's replacing it with short-term bonds that have much higher interest rates. So this is a dangerous game that's being played here. I understand his frustration with the rise in the long end. We also have to watch the U.S. dollar, because if we lose the U.S. dollar over this, well, that's inflationary, and foreigners own a lot of U.S. assets, and a weaker dollar could facilitate their selling of U.S. assets. So this is a game of whack-a-mole.
Okay, and we have seen the dollar weaken this week. Gilbert, I think we've tracked you down on your world travels just to have you weigh in, so there's no one better I want to hear from right now.
Thank you so much for having me. First of all, I think it was a brilliant move. And I take a little bit of the other side of the trade. I think what the Secretary is saying is that the fundamentals do not warrant as high rates as they are today. And if you look since the war, the majority of interest rate increases have come from real rates. And of course, we all know that real rates being higher are much more difficult than just nominal rates being higher. Of course, when nominal rates are higher, we know that that's inflationary. There must be some inflationary pressures. That probably means wages are going up. That probably means businesses have the ability to raise prices. But when real rates go up, it's a much more strangling effect on the economy, and that's what they're trying to curtail.
Ryan, I want you to weigh in on this, especially since you've been on panels with me here on this show in the last couple of weeks where we've said, you know, when does the stock market start to listen to the bond market? It seems like that's happening now.
It does. Good morning, and thanks for having me back. I mean, listen, the last 5 days, S&P's down 2%. We know we've had some weakness. Like we said, Jackson Hole is next week, NVIDIA earnings next week. To have a little indigestion with the markets, not surprising. That 10-year yield's up around that 470, 480 level. I know Frank Capillari comes on with you. He's mentioned that level for like 2 years has been kind of the peak. So we're not breaking out yet, but clearly those concerns are there with those higher yields.
Yeah, we've seen a big move higher in gold. Bitcoin is having a move this week as well. To Ryan's point, Peter, we're looking at the Fed with Jackson Hole next week, and certainly questions about what that's going to look like and the messaging there now. NVIDIA, possible we get an Anthropic prospectus drop here too, and then PCE.
Well, with Warsh, he's told us he's not giving us forward guidance, so I don't know if we're going to learn anything new. Of course, I do want to hear what he has to say about what Bessent's doing, because by Bessent front-loading short-term T-bill issuance, Fed policy is then highly influential on the amount of interest expense we're going to pay if he's going to do that. I think with Anthropic, it would be great to see them IPO. They need the capital, but that's extra supply on the market after the SpaceX. And the other thing you said was?
Oh, PCE inflation.
PCE, of course. Yeah. Well, with interest rates doing what they're doing, that's going to be huge. Now, the one thing with PCE is because we've already seen CPI and PPI, it's usual that PCE doesn't really deviate much from expectations. But getting back to what our other guest said, I do think it was smart to try to cap long rates, but that's a big fight. The market is much bigger than Scott Bessent. Scott Bessent does not have a printing press like the Fed. So just because you do something, that doesn't mean it works. And I see this more like FX intervention, where unless you have policy change, these effects tend to be very fleeting.
Yeah, which we've gotten with dollar-yen as well in recent weeks too. Gilbert, your thoughts?
I think this is just the very first salvo. I think with time, we're going to see if it doesn't work, they're going to keep going. They're going to keep going. It's going to be something as large as some type of Operation Twist, because I know that, or at least I believe, that they want to get real rates down. I think a coordinated effort by both the Treasury and the Federal Reserve. I think the Federal Reserve is going to be waiting for those task forces to come out before they raise rates, and I think these are coordinated actions to get rates lower.
Okay. Ryan, I owe you. Come back next week. We'll finish this conversation then. Gentlemen, it's wonderful to have you here. Thank you to our call crew. Have a wonderful weekend. Squawk Box starts now.
Good morning. Futures pointing to a partial rebound after the Dow and the NASDAQ fell more than a percentage point yesterday. But the numbers are big because the markets are high. So even a percentage point looks like a big number. Yields remain in focus. Treasury Secretary Scott Bessent telling CNBC that the government could increase the size of its bond buybacks. And another move higher for Bitcoin. It's now up more than 20% this week. Up more than 30% since someone called it a warm bucket of urine. It's Friday, August 21st, 2026, and Squawk Box begins right now.
Good morning. Welcome to Squawk Box right here on CNBC on this Friday morning. We are live at the NASDAQ market site in Times Square. I'm Andrew Ross Sorkin, along with, ta-da, he's back, Joe Kernan. Meanwhile, Becky Quick is off. Nice to see you, sir.
I figure 2 full weeks, come back on Friday, let people know you're alive, and then it's only one, then it's Friday, then the weekend is here. And I figure, I leave. If I didn't come in today, you're going to let the debt be 42 trillion when I get back. So
I would let the debt get to 42.
I'm gone, and now we're 40 trillion.
It's 40 trillion. We're doing intervention projects with
is it different
the bond
than QE?
markets.
Is it different?
Oh yes. Oh yes.
Oh, you don't like this? Then
I think this is creating a real.
Because if it doesn't work, then what do you do?
Correct. Okay. And I think there's right now. I think there's like a credibility question about
I see that
how that's all going to play itself out.
Yeah.
Take a look though at U.S. equities right now, about 210 points higher on the Dow. That's the good news after what was not so great news yesterday. Nasdaq up about 225 points. S&P 500 up about 27 points. Energy has been the story. Maybe if we could somehow land the plane, if you will, in the Middle East, we'd have a different situation. But WTI crude right now, 86.71, Brent at 93.62. Treasury yields, this is an important part of the story. 10-year note at 4.6, you're looking at the 2-year at 4.1. And then there's this, maybe on the back of this, and this is maybe the credibility story, it's a boon for Bitcoin. Jumping again this morning, it's now up close to 20% just in the last 2 days, breaking out of a range it's been in the last few months. We had a conversation with Brian Armstrong just yesterday from Coinbase about this, about the Clarity Act, whether that would be the driver of some of this. We talked to Anthony Scaramucci earlier in the week, whether actually it's a function of the credibility around our bonds right now, and whether that would actually inspire people to go buy Bitcoin or gold or things like that.
Always tough, right? Bitcoin to really point to anything definitely definitive. We do know a pretty good low put in by, well, he's not your buddy, but Grantham, 58,000 the day that he was on. So, but he's not short, so he gets some say whatever he wants.
In fairness, just the last 2 days though, the two people who came on around Bitcoin actually did not think that any of this would actually, that there was a catalyst for Bitcoin right now.
That's what I mean. Yeah, I don't.
No, I'm saying even Scaramucci, who's in the Bitcoin business.
I'm saying there doesn't have to be one for it to go down or to go up, right?
Which makes it that much more complicated.
Well, same with stocks and everything else. Well, but the thing is,
hopefully with stocks and hopefully with bonds, there's things you could point to and say, okay, this is what's driving.
Well, it's always supply and demand, though, isn't it?
Well, and then there's a question about the supply or the demand of Bitcoin and what it is, but that's a separate matter.
Well, I know you. Thank God you didn't short it at 58,000. Short it today. Short it today. That way you actually feel the actual moves instead of just being able to talk about it.
I'm not in that business.
Okay. Let's get back to, it would help. Maybe it would help. Let's get back to the story in bond yield. Treasury Secretary Scott Bessent telling CNBC his department could upsize a buyback of government debt. He was speaking with Sarah Eisen on Squawk on the Street.
We routinely do buybacks, and we're going to increase the size of the buyback. And, Sarah, I would note that it could be more than the $4 billion per issue.
Yields initially fell on Wednesday after the Treasury announced it would be doubling its scheduled $2 billion in buybacks to $4 billion, though by yesterday some of that decline had been erased. Bessent's remarks yesterday caused another easing in yields, but that only lasted a few moments. Bessent said he doesn't think yields reflect the underlying fundamentals of the U.S. economy. He also said there's a good chance the U.S. budget deficit under President Trump has peaked. There are other people saying it does reflect the underlying fundamentals of the U.S. economy, in that a strong economy would be a reason for rates to go higher.
Look, the thing I'm hoping for, there was a comment he made, which I am hoping is right, which is he says, look, I have asymmetric information. He made a comment about Japan.
Mm-hmm.
So I wonder whether there's an indication that somehow there's going to be something that the Board of Governors in Japan do, with the central bank there, Bank of Japan do. Maybe he knows something else about what's happening in the markets in the U.S. That is my prayer. But obviously, there's a lot of people asking a lot of questions. Meantime, more news from the Treasury Secretary. He says the Trump administration's plan to squeeze Iran's economy probably negates any current need to resume a muscular military campaign.
If we are doing the maximum economic pressure, then that means that likely there will not be a large-scale kinetic restart. But I would emphasize that is for now. And look, we do have control of the Strait.
Those comments followed a social media post by President Trump earlier this week that said that the U.S. was about to impose what the president called an economic D-Day on Iran. And we're going to talk more about how China plays into all of this a bit later this hour. But on that score, you had interviewed the Treasury Secretary just 2 weeks ago. He told us that there was basically a deal in Iran that was going to be made.
Right.
The markets popped. Everybody, this gets to the credibility issue. They listened to what he said. The markets did what he said. And then, of course, what happened in Iran
that was the Oman. That was when Oman was going to do something. Then we got mad at Oman.
Turned around. These are sort of, to me, the sort of longer-term questions about how you're supposed to read what the administration says about some of these things. I remember the Treasury Secretary, months ago, talking about sort of economic ninjing. Remember he used this phrase, we're ninjing Iran, and it's going to force them into a corner. And
things aren't great.
It has not. It has not worked.
But things are. You kind of have a smile while you're saying all those things. I guess you can't help it. It's okay though.
No, it's the truth.
I know, but it sort of shows but hopefully everything does work out.
I honestly,
I know you do.
I genuinely want it to.
I know.
Genuinely want it to.
I do too. I do. We both do. The clock is ticking on some new U.S. tariffs on tens of billions of dollars worth of Canadian products. Without a deal, they're set to take effect at 12:01 tomorrow. The tariffs would have snapped into place earlier this week, but President Trump delayed them for 3 days yesterday. The Canadian minister responsible for trade with the U.S. said the two sides were close to an agreement, and the Canadians would remain in Washington to work on hammering out a deal. Is it at 6:07? What else you got for me?
We got a whole show ahead, so why don't we get to it?
Because I haven't seen you. I mean,
okay, well, what's
going on in your life?
We
never get done. We never get done at 6:06. Now it's 6:08. Clock is ticking. Coming up, much more on yields as we get ready to conclude a volatile week. My Tom Brokaw, volatile week in the bond sector. And we'll get you ready for NVIDIA earnings. Those are on the way next week. Stay tuned. You're watching Squawk Box.
never miss a moment.
We think there is a huge opportunity for AI in the UK and Europe because it is that middle ground between the United States and China.
Andy Burnham has committed himself to the Labour manifesto, so I don't think that that's going to change in the immediate future. I think our historic destiny is to be back in the European Union.
The world is taking you at your word, sir. What happens next?
We're never going to see Iran have a nuclear weapon.
For this edition of the CNBC Conversation, I'm joined here in Milan, Italy, by the Prada Group CEO, Andrea Guerra.
There is fashion waves, there is political waves, but then there is reality. The reality says that younger generation are looking at you, not just to what you say, but how do you behave. The way you are behaving in the society, you are behaving with your own people and suppliers and stakeholders, and how you are behaving towards the planet are the three things that are part of our inner mission. So we are here to allow everything inside our group to be connected smoothly and positively towards planet, society, and our own people.
Prada Group CEO Andrea Guerra sits down for the CNBC Conversation.
There were definitely a few times when there was no money in the bank.
Before Careem became one of the defining startup stories of the Middle East, Mudassir Sheikha was trying to keep it alive from one funding round to the next. He'd left a safe consulting job, and he and his co-founder had each invested $50,000 of their own money into the company. In the early days, Careem wasn't an app that magically matched riders and drivers. It was the founders calling drivers themselves in the early hours of the morning.
It was radically basic. All we had was a website.
And 7 years later, Uber, the rival Careem spent years fighting, agreed to buy the company in a landmark deal for the region.
To do a deal with our biggest rival, the company that we thought was trying to kill us, was just very, very difficult for the organization.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
Let's get another look at treasuries this morning, and you were just talking about it. These are, on a relative basis, they're big, but they're still in basis points that we're talking about. And if you've been around long enough, none of these yields are that surprising compared to where they were, maybe, but on an absolute basis, we've been much higher for decades at a time. Join us now on the recent move in rates plus earnings season is Jason Pride, Chief of Investment Strategy and Research at Glenmead. And we were talking off camera, not due to inflation, since expectations have come down, not due to 40 trillion cover. I mean, that's a number.
I don't think that's.
I mean, we're at 39,999. When we go over 40, suddenly everyone talks about it. You don't think that's
the key numbers? Look, I think that's important. It's important for us to get that under control. You know, ideal debt to GDP scenario for the nation is probably something in like the 60-70% range, not 100% of GDP. But the line for which bond vigilantes have a lot of power is way higher than this. Way higher than the 100%, and there's a pretty decent amount of time frame in which we can actually make gradual adjustments.
What's Japan right now?
Japan's 130% on a net basis. Key thing to look at is UK. UK got to 269% debt to GDP at its peak. 269%.
They got great help.
Now they had to fix a lot of things in order to repair that. Japan's had to fix things, but that's not the issue. We don't have credit spreads on government debt like blowing out right now. This is actually about expectations for rate increases from the Fed. That's part of it. And then let's call a spade what it is Kevin Warsh introduced uncertainty on the path of interest rates. Markets are pricing in a little bit of uncertainty there on the path, right? They're taking interest rate risk. They're going to build in a little bit of uncertainty. And then the Fed's has been doing its own kind of reduction of the balance sheet / twist action in the opposite direction of what the Treasury just announced effectively the last 2 days.
So now they're at odds?
They're at odds. Well, I would probably say maybe they were at odds and now they're more kind of in interplay with one another. The Fed's effectively handing off the duration positioning of bond kind of flows to the Treasury. Bessent is basically taking the signal from the Fed and saying, okay, well, if the market's going to allow us to buy longer term debt, 30-year paper at 5.2 plus, I'm going to take that. I'm going to buy that, and I'm going to finance.
Is there any way this has to do with underlying strength in the economy? You saw Walmart yesterday; that didn't look very strong. But you look at corporate earnings, incredibly strong. Plus, what about AI and all the money AI needs for the build out? Wouldn't that put pressure on rates?
And I do think that might be kind of a modest piece here, right? So if you have government financing, government's going out to the market providing debt. You've seen AI companies, some of the highest investment grade companies out there, go out and issue debt into the marketplace. Everything's about flows, I think, at least right now. When you have the Fed stepping away from purchases, when you have competing issuers that are also investment grade going out to the market and issuing long-term debt, there's only so much of a pile.
But look, I described it yesterday as a situation where you have a 30-year mortgage and you decide to refinance it almost like with a 5-year arm, but in this case, like a 90-day arm. And the question is, that can either work out really, really well for you or really, really poorly for you. JP Morgan this morning described it as paying your mortgage with your credit card.
That's probably a little bit dramatic because they're not financing the entire mortgage here, right? Scott Bessent went out and he's hitting for pieces of the market. It's like marginal positioning around the edges. It's meant to be signaling. It's basically meant to be signaling to the market. But
it's meant to bring the rate down. That's what it's meant to do, and it's meant to do with the other piece of it is the timing of it. And this is, I think, there are people who look at it this way. It starts effectively in September and ends on, you know the date? November 4th. Do you know what happens on November 3rd?
Well, that's.
Are you clocking the calendar? No, I mean but this is why people look at these kind of decisions, and unless they're explained in such a way.
Those people again. Those people.
You know what?
I think at the end of the day, it's
including some of the biggest Republican donors, successful investors who have been talking about this for the past 2 days.
You know what I'm saying? It's a way of saying those. You can always say whatever you want by saying those people. Anyway,
I think we're actually saying similar things. It's a signaling thing by the Treasury, basically saying you're going to give me 5.2, I'm going to take 5.2 plus, right? Number one, I'm very confident in the position. I'm willing to make that bet. This is a Treasury Secretary that's coming from a position of being in a hedge fund. In prior, he's used to making bets, and he's basically putting on the table and making a bet behind it. So he's very comfortable in doing that and very comfortable in signaling that.
And the question is that it will either prove to be correct or not.
But he also came out yesterday. I thought one of the keyest things that a lot of people didn't key off of yesterday in his comments was he stated, I think we're at peak deficit in the U.S. And why is he confident about that? I think it comes down to the tariffs, right? They're in this window of tariffs where the U.S. Supreme Court put them in a position of where they had to pull back. They effectively had to refund tariffs. They had to pull back on the rate. They're now gradually ratcheting up. That was in his calculus, I think in Bessent's calculus, that was his offset to a lot of the spending they had in place. Without having it there,
but can I ask you a question? You're talking about his confidence.
Deficits come back in.
What would give you confidence? He also was confident that the tariffs were legal, right? He was confident. He came on our air multiple times, said how confident he was that case would end in a different way. He was confident repeatedly that he was going to financially ninja Iran into a corner. He was confident that there was a deal with Oman. I can go through a list of the things that he has been confident about over the last year. And what I'm trying to understand is why you would be confident that his confidence is accurate.
So we're not confident on every single thing that he says. We're confident on the things that we've gone through the analysis and agree with him on. This is one that we agree with him on. Treasury Secretary is in a position where they do have to be an advocate for the administration and a general perspective, and you need to know that when they go on, when he goes to speak. But there are spots.
Did you watch Janet Yellen at all?
Of course.
I mean, during that tenure, it was a joke. It's like the opposite of what we're seeing from Bessent right now. 90% of the people here think he's one of the greatest Treasury Secretaries we probably had, because he knows so much and has done so much with currency and everything else.
And showing confidence is part of the job in that role.
Get back to stocks. So what do you mean that you're neutral risk? What does that mean? that you think we're at high levels here, or you're? You said you didn't have a fat pitch.
You've had me on this before, and you've said, well, you're sitting in the middle of the road, like in the show before, and there's going to be a number of occasions where we are fully confident and comfortable with sitting in the middle of the road. When we don't see a fat pitch provided in markets in terms of a reason to be positioned differently from where our clients should be on a long-term basis, we're going to be very comfortable sitting with our bat on the shoulder, all right? So in this case, neutral risk position means we're not dramatically overweight equities because the valuations are high. We're also not dramatically underweight equities because while valuations are high, we have one of the strongest economic momentums, profit momentums, that is broadening out across the system in this market.
Well, until yesterday, we were at most people's year-end target. We were at 7,700. Yeah. We were at 7,800 on the S&P before then. So we're already there.
We have this.
You could hold on to 7,800, but by the end of the year, you would hit the bullish targets that people had at the beginning of the year.
And we have our valuations have us at between 85th and 90th percentile valuations. 90th percentile plus is where I start.
So where do you think it ends the year? You think we end the year around here? That's what you're saying.
I think we could probably have another 5% into the year.
Up, not down.
Up, yeah.
Or down.
Yeah. Look, I can also put, and this is why I say it's not a fat pitch. I can put a plus or minus 10 around that number.
Yeah.
Because that's the way markets are on a near-term basis. The other key part is that this market is broadening. And the other pieces it's broadening into, down into smaller capitalization securities, out into international securities, those valuations are a lot more reasonable. I can get behind those on a more sustained basis. And the profit growth is beginning to develop there. We're really feeling it in small cap, which has been our biggest positioning differential for our client base on a year-to-date basis.
All right, Jason, thank you. How much has Glenn Mead got now?
$43 billion.
Okay. And you're in charge of all of that.
We've got a lot of colleagues there that work with me.
You only have a little gray hair. All right, thank you.
Thank you.
All right.
Thanks for having me on.
Thank you. Coming up, the next monster IPO, Anthropic, reportedly expected to publicly debut its offering, which could eclipse SpaceX. Bring you details on that right after this.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC+.
For me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. You want to learn more about it. And I think CNBC allows our viewers to fulfill their passions. There's no doubt that the people who watch us care. I am very much focused on trying to land interviews where there is something at stake and asking them fair but tough questions in which their answers are important. I could not imagine covering anything else.
American soccer legend Landon Donovan. He'll explain how the 2026 World Cup could shape the future of Major League Soccer and the inner demons that drove him to greatness.
I was constantly chasing this insatiable desire to be noticed.
He's the man behind Apple's sports ambitions. In an exclusive interview, we talk about the tech giant's unique sports strategy and whether a blockbuster acquisition is on the horizon. This is CNBC Sport on the Record.
The AI boom is reshuffling the global equity market rankings, with Taiwan and South Korea leapfrogging past long-established markets. Taiwan has climbed past Canada and India to become the world's 5th largest equity market, while South Korea has moved into 6th place.
All this happened within the span of just a few months, because last December, they were in the 9th and 11th places respectively. Now, such a shift is not unprecedented, but what is unusual is the speed at which these two have been climbing.
But this reordering isn't necessarily being driven by broad economic growth. Instead, it's about 3 companies at the heart of the AI hardware supply chain.
It's the AI theme which is driving things. So we have this kind of perfect positive storm of industry fundamentals which are resulting in very, very rapid profit growth.
So what does this reshuffle tell us about how AI is changing global stock markets, and what are the risks?
One of the world's largest private climate investment vehicles, Altera, aims to mobilize $250 billion by 2030.
What we're trying to show is that we can align those objectives and we can make money doing it.
Clean energy, emerging markets, even the AI boom. The opportunities are vast, but how do you pick the right investments?
We have people who specialize in these investments, and that's what makes Altera unique. That's our secret sauce.
Find out more on the next Managing Middle East.
Welcome back to Squawk Box. Anthropic executives believe the company's IPO will probably match or beat SpaceX's debut in size. A Bloomberg report saying that Anthropic could file publicly for its listing before the end of the month. SpaceX IPO'd in June. It raised $75 billion in what was then the largest ever first-time share sale. Bloomberg saying that Anthropic's recent investor briefings have avoided the question of valuation thus far, but we're going to keep our eyes, of course, on this. And I think the entire industry is largely dependent on what valuation Anthropic comes up with, because then it will move towards what valuation OpenAI ultimately comes up with.
Claude gets backed up. If I pay for it, does it not get backed up?
That you need to pay.
Have you heard of it getting backed up? I ask, and it's like I can't do anything for it right now. It's hurtful.
I pay. I'm a customer, so I don't know about these situations that you're having.
Even after what Alex Karp said, so you're paying. You don't.
It's a great service, but I also pay for OpenAI.
You pay for both of them?
Of course.
What are we talking?
You pay for neither of them.
What are we? No, kidding. What are we talking about?
What do you mean?
How much a month?
It's the price of the thing. $25 a month each one.
You're paying $50 a month for artificial intelligence?
Yes, and in fact, for a period of time, I was paying the $200 max fee on Claude. But I found that I didn't need it as much.
So it just comes out of your, how do you pay it? It comes out of your Apple account or something? Or how does it work? Coming up, what you don't write a check, if snail mail? No. What went wrong with Walmart's second quarter earnings? The stock coming off its worst day in years. We'll get into that move next, because you probably got a million things you're paying for you don't even know you're paying for, if it's that easy. That's a problem. First, as we head to a break, here's a look at yesterday's S&P 500 winners and losers.
You can master your strategy, but performance could be limited by your instrument. Precision trading starts with the right instrument. Over the past 3 years, Interactive Brokers clients outperformed the S&P 500 on average. Like returns, trading costs compound. Interactive Brokers is built to lower costs through smarter execution. Access stocks, options, prediction markets, and more across 170+ global markets. The best informed investors choose Interactive Brokers.
Power Lunch streaming on CNBC Plus.
A market shaping industries. We are watching the six little dragons, the first to be listing in the Hong Kong market, supply chains, and global momentum.
Do you feel pressure to create the next Labubu soon?
This really is a business-first pivot despite the geopolitical strains. The China Connection, weekdays.
The trade heads are gathering against the backdrop of the global energy crisis.
CNBC.com and the app anytime. Let's get to your headlines. Only on CNBC, connecting you with China.
Good morning. Welcome back to Squawk Box. We are live at the NASDAQ market site in Times Square. Take a look at futures right now. Dow up about 201 points. The NASDAQ up about 213 points. The S&P 500 up about 24 points. But depending on how we end the day, this week has not been the greatest in the market's history. A check on Walmart shares right now.
Let me do that for you, because that had a lot to do with what happened yesterday in the Dow. How much was it down? About 10%? How much was it down yesterday?
Total week today was 10% for
week today. But I was just trying to figure out how many points on the Dow. So that was part of it, but it's not like a much higher price stock. The retailer stock fell 9%. Its worst day in more than 4 years. Second quarter comparable sales grew 2.6%. But that was below the 3.5% that Wall Street was expecting. Investors also appeared disappointed in the company's guidance for same-store sales.
Meantime, chip designer Broadcom said to be speaking with lenders in an effort to raise more than $60 billion in debt for an AI chip financing deal. Bloomberg reporting that the agreement would be designed to help firms like Anthropic access chips and other AI infrastructure. It also could reach $100 billion potentially in size. That report saying that Blackstone and Apollo Global are in talks to participate in all of this. Now, those firms, along with Broadcom, reached a computing infrastructure financing deal several months ago and gets at this whole idea of data centers and these chips as a asset class, if you will, and gets back to the conversation that Jensen Huang and what I'm calling the Gang of Six have now talked about trying to create in terms of thinking about this technology as an asset class. Of course, big questions about whether it is long-term. Coming up, how China is playing into America's Iran war calculus. Will U.S. penalties hit the world's second largest economy as a result of President Trump and what he's now calling economic D-Day? That conversation next. And a reminder, get the best of Squawk Box in our daily podcast. Follow Squawk Pod on your favorite podcast app and listen anytime. We're coming right back.
One hour of added insight every morning doesn't just add up, it compounds. One extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC. Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
My ambition is to get the story and to help the viewer connect the dots, to understand the context so that we, all of us, can actually make our own judgments. Oh, I love what I do. I can't imagine doing anything else.
The AI boom is usually told as a Silicon Valley story, but some of the biggest winners are thousands of miles away in South Korea. And their windfall is now spilling into an unexpected place, the housing market.
Before we saw this massive rally this year, people just like to invest in the housing market because there is no alternative for savings and investment.
From January to April 2026, home buyers used about 3.7 trillion won, or roughly $2.4 billion, from stocks and bond sales to fund purchases.
The government wanted to boost the stock market so that people could move away from homes into the stock market, but people are coming back to the property market with the money that they earned in the stock market, and it's also sort of this vicious cycle.
The danger is not that one stock market sell-off would immediately crash home prices. It's that the same wealth channel pushing stock gains into housing depends on confidence.
Welcome back to Squawk Box. The U.S. plans to squeeze Iran's economy could force China to think more carefully about the trade-off between cheap Middle Eastern oil and doing business with America. In a statement, a spokesperson for China's foreign ministry saying, quote, imposing sanctions and pressuring do not help to solve the issue. China calls on relevant parties to take responsible measures and solve the issues through diplomatic and political means. Joining us right now is CNBC contributor Dwardwick McNeil. He's managing director at Longview Capital, or Longview Global, I apologize. It's nice to see you this morning.
Good morning, Andrew.
You tell me how this all ends.
Well, my hope, Andrew, is that it is a conflict between the U.S. and China. If we're careful, we could dip into that type of situation. Let me be clear, if you have economic D-Day, as the administration is calling it, with Iran, at some point you will have to address how China has helped over the years Iran survive and end around and run sanctions, particularly as it relates to petroleum. And look, I think much of this will really rest on whether or not the U.S. is prepared to go all the way to the Chinese banking system and impose secondary sanctions there. And if you'll recall, Andrew, the Biden administration hinted at this at the start of the Ukraine war because of what they say were Chinese assistance to Russia, but it never happened. And it never happened largely because that is the nuclear option when you deal with China.
Well, that's the question. So President Xi Jinping will be in the United States, I imagine in the Oval Office at the White House at the end of September. Is this part of that conversation and that negotiation?
Well, on our air yesterday, Secretary Bessent made a statement that I thought was a very smart statement. He said some of these conversations need to be had in private or something to that effect. And he's absolutely right. I think trying to lecture China or shame them publicly or threaten them, that's not the best way to get cooperation here. It should be raised to the leader level and should be on the table when Xi Jinping comes to Washington if he comes to Washington. I think that's the only way you're going to really get some movement here, Andrew. But, with respect to this, I want to be clear that this is not the large Chinese majors that we're talking about. So this is not Sinopec or CNOOC or PetroChina. These are what they call teapot refiners. Larger in scale than the mom and pops that we commonly think about when we think about teapot refiners. But much of the Iranian crude is going to these guys, and it's being transferred, shipborne, ship to ship, once you get outside the Malacca Strait, and then taken up to Dalian and other places on the port. So you really have to address this system of workarounds that have been in place for quite a long time, Andrew.
What is your realistic timeline for when the Strait could be meaningfully open in a real way?
Yeah, this is a good question, because what we're about to launch is what I call a war of attrition. This is about endurance and who can stand pain for a long time. And this is going to be a long time. These sanctions, or whatever it is we're going to roll out here on Monday, it's not going to turn this network off overnight. And there will be all sorts of attempts to test the loopholes and test the slippage in the system. So, I think, Andrew, we could be moving well into the fall and winter before we see any real movement here, because I think both sides have entrenched themselves in thinking that they can outlast the other, and those aren't quick conflicts. Those are long-tail conflicts.
Okay, so if that's the case, we're looking at WTI crude at 86.78 right now. What do you think that is come this fall, come this winter?
Well, I'm not a commodities trader, but I can tell you I don't think we're at $84 a barrel as we continue to see this war of attrition. I think markets at some point will acknowledge even this economic D-Day does not provide the quick solution that we're seeking with respect to the Strait of Hormuz. And if we're talking about going after these teapot refiners, Andrew, this could move to the Strait of Malacca, where most of this stuff is happening. So this gets very complex. And we'll see what's announced on Monday, but there's a lot of layers still left to unpack here.
Okay, Dwight Rook, we're going to leave it there. We appreciate your time this morning. Thank you.
Thank you, Andrew.
You bet.
Wait, coming up, want to take a few days off to play Grand Theft Auto 6? I don't know, not really. But it finally...
My kids probably would like to take a couple days off of school just so they could play. They're looking forward to 18, but they are. What?
Wow, really?
It's a serious situation.
It's finally coming out in November. Mm-hmm. If you want to do that, you could join the U.S. Army. Some soldiers are in line for video game leave. That story's next. First, though, the AccuWeather forecast with meteorologist Bernie Moreno.
We have some drenching thunderstorms today across the southeast from Atlanta, Tampa, Orlando toward Miami. Clouds break for some sun in New York City and Washington, D.C. Lingering clouds and some rain in Boston. Gusty thunderstorms in Chicago. And the heat continues from Texas toward the southwest. Watch for your travel delays all day in Atlanta and this morning in Boston. AccuWeather for Business delivers proven superior accuracy with often earlier site-specific warnings that reduce false alarms and costly disruptions so your business stays best prepared. Visit business.accuweather.com.
When world-class racing meets the best in science, nothing is left to chance. At this level, everything and everyone has to perform at their best. Ecolab helps protect it all, from people to performance, ready for whatever the race demands. This is what the best looks like. Driving innovation and building a high-performance future that's better for people, planet, and business. The best of us, winning the right way.
From London, Paris, Munich, and in Milan.
We've seen very strong demand all summer long. End users are using our AI even more frequently.
Are you heading into a record Q4?
We are gearing up for the biggest IPO of the year.
Prime Minister, it's a pleasure to be back in Athens.
It's a pleasure to talk to you.
This is becoming a very competitive market in the EV space.
Parliament continues to stay very fragmented. This Bank of England decision certainly got more interesting over the last couple of months.
Here's what investors are watching this morning.
My earliest ambition was to be a teacher, but I felt I couldn't afford it. My mother thought it was the highest calling, and I gave her a promise that one day I would be a teacher if I did well enough in life. It was my ambition, and I was able to achieve it. So now I can teach you so that you can be as ambitious as you want about whatever you want to do. CNBC is my home. If you love your work, well, maybe it's life itself.
Be there for the opening bell.
Right here.
Squawk on the Street, CNBC.
Welcome back to Squawk Box. The U.S. Army unit dangling a chance for re-enlisting troops to binge what's sure to be the year's hottest video game. The 9th Brigade Engineer Battalion, based at Fort Seward, Georgia, has now offered soldiers 4 extra days off around the time that Take-Two Interactive releases Grand Theft Auto 6. This is happening in mid-November if the troops extend their military commitments. Fort Stewart spokesperson telling the Associated Press an Army career counselor came up with the idea in part to remind soldiers of approaching reenlistment dates. The spokesperson said that at least 20 of 130 eligible soldiers so far taken the perk. But by the way, people are addicted to this game. I have kids who play this game. They shouldn't be playing this game. I don't know if you know how violent this game is.
No, and we've talked about with Becky. You know, you run over a hooker and you get extra points or something.
It's wild. You're robbing the banks. You're stealing this. It's pretty crazy. I had to explain to my mother what my kids were doing, which was not the most comfortable conversation. Anyway, yes, you're watching right now on the air what some of the game looks like. I think it is for 18 and above. So I don't know how my kids are even playing this, and maybe it's showing that I'm not doing as well as I should as a parent with the parental controls.
Well, it's good that it's 18 or above, because if you want to do all that stuff, you're actually in a position to be able to go, buy the firearms and do everything necessary to do the Grand Theft Auto, right? You're able, to act. I'm not a person that thinks video games is the root of all evil, but don't you think
I can't help. Cannot.
But overall, don't you think that there's a general decline in sort of civility and everything else, and some of it might be from all of this stuff? It's social media for sure.
I think video games, social media is all not helping.
And it's also something we're just not going to stop anytime soon.
I wish I knew how.
Right. Well, now we just got to survive the hunter-killer Terminator type situation staring us in the face right now, or the so good to know that they've designed some viruses from scratch and that AI can do it just like I asked Claude to help me with, reservations. He couldn't do that, but he's ready to design me a virus for a pandemic.
A check on SpaceX shares this morning. The stock fell 4% yesterday. That came as more than 300 million shares were unlocked for trading, about 7% of the stock that was owned by early investors and employees. Coming up, how much would you pay for Edward Scissorhands' actual scissor hands? Wait a second, he was real? Oh, they mean for the, okay. Prop Store's chief operating officer is going to join us ahead of what could be a blockbuster movie memorabilia auction. That is next. Well, it could be Freddy Krueger's fingertips, too, kind of looks like. We'll have that when Squawk Box returns.
On a $100,000 US margin loan, Interactive Brokers charges just 5.14%. Do you know how much your broker charges? Fidelity and Schwab charge over 2 times as much. E-Trade is even higher. Move your account to Interactive Brokers and save at least $5,100, or much more if you're trading big bucks.
Halftime Report, weekdays streaming on CNBC Plus.
Ambition doesn't always look like you think it might look. I can remember reading The Economist on my lacrosse bus trips in college. I've just always been super fascinated by what's happening in financial markets and what is that telling us about where the world is going. I want to democratize access to that high-level information and help explain to every single person out there watching why what's happening in these complex markets matters for their lives today and in the future. That's what drives me. I love being part of this.
Listen to CNBC on the move with the CNBC app.
A lot of strong numbers this morning.
Breaking news.
We got a big IPO, something for the private markets. Could it be a rate cut scenario?
Real-time market updates.
A check now on how Europe is set to open the trading day ahead.
Your favorite programs live 24 hours a day.
Welcome to Squawk Box Europe.
Welcome to the China Connection of Squawk Box Asia.
Listen wherever in the world you are. Download the CNBC app now.
From the markets to the courts. Kick back and relax while we serve up the highlights. Tackle your weekend. CNBC Sports, afternoons on Saturday and Sunday, only on CNBC.
Testing it on. You know what this is.
It's the shot of you right now is so tight that nobody knows what you're doing.
I ask you, and what did you say?
Because now here it's a wide shot.
I gotta move my leg like that. That's Tony Monero, and his white suit is going to be up for auction. You already have one. Wait, so it wouldn't be any probably. Don't you? Do you have a
white suit? I don't own a white suit.
You know, okay.
Maybe I need to get.
You know what
suit.
else you could get? You remember the mosquito in amber in the opening scene of Jurassic Park? That is going to be up for auction for the first time ever. It's called Prop Store is holding its summer entertainment memorabilia live auction next week in Los Angeles. More than 1,700 pieces of movie and TV history with combined estimated value of $10 million. Join us now, Brandon Allinger, PropStore's chief operating officer. Did you have a monitor? Wasn't it obvious to you immediately do you have a monitor, Brandon, or no? Maybe you don't.
Yes.
But
yes. No, I knew.
So you knew.
Yeah, your acting is strong. Good job. Well done.
Very good. All right. How much is that one going to go for? Is that the most expensive piece that you
It's
think?
not the most expensive, but that's a big one. Yeah. That is the actual 1977 suit worn by John Travolta as Tony Manero in that film. It's incredibly significant just as a piece of Hollywood history. The fascinating thing about it is that the black shirt that you see there is actually stitched in to the pants at the waistline so that it wouldn't come untucked while he's doing all the great disco dancing moves. So this is coming to the auction for the first time in about 30 years, and some passionate collectors are very excited about the opportunity to potentially own it after they win it in auction.
I mean, even culturally, the ball from Saturday Night Fever, that it really kind of ushered in that whole crazy disco era. And I didn't realize how hard John Travolta had to train to do that, running 5 miles a day and lifting all kinds of stuff to get to that. But what else should we talk about that's interesting?
Well, I can tell you, it may be interesting to hear that the single most expensive item in the auction potentially is an original stop-motion animation model of Mighty Joe Young from the 1949 visual effects classic film, Mighty Joe Young. This is an incredibly significant model. I don't know if everyone has seen this film, but it is incredibly significant to the history of film overall and visual effects specifically. It's a stop-motion puppet, which means there's a metal armature inside of it that allows the animator to move the arms and the legs, the head, everything, one frame at a time. And this is the best surviving known example. There were 4 of these made for the movie. This is the first time that a complete one has ever surfaced, believed to be the only one still in existence. It was in the private collection for the past 50 years, coming to auction for the first time, and the pre-sale estimate on this one is $1 million to $3 million US at PropStore. So an incredibly exciting piece, this Mighty Joe Young puppet.
Hey, Brandon, for the kinds of things that you sell, would you say that the majority of people buying them are genuine fans of the particular film or the particular show or whatever it is, or that they think about this more as an asset class? We talk about this oftentimes with people who buy art, other people who increasingly buy different forms of collectibles, trading cards and the like. There's some people who are buying them because they love them, they want to display them, they have a real history with them, and others who look at it as a great trade.
Yeah, I mean, I think you're absolutely right. And, really, it's both. The answer is it's both, right? A lot of people who are buying from us, it starts with a genuine love of the material. They're incredibly excited to learn that there is an opportunity to own a little piece of Hollywood history, take something home and display it in their home theater or their home office. But obviously, no one is going to spend $200,000 to $400,000 on that white suit without considering the investment and the return potential. And historically, Hollywood memorabilia has been trending up. That people have seen some very significant returns, large multiples, as collector interest has grown, and really as just the understanding, the awareness has grown that you can.
Jack Torrance's axe, that might be good.
Yeah, that's a classic one. The interesting thing about this is it's lightweight. So it may look like a real axe, especially on camera there, but this is actually made out of a cast foam with just some little thin aluminum plates on the surface of the axe head here. The idea was Jack Nicholson could carry around for 8-10 hours a day on set without getting drained by the physical weight of a real axe. So we love things like that show you a little glimpse into the filmmaking process.
That wouldn't have worked on the door, though. That must have been a real axe to do that with.
I think you're absolutely right. Yeah, with film props and costumes, they always have multiples, and they would have had a real axe. I mean, I think he actually did chop through that door. So no foam axes there. You're absolutely right.
And then, poor Scatman at the end, right into the heart.
Yeah, and I think they had a special rig for that one where you were only seeing half of an axe blade, and then it's connected into a metal plate that's strapped around his chest, under his shirt. It's all the movie magic.
Hey, Brandon, I have one other question about the value of these kinds of collectibles as it relates to generations who know them and don't know them. And the reason I say this, so Batman obviously is this iconic character.
Mighty Joe Young.
That, no matter what generation you are, you would love, I imagine, or at least know and understand the sort of value proposition of it. But the reason I'm mentioning this is I was thinking about Larry Bird, the basketball player, had a basketball card that for a long time, during a certain generation, when he was uniquely popular, the card actually at certain points had higher values, and over time then didn't necessarily hold its value in the same way because the next generation was less aware, if you will. Do you know what I'm saying? And so how do you think about that?
No, it's definitely relevant. You know, I think there are things that sort of go through a cycle and a peak of interest, and you know, there's probably a core buying age and demo. At the same time, you know, the inverse of that is sometimes we're shocked by modern things that sell for as much as they do. You know, it used to be that six-figure numbers in this world were reserved for sort of blue chip properties like a Star Wars, maybe an Indiana Jones. But over time, we've seen more and more modern titles, comedies, you know, things like Will Ferrell movies with Mike Myers, or, you know, recent franchises like Harry Potter, where they're hitting very high price levels. And I think, you know, there are certain things that transcend time, like, say, the Mighty Joe Young puppet, where even if folks today may not be growing up watching this movie, there's a deep intellectual appreciation for the significance of this piece as it relates to overall film history. So I think anybody who's studying the history of film is going to have an awareness of this, even if maybe you're not buying it from a nostalgia place like you are a piece from, say, Star Wars.
Right. I don't think I want Johnny Depp's. Did Freddy Krueger's ever come up?
We have had the Freddy gloves. I think in this auction we have a Freddy hat. I don't think we have a Freddy glove, but we do have a nice Freddy hat. And of course, these are the Edward Scissorhands from the Johnny Depp film of the same name. Fascinating thing about these is most of these blades are actually cast out of rubber. And again, this is giving you some insight into the filmmaking process. You know, if he's wearing these things on his hands, you don't want him to hurt another actor on set. So a lot of the time he's wearing a simplified rubber version that's not going to poke someone's eye out, essentially.
Series, cancel.
All right, good luck, Brandon. I hope
Thank you. Auction's coming up soon. Next week at Prop Store.
Okay. All right, we'll be watching. Thanks.
Thanks,
guys. It's right at 7 a.m. on the East Coast. You're watching Squawk Box on CNBC. I'm Joe Kernan, along with Andrew Ross Sorkin. Let's check the futures after yesterday's slide. It was like a week ago, we were at about 7,800, 7,810 or so. Maybe it was Thursday of last week. You can see the S&P has had a tough couple of sessions, but could get back around 7,700 today. That won't be enough because it was down about 60 yesterday. Let's look at Treasuries. That's been the fly in the ointment, the wrench in the works, whatever you want to call it. You can see 470 now. On the 10-year, 524, even the 2 years is noteworthy, just under 4.2%. And energy prices back in the mid-80s on WTI, in fact, high 80s now, 87, with Brent up about 94. Bitcoin almost got to 80,000.
Yeah. The move in crypto giving that sector a nice boost this week. That's the good news. We're going to get straight over to Dom Chu with a look at this morning's pre-market movers. Dom.
That's right, Andrew. Joe, to your point here, let's talk about some of the moves around the crypto space. Bitcoin surge is continuing to close out the week with two major catalysts behind that move, which is a sharp pullback in those Treasury yields, although today notwithstanding. Also a push from the White House and the crypto industry overall to get that Clarity Act across the finish line in the coming weeks. As a result, Bitcoin price is 77,667 right now. That crypto surge is lifting names like Strategy, like Coinbase, Circle Internet Group, and others in that ecosystem, all up roughly about 5 to even 10% for Strategy, so keep an eye on those names. Meanwhile, Ross Stores is a retail winner after reporting earnings that beat on both the top and bottom lines. The discount retailer boosted guidance for the quarter and the full year on growing demand for that off-price retail merchandise. That higher demand, the company says, is coming from both new and existing customers. Ross Store shares up 8% in the pre-market trade. And then let's end with Broadcom, which is pointing higher right now to the tune of 0.75% on reports of a new debt deal. According to a Bloomberg report citing people familiar, the chip giant reportedly is seeking $60 billion in new debt to help fund their AI build-out, with the deal possibly raising as much as $100 billion. Now, Broadcom, like other chip makers, is using debt to raise capital they can use to deliver for customers like Anthropic, other hyperscalers as well. So Broadcom in the news this morning. Andrew, I'll send things back over to you and Joe.
Okay, thanks, Dom.
You got it.
The Kansas City Fed's annual Jackson Hole Economic Symposium kicks off next week. Steve Leisman joins us with a look at the issues on the table and the expectation for Kevin Warsh's Jackson Hole debut as Fed chair. That'll be a switch.
Yeah, it'll be a new chair there, given the keynote speech on Friday. And markets seem likely, Joe, to get somewhat more from the new Fed chairman next week in Jackson Hole on the outlook on the economy. It's more than gotten from him from Washington. The chairman, meanwhile, faces new challenges when it comes to what's happening with bond yields. Expectations for the new Fed chairman in his first keynote include more detail on his economic views and the rate outlook, task force updates, and maybe a clear statement on his inflation reaction function, trying to dispel any notion that he really is dovish at all. It would make sense for Warsh to make the distinction between how much he talks about after a press conference where he's speaking for the committee and how much he says when he's on his own and how much he gives when he's speaking for himself. Many in the market, of course, are hoping for more.
I just think we need to know the reaction function. I just think we need to know, what are you looking at? What is important to you today? Is it more inflation? Is it more employment? Are you looking at, by the way, there's a series of indicators in employment. Are you looking at demand, supply? Are you looking at a whole series of different indicators? To get some clarity on that, then markets can do their job in interpreting it and putting a price on that.
John Hartley, policy fellow at Hoover and economics professor at UT Austin, telling me, quote, my guess is that Jackson Hole will tilt toward being a hawkish event as the FOMC is moving towards trying to tee up rate hikes in late 26 and 2027. The conference this year focuses on financial innovation and the effects on banking, monetary policy, along with the global financial system. But the unofficial agenda is going to be probably these rates and what the Treasury has done and whether it does or does not involve the Federal Reserve, Joe. Our full coverage, including newsmaking interviews we have from Jackson Hole. It starts on Wednesday with a special edition of the CNBC Fed Survey live from Jackson Hole. Joe?
I know you dread that every year, Steve. Fly fishing and, nice weather where it's not humid and the Grand Tetons and everything else. Just hang in there, buddy.
Well, that is true, Joe, but I will point out they've had a bit of a drought out there out west, and so I'm a little concerned about the fishing. You want to know an interesting fact, Joe? When there's a drought out in the west, especially in Idaho, the Snake River in Jackson runs high because they're contracted to ship river over the mountains to Idaho. So that's going to be an issue that I'm personally going to have to deal with, and I know you'll feel some sympathy for me on that regard.
I do, and we had a moment out there together, if you recall. It was bizarre.
It was an excellent moment.
It was.
Yeah. Yeah.
We at the same place, at the same nice club. And I was surprised to see you there.
I was very happy to see your family, Joe.
I know, and I was happy to. That was nice. That was a nice moment, Steve. We don't do it enough. We don't. But we missed you, Joe, during this. What do you want to call it? Bond battle of Bessent versus the market. I know.
It's been interesting. And you know what else is interesting? I'll tell you, having done this, I think for a couple decades now, gone out to Jackson Hole, is how something always comes up in August that becomes the thing that is not the thing they go there to talk about, but becomes the thing. And I think it's going to be very interesting. Obviously, Kevin Warsh and how he speaks, I think he's going to give us a little bit more than he has in the past. I think we can expect that. I think that's important. But also, the relationship of the Fed to the Treasury is something Kevin Warsh has thought a lot about and has different ideas than other people, than other Fed chairmen, and maybe even other members of the FOMC. So it's going to be something we're going to be talking about and thinking about. And of course, the outlook is very important. It feels like we've gotten distracted from talking about the economy and whether or not what's happening with the bond market is a reflection of accelerating growth out there, which is something we'll see how the Fed chairman characterizes these bond yields.
Trying to remember who was it that demanding to know what Warsh and Trump talk about. This is not new that the presidents and Fed chairs talk. Did you see that? It was in the last couple of days. Someone in Congress.
I think Democrats have asked Warsh for detail. Warsh for detail about
what you have for lunch.
Conversations.
Do you have an appetizer? Do you have the creme brulee? All right. Thanks, Steve. And have fun. You deserve it. Before we head to break, President Trump just posting on Truth Social. Here's what he said. Today, I concluded a deal to substantially lower the price of ground beef for working American families. As everyone knows, under President Biden, beef prices soared at their fastest rate, and the American beef herd fell to its smallest size in modern history. As we work to rebuild this herd and help our ranchers, for the next 90 days, the United States will allow up to 300,000 metric tons of product for ground beef to be imported with no out-of-quota tariff. We have a commitment that this beef will be sold at 25% below current market prices. The deal will reduce prices for Americans while giving space for our great American beef herd to grow again. Thank you for your attention to this matter.
Coming up, the debate over the California wealth tax. It's picking up more steam. It's one of the big tech topics we're going to get to with VC investor Ben Harrison. We'll do that next. Squawk Box coming right back.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
This is not just good content, this is good business.
It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
I'm with Becky. This is the greatest show on earth.
Squawk Box, streaming on CNBC Plus. Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
Fast Money is America's post-game show.
Near all-time highs against the S&P.
We want to arm people with the information to make great decisions.
Valuations matter in a higher interest rate environment.
Fast Money, CNBC, streaming on CNBC Plus.
Welcome back to Squawk Box. A debate about Proposition 40, that proposed wealth tax in California, playing out online and right here on our set. Joining us right now to weigh in is Ben Harrison. He's the founder of Tenacity Venture Capital. Good morning to you. You've seen Mark Cuban's comments. You've seen Bill Ackman's comments. You've seen Palmer Luckey's comments. Ro Khanna, obviously, on the other end of this. And I think we're all trying to figure out, A, what ultimately happens in California, but maybe more broadly, what happens across the country. if some version of this passes?
So this one won't pass, but the next one probably will. The reason for that is this was orchestrated by the second sleaziest group of humans on the planet behind politicians, which is a union. And only one union was involved, and they will get most of the benefit. They wouldn't let the other unions play, but when they fail this time, they'll let the other unions play, and then it'll be almost impossible to defeat. And it'll be tragic. One of my LPs reached out to me when it was first announced and said, should I be worried? And I was like, I didn't know you were a billionaire. He said, well, I'm not. But I'm worried this will drive innovation and entrepreneurship out of California. And he is dead right. This is the first time that the preeminent position of Silicon Valley as the innovation hub of the planet has been at threat. No other country has been able to do it, no other state, no other city, but now we're going to create self-inflicted wounds to drive out the entire ecosystem that feeds the success that is a majority of our economy, as far as I can tell.
Let me ask you a different question, though, which is clearly there's a shifting opinion in at least parts of the country around wealth, around affordability, around all of these issues. And the one thing that people in the industry, in the Valley and elsewhere, haven't done is say, you know what, there is low-hanging fruit and things about our tax system that don't make sense. Whether it's carried interest, you may disagree with these kinds of things. We can debate them. Dave Freeberg, who's on the All In podcast, has suggested that we should have higher capital gains rates for people, perhaps at certain types of numbers that match closer to things like income. You may be against that, but there are things that I don't know where you are on a 1031 exchange. I don't know where you are about people taking loans against their stock and then not paying taxes effectively. So
that's the trickiest one, I think.
Well, but the question is whether the answer to this, and nobody seems to be engaged in this conversation, is to say, look, we shouldn't be taxing unrealized gains creates all sorts of truly perverse incentives, right? But there are other things that we could do to raise funds. And by the way, part of it is we need to raise funds. Part of it is we need to cut costs. And whether you can actually have that real conversation. But it seems to be that either people say we should only be cutting costs on one side, don't raise taxes on the, and the question is whether that is a long-term solution.
Okay, so first with the basic premise that Silicon Valley wealthy have not proposed other alternatives, I don't think that's fair. I think you just talked about Freeberg's discussion, there should be higher capital gains. Somebody else put forward that anybody that makes under, say, $150,000, no tax at all.
Jeff Bezos has made that comment.
Entirely supportive of that. Look, the top 1% pays 50% of California's tax income. Here's the other issue, though. California is not a good steward of our money. I would be perfectly happy to have a logical conversation about how taxes should be reorganized if I thought something useful would be done for it. We had a $95 billion surplus less than 5 years ago. They blew through it and more, reset the baseline. It was a one-time gain, and they spent it like it was an annual. What do you think's going to happen? If you hire an extra 100 people on this set, because you had a one-time bonus because I dropped $100 million on the table, and then next year nobody comes along and drops $100 million. Ooh, woe is us. We don't have any money to spend? Horrible. We approved $33 billion to build high-speed rail. We spent $15 billion in 18 years. 0 miles of high-speed rail. In the same amount of capital spent, Elon put a reusable rocket into space and brought it back and caught it.
But and we're at 24% spending now. We're usually at 20. And we raise the same amount, 18 or 19%. So you can say, well, we could talk about something, but all the heat and all the energy and all the discussion is about raising taxes. At the same time that one side is talking about Medicare for all. So there's no genuine impetus to try to cut the 24% that we're spending. That's where the problem, that's why we're at 40 trillion. And working around the edges and its fairness and all these fat cats with their yachts doesn't even raise any money. Right, but look at
Look at the cutting problem. The cutting problem.
You have to do it.
But look at what happened with Doge. Didn't happen. Look at what's happened to our military budget. Look at all of the things, by the way, that this administration has talked about.
Medicare fraud. Look at what's happening with Medicaid fraud. Look at what's happening. And you read about it anywhere?
They are catching some of it. They are starting to do so. In fact, I have a company involved in this right now where it's not as high profile as Doge was, but they're just using data to tease out where actual fraud is happening.
By the way, we should be doing that. I'm not suggesting we don't do that at all.
The Journal today is about Bill Clinton reformed welfare. It's back with a vengeance. And these at this point, you can sit at home and make $55,000, $60,000 a year.
But we also have just doubled our defense budget practically. So
Well,
just think about
there might be a good reason for that.
And maybe we need to. But look, for a very long time, we talked about, Republicans, by the way, talked about bringing that number down, not up. So
it doesn't matter who's in power. Whoever isn't is mad at whatever the people there are doing. I mean, I've become so disenchanted with our political system. It's the best in the world, but it still sucks. And, you know, we do spend like crazy with no effect.
Do you think we're at a breaking point? I mean, part of this question is around the bond market.
Well, the bond, it's been wild to watch what's been happening there, and then they tried to fix it, and of course that didn't appear to work, right? Because it, you know, one day blip. Somebody said, Band-Aid on a bullet hole. I thought that was a great quote. I don't think we're at a breaking point. You know, first of all, California is a very large state. What is it?
You're talking about California. I'm talking about the country.
Yeah,
country we just heard that's what 70% of GDP, whereas you know what did Britain get? He said it got to 270%. Japan's
yes, and that's a disaster,
right? So it's Japan.
But we can't accept that as where we want to be.
But it doesn't mean we're close yet.
So one of the things that was interesting to me when I was looking at the historic reality in California, $95 billion deficit. $95 billion surplus. Why? Taxes. Taxes on capital gains and other income from great IPOs and other companies. We're about to go into the largest creation of wealth across many, many, many human beings through the IPOs that will happen this year and next. And yet, California is actively trying to drive those exact human beings out of the state. The number of people I know and that I've been exposed to that have moved to Austin, Florida, Incline Village, Nevada, where I actually lived for several years.
Nevada.
It's crazy.
Nevada.
Right?
Nevada.
So, you know, why would you, to do this now, this is all pablum for the proletariat. This is just bribing voters to keep your seat. I don't think any of these politicians like Ro Khanna are actually as stupid as would appear from trying to do things that have never worked. I mean, your own, you know, political group here is trying to push socialism through. What was it, Thomas Sowell that said socialism is a concept so utterly and totally failed that only an intellectual could defend it? Zero success. I don't think these people are stupid. I think they are sly, and I think it's how they buy votes, and it's how they get people to believe maybe this person will help me. Now, yes, there is a huge spread between the absolute dollars of rich and poor. However, the overall affluence and just benefit provided to people on all income classes is higher than it has ever been in all of human history.
And so how do you explain what's happening not just in California, but in all sorts of parts of the country as we're seeing the DSA, whether it's here in New York, whether it's in Ohio, whether it's in
I don't
Michigan?
get it. I think it's youthful optimism. My favorite quote about politics is, if you're not a liberal when you're young, you have no heart. And if you're not a conservative when you're older, you have no brain. And right now, my own youngest son thinks Mamdani is great. And I want to ask him why, but I really don't want to get into that fight. This is, you know, it's just, hey, here's money for you. Now, that money's never going to come, but you can promise it and get elected. This is time eternal. Politicians have lied about what they're going to do so that they can get elected and then not do it. I mean, Roe's an interesting example of this, because here he goes out and he solicits money from the affluent tech class of Silicon Valley, and then totally and completely betrays them, and then they negotiate with them to try to get him back to where he was.
I don't disagree with that, but then the other issue is, here we are at a time when the economy is growing as much as it is, and we are running massive deficits. And so then, and by the way, the entire Washington apparatus is run by one party right now. One party. So you have to say to yourself, there has to be some introspection about how is this possible? How is it possible that the people who have argued that they are supposed to be responsible, that they are the responsible party as it comes to economics, that we are now in a situation where the economy is growing as much as it supposedly is, and yet we are running the deficits we are?
That is challenging. And, you know, while one party's in charge, one person is disproportionately in control of that party. And I would say the word introspective is not in that human being's entire history of life, and will not be until the day he dies. So it's tough. I mean, I think everybody likes to tax and spend at different levels. We are in a tricky position here with this massive deficit, with just a crazy amount of bond issuance. I mean, I made one trade ever in the blockchain space in 2014 and decided not to play. Decided it was purely speculative, and I'm not a speculator. I'm a long-term investor. I would rather follow a Buffett model than a Soros model. But within the last year, I've bought a variety of different crypto-oriented assets because I'm very, very, very concerned with inflation. The scoop of ice cream I bought as a teenager is now 8 times as expensive. I try to explain to my kids how inflation works. I paid $1 for Haagen-Dazs, high-quality ice cream when I was a kid, and today I pay $8 for a scoop of gelato in New York City. That's inflation. It's crushing. So, look, if these things were fixable, they probably would have been fixed, although I don't know that the politicians that we have or any that we'll ever get will be the ones to fix it, because there's very few politicians that are there for the right reasons.
Ben, I want to thank you. Appreciate it.
Thank you.
It's a longer conversation. Joe?
Yeah. Coming up, using AI to enhance mental health care, we're going to speak with the CEO of teletherapy platform Talkspace about using technology to support patient care. The company was just acquired by Universal Health Services. Squawk Box returns in just a moment.
From the markets to the courts, kick back and relax while we serve up the highlights. Tackle your weekend. This weekend, race to your screen. The adventure continues. Dive into the action with CNBC Sports. CNBC Sports, afternoons on Saturday and Sunday, only on CNBC.
All right, let me tell you about ambition. To me, too much is not enough. You have only one life, so go all out. The only way you're gonna accomplish all the big goals is if you have a vision. Find out what you want to do, set the goal really high, and go all out. And then you create another vision, and another vision, another vision. So that's being ambitious, be useful. That's what my father always said. Don't just waste this life away. Be useful, help other people. This is what it's all about.
Become a smarter investor with CNBC Pro. 24/7 access to market-moving news and interviews with 3 global live streams. Subscriber-only content from Wall Street pros like Josh Brown.
If you love the stock market as much as I do, you're going to love the best stocks in the market list.
Plus exclusive live events.
This is my first time at the stock exchange and it's been awesome.
To be on the floor, I just can't believe I'm here.
Become a CNBC Pro. Go to cnbc.com/GoPro now.
In this CNBC Explains, we explore why Asia is leading the global IPO market.
We have a really big year for IPOs with SpaceX, OpenAI, and Anthropic, but analysts are pointing out that there's much more volume here in Asia.
And we look at how South Korea's AI chip boom is spilling into the housing market.
In Korea is a reflection of what people consider as their safety net, as well as a symbol of success.
The show that explains the why behind the headlines, only on CNBC.
The day's top stories driving Wall Street. Up-to-the-minute developments. Kelly Evans, Brian Sullivan, Power Lunch, streaming on CNBC+.
Hospital and healthcare manager Universal Health Services completed its acquisition of teletherapy platform Talkspace. That happened this week. Talkspace has been leveraging AI to fill gaps in the mental health care system. Joining us now, Dr. John Cohen, CEO of Talkspace. You were around before AI, and this is helping your business do more. But can you just give us a quick rundown of exactly how Talkspace works and what needs it addresses and how?
So Talkspace is right now the largest in-network provider of mental health support in terms of being in network with 220 million Americans, including Medicare. So that was the big change for Talkspace about 5 years ago, so that it no longer became just a commercial product, but it became a fee-for-service product. That's what fueled the growth of Talkspace.
And it helps people how? So they would... on the telephone?
So we provide virtual services only. That could be texting and messaging. Talkspace did most of the original research to prove that you could text and message people to deliver therapy. The majority now is virtual, face-to-face, virtually. And then we do also phone calls. But the majority, 70% now, are virtual visits.
The AI segment. So I could have if I'm lonely, I would think AI companions might be part of the problem, not part of the solution. There's a way of doing it where it's part of the solution, where it doesn't make things worse. I don't want to get dependent on... Claude's very nice to me at times. There's other times he blows me up, so I understand.
So T, which is the Talkspace developed, it's an AI agent, companion, unlike large language model chatbots that are supported by large language model models. The T is actually specifically developed, one, to be safe. It was also developed by mental health clinicians with oversight and things we call red teaming to prove that it actually works, so that it would deliver an agent that you could have available 24/7 to navigate life's daily problems. The problem, as you probably know, is, let's say 800 million people are now using chatbots weekly. 40% of those searches are healthcare related, and half of them are mental health related. So that means 150 million people a week are using chatbots for daily problems that are coming up with them. The problem is that they were never designed that way. They were never supposed to be developed and designed to deliver mental health. And as you reported, mentally people reported, the results have been, in some cases, disastrous. T was purposely developed by Talkspace to address that issue, to develop a safe model through a bunch of 4 different significant differentiators compared to everybody else that will make it easier to use and safe to use. So what we did is, first, the model was trained with our database. Talkspace has probably at least one of the largest mental health databases in the country, 8 billion words, millions of interactions. It's anonymized, de-identified, consented data that we use to train the large language model. That was first. Second, it's HIPAA compliant or HIPAA type compliant. Most people don't know when they're talking to a chatbot, that information is out there. We designed it specifically, like we did as a healthcare provider, to be HIPAA protected. Third, and probably as important, is Talkspace back in 2018 reported on the first suicide algorithm, proprietary algorithm, that actually could identify, based on the conversation, whether or not a patient is at risk for self-harm. We've subsequently developed algorithms for homicide and violence, prediction of substance use, prediction of being abused at home, and 5 other big clinical entities, including psychosis and OCD, hallucinations, eating disorders, etc. The reason that's important, that's been in use by Talkspace as part of its platform. We now use it in the AI platform. The reason that's important is we now know what's happening on the platform. We have clinical oversight. We call people in the loop, clinicians in the loop, that are monitoring all the AI conversations. If there's an issue, a risk alert goes off, we make a decision, real or not real. Do we need to intervene? Does a clinician need to take you off the platform? Or do we need to actually refer you or actually do a wellness check, send the police? So it is truly a safe model that's been developed, and it's the only safe model that's out there.
So technology, we complain a lot that it's part of the problem. You think in this case it could be part of the solution?
So I like to tell people...
Net, I think we're still losing. Social media and everything else, that's why we're in this mess right now. That's why people need, how many young women have, I heard the teenage women have considered suicide. It's like this ridiculous number that I can't even get my head around.
So just to address the suicide, since we put the suicide algorithm in place, we've had close to 60,000 alerts, right? That's since 2018. We have a program, we run the largest mental health support program for teens in the country. 500,000 teens in this country have access to Talkspace for free because of our government contract. Since we've put that in place, we've had close to 1,000 moderate to high-level suicide alerts, just to give you an idea of the suicide thing. So let's go back to the chatbots. The genie's out of the bottle. You know, I like to say, horses left the barn, trains left the station, whatever you want to say.
Toothpaste is out of the
Okay, whatever metaphor you want to use, you're not going to stop this. Our issue, though, is if you're going to use it, and people use it, we're talking to psychiatrists and therapists every day who are saying, after my session, the patient's coming back to the next session and say, oh, by the way, in between my session, I'm using X chatbot. Our plea is to develop a safe model that sets a new standard so that you use a safe model if you're going to use it in between. You're not going to stop it. The question is can you develop, which we did, a technology solution that'll help in between sessions or when you're going to use it. And quite honestly, the results have been fairly remarkable. We did a beta test of 2,000. We now have about another 10,000 people who are using the AI agent. And it's been really interesting. So what do people go on for? They go on for relationships. Or I wake up in the morning, I had an argument. I'm upset about my child in school. You know, something is going on that's really bothering me at work. So one, it's relationships. Second, anxiety, depression, and a fair degree of stress. Low self-esteem. The other is compulsive behavior that's stigmatized. So what do I mean by that? A lot of people nowadays are found it acceptable to see a therapist. It's no longer as much a stigma that used to be 20 years ago. Mm-hmm. The problem is that there's behavior that you won't tell your therapist. So first off, we found that men are much more likely to use an agent than women. Women are much more likely to use live therapy than an agent. Having said that, there's a fair amount of stigmatized behavior that occurs.
Is it problems with relationships at work?
Well, yeah, so my question is...
were you going to ask about me? Or
when I talk to, you know, my wife jokes, you know, you're talking to your girlfriend, Claudette. You know, my question...
Oh, Claudette.
Claudette, as in Claude, right. So my question is, how different, and I will ask it, I will ask large language models all sorts of questions.
About self-esteem?
How to deal with this, how to deal with that.
You've never asked about me.
How do I deal with Joe Kernan today? How am I going to deal with Joe Kernan? I have to ask that's every day, actually, like on the hour. And so the question is, how different is the reaction that I might be getting from one of the models different than what I'd be getting from you?
Highly significantly different. Okay. First off, it's trained in mental health to deal with the issues. You know, mental health therapy there's a reason people are licensed, the reason why psychiatrists are trained to figure out how to deliver it. So the answers you're going to get, what you're not going to get from T is the delusional pathways, the hallucinations, the bad results that happen. You know, I like to say it's mirror, mirror on the wall from Snow White. You know, it's the cracked mirror syndrome. Like, you don't want something to continue to validate something, that you want to be in reality. Right. The problem people have is they go down the delusional pathway.
Okay. Thank you.
Yeah. Doctor, thank you. And we're seeing it played out in real time with this crazy... now it's a metaphor for all that's wrong with the mental health. Instead of the poor kids that are strangled, we're now thinking that it's not her fault. It's bizarre what we're seeing.
The good news is there are people who have cancer, postpartum depression, they have weight loss, they have financial concerns that are going on to these chat agents.
Right. Well,
and the answer is
maybe it's a big gap.
Answer.
Right. Okay.
Just so you know, I just asked it because on the hour I asked. I say, how can I handle working with Joe Kernan?
Yeah.
That's what I asked Claude or Claudette. It says the Sorkin-Kernan dynamic has always worked on air precisely because it's genuine friction. Viewers can tell neither of you is performing disagreement.
Performing in other words. So it's real.
It's real. It's real.
So that you were hoping for.
It's much longer because it says if there's a specific
I'm going to ask about you.
We can do
you should ask T.
Yeah, I'll ask T. Thank you. From Talkspace to SpaceX, the stock falling 4% yesterday. That came in more than $300 million as SpaceX shares unlocked for trading. About 7% of the stock owned by early investors and employees. We're going to speak to an analyst about the stock in the next hour. Don't go anywhere.
The gold is reaching 50%
you can
on
master
daily
your
chart.
strategy, but performance could be limited by your instrument. Precision trading starts with the right instrument. Over the past
The
3
gold
years,
is reaching
Interactive Brokers
50%
clients
on daily chart.
outperformed the S&P 500 on average. Like returns, trading costs compound. Interactive Brokers is built to lower costs.
The gold is
through
reaching
smarter execution.
50% on
Access
daily
stocks,
chart.
options, prediction markets, and more across 170 plus global markets. The best informed
The
investors
gold is
choose
reaching
Interactive
50%
Brokers.
on daily chart. The gold is reaching 50% on daily chart.
The Exchange, streaming on CNBC Plus.
Welcome to Closing Bell Overtime.
Get the essential post-market edge.
A very busy overtime.
After-hours action and opportunities.
The economic impact is just beginning.
What happened today?
The market had to resort to defense.
We've got a developing story out of Washington.
What's moving in real time?
What do the numbers tell you, pro or con?
Be ready for tomorrow after the bell.
There's a wait and see about a lot of things for tomorrow, Mike.
Completely.
Melissa Lee, Mike Santoli, Closing Bell Overtime, CNBC.
I built a legacy on the court, and now is the moment to build a legacy outside of the court. My main investments are in hospitality, in education, and sports. So I believe that's the future. I see my brand as in a growing perspective, and in some way building this new chapter.
You'd been managing a very rare condition in your foot for much of your career. At what point do you think you seriously started to think about life beyond tennis?
You need to have goals. I think it's very important in this
See
life
my brand
to
as in
have
a
goals
growing perspective and
ahead of you,
in
because
some
that
way
helps you to
building
wake up
this new chapter.
every day
You've been managing
with
a very
motivation and
rare
passion.
condition
I
in
knew
your
since a long
foot
time
for
ago
much
that
of
I
your
wanted to keep
career.
doing things
At what point
and
do you
learning
think you
after my tennis
seriously
career. I have two small
started
kids,
to
and
think
that's the most
about
important
life
thing in
beyond
my life, without a
tennis?
doubt. But
need to
I
have
like to
goals.
work.
I think it's
That's how
very
I
important
understand
to
this.
see my brand as in a growing perspective and ahead of you. In some way building and passion. I want to keep doing things.
Can call home.
Series. Countdown 50 minutes.
Rain falls gently on a Delta town tonight. Street lights flicker in the fading light. Old men drinking slowly at the bar, talking about dreams that never got far. Smoke rises softly through the quiet room, like tired flowers trying hard to bloom. And Every lonely blues song on the radio sounds like somewhere I used to know. Rain on the Delta tonight, cold against my skin, like old broken memories coming back again. Oh Lord, hear my cry underneath this southern sky. Every love I lose turns into these blues. My guitar rests heavy against the wall, like it already knows the rise and fall of every lonely soul that passes through, searching for something real and true. Wind moves softly through the pinewood trees, carry no forgotten melodies. And somewhere down the darkened railway line, another lonely heart is losing time. Rain on the Delta tonight, slowly washing through like muddy river water, pulling me from you. Every road I roam, every dream I chase, still leaves these old blues written on my face. Smoke hangs heavy in this old blues bar. Street lights shimmer from passing cars. Bartender pouring another round slow as old train whistles echo below. My guitar hums with a tired sound, like a lonely soul still wandering around. Every broken memory comes alive tonight, under neon glow and candlelight. Smoky Delta night, burning low and warm, like an old blues record spinning through the storm. Every lonely mile, tap softly on the window pane, trying hard to wash away the pain. But every melody still calls your name, and every midnight feels the same. Southern wind moves through the trees so slow, like secrets only lonely hearts know. And somewhere far beyond this town, another tired sun is going down. Smoky Delta night, hold me till the dawn, like the last old memory before it's gone. Every road I ride, every dream I chase, still leaves your shadow in this empty place. Cold wind blowing through the Delta night, rusty street lamp barely shining light, old six-string crying by the motel sign, like a broken prayer lost somewhere in time. River keeps rolling dark and slow, carrying secrets only drifters know. Every heartbeat echoes through the rain, like an old freight train full of pain. These crossroads after midnight keep calling out my name, through empty southern highways and neon-colored rain. Oh Lord, can you hear this old guitar and feel every road I ride leaves another scar inside. Bartender wipes the dust from empty glass, watching lonely shadows slowly pass. Jukebox humming low in the smoky air, playing songs for souls beyond repair. Moonlight falling on these worn-out boots, while silence hangs beneath the roof. old home. Train wheels crying near the riverside like the ghosts of dreamers left behind. Smoke keeps dancing underneath the blue, while this old world keeps breaking in two. These crossroads after midnight still pull me through the storm, like distant thunder rolling before the night is gone. Oh Lord, stay near tonight beneath this fading light. Every dream I knew turns back into the blue. Standing at the crossroads, late at night alone. Cold wind blowing through flesh and bone. Street lights trembling underneath the rain, like tired hearts learning how to break again. Oh, black guitar hanging by my side, full of songs I've always tried to hide. Every mile behind me feels the same. Every broken town still knows my name. Crossroads, midnight blues, calling out my soul, like a dark old river, too deep to control. Oh Lord, hear my prayer floating through the southern air. Every road I choose leads into these blues. Smoke drifts slowly through the neon light, while lonely strangers drink away the night. Bartender says some wounds don't heal, and tonight I finally know how that feels. Train tracks humming underneath the storm, like tide ghosts trying to stay warm. And every note my guitar softly cries feels like one more beautiful goodbye. Crossroads, midnight blues, hold me till the dawn, like a fading echo of an old sad song. Every dream I chase, every love I lose, still leaves me standing in these midnight blues. Delta moon hanging low above the river tonight. Silver reflections dancing in the pale light. Old wooden porch creaking underneath my feet, while distant thunder rolls through the summer heat. My cigarette burns slow beside this rocking chair. Southern wind moving softly through the air, and every lonely cricket singing in the dark feels like another memory inside my heart. Delta moonlight blues, soft and low tonight, like an old forgotten prayer floating through the night. Oh Lord, hear my soul trying hard to stay whole. Every road I choose leads back to these blues. Rain clouds gather slowly over county lines, like old regrets buried deep in time. My guitar hums with a worn-out sound, like a tired man still drifting around. Oh, radio playing from the room inside, songs about lovers who never survive. And somewhere far beyond the river bend, another lonely night begins again. Delta moonlight blues rolling through my veins, like muddy southern water after endless rain. Every dream fades slow, like smoke beneath the moon. Still singing these blues to an old forgotten tune. breeze blows softly through this tired southern town. Old pickup trucks and faded signs breaking down. Neon buzzing outside the corner store, like memories I can't escape anymore. My boots feel heavy from these endless miles. Too many heartbreaks hidden behind smiles, and every cigarette burns slower tonight underneath this lonely yellow light. Dust and bones blues running through my soul, like an old black river nobody can control. Oh Lord, can't you see what these old roads did to me? Every dream I lose turns into dust and blues. Old bartender says the night's still young, but these tired lungs have sung enough songs. Train whistles echo somewhere far away, like ghosts begging me to stay. My guitar strings hum with a cracked old sound, like a worn-out man still drifting around. And every note beneath this southern sky feels like one more slow goodbye. Dust and bones blues, heavy as the rain, like cold scars hiding deep beneath the pain. Every road I ride, every town I choose, still leaves me stranded with these dust and blues. Midnight train rolling through the rain, steel wheels crying like human pain. Coffee grows colder beside my hand as I watch the storm move across the land. motel glowing beside the road. Another lost town carrying heavy souls. Old radio singing soft and low, songs about places I'll never know. Lonely train blues tonight, rolling through my soul like an endless highway, with nowhere left to go. Oh Lord, hear that sound as the rain keeps falling down. Every passing tune sings these lonely blues. Dusty suitcase lying by the door. I've seen too many towns before. Every neon light starts looking the same. Every heartbreak carries your name. My old guitar still understands the things this world never planned, and every chord beneath the moonlight sky feels like one more long goodbye. Lonely train blues tonight, slowly drifting on, like the whistle of a train just before the dawn. Every road I take, every mile I lose, still leads me back to these lonely blues. Rain keeps falling on the Mississippi road. Old guitar singing like a weary soul. Smoke from my cigarette fades into the night, while neon shadows dance beneath the pale light. Cheap whiskey burning slowly in my chest, trying to calm a heart that never rests. Every passing train sounds lonely and low, like memories from a life long ago. These midnight river blues leads back to these blues. Dusty boots walking through an empty town. Every lost soul keeps looking down. Oh, jukebox crying in the corner bar, playing songs for hearts left scarred. Through the southern trees, like ghosts whispering old melodies. And every note my guitar plays tonight feels like holding on to fading light. These midnight river blues run deeper every year, like thunder in the distance, slowly drawing near. Oh Lord, hear my cry beneath this endless sky. Every dream I lose turns into these blues. Neon signs glowing through the midnight rain. Every small town highway starts to look the same. Cheap whiskey bottle resting by the sink, while lonely hearts sit quietly and think. Old jukebox humming in the corner bar, playing songs for people carrying scars. Smoke hangs heavy underneath the light, like broken souls hiding from the night. Neon whiskey road, take me far away, past the empty bars, memories that stay. Feels home. Every road I choose turns into these blues. Scream about all the things that could have been. Train tracks shining underneath the storm, like old ghosts trying to stay warm. My guitar keeps singing soft and slow, things this world will never know. And every chord beneath the southern sky feels gently on a Delta town tonight. Street lights flicker in the fading light. Old men drinking slowly at the bar, talking about dreams that never got far. Smoke rises softly through the quiet room, like tired flowers trying hard to bloom. And every lonely blues song on the radio sounds like somewhere I used to know. Rain on the Delta tonight, cold against my skin, like old broken memories coming back again. Oh Lord, hear my cry underneath this southern sky. Every love I lose turns into these blues. My guitar rests heavy against the wall, like it already knows the rise and fall of every lonely soul that passes through, searching for something real and true. Wind moves softly through the pinewood trees, carrying old forgotten melodies. And somewhere down the darkened railway line, another lonely heart is losing time. Rain on the Delta tonight, slowly washing through like muddy river water, pulling me from you. Every road I roam, every dream I chase, still leaves these old blues written on my face. Smoke hangs heavy in this old blues bar. Street lights shimmer from passing cars. Bartender pouring another round slow as old train whistles echo below. My guitar hums with a tired sound, like a lonely soul still wandering around. Every broken memory comes alive tonight, under neon glow and candlelight. Smoky Delta night, burning low and warm, like an old blues record spinning through the storm. Every lonely mile, every faded sign still brings me back to the ghosts inside my mind. Rain taps softly on the window pane, trying hard to wash away the pain. But every melody still calls your name, and every midnight feels the same. Southern wind moves through the trees so slow, like secrets only lonely hearts know. And somewhere far beyond this town, another tired sun is going down. Smoky Delta night, hold me till the dawn, like the last old memory before it's gone. Every road I ride, every dream I chase, still leaves your shadow in this empty place.
About private credit and some of these funds. It's all about blue owls. But the truth is, it's increasingly about gray swans. And the question about whether or not NVIDIA is one of those gray swans, if not the biggest one. It might be the X factor in the entire thing, connecting everything together, because this is no longer just about private credit. Private credit is where it started. And what private credit is signaling now, along with what's going on in NVIDIA, is the downside potential of the downswing in the credit cycle. The credit cycle is the X factor, and NVIDIA is the gray swan, which ends up being the X factor for the X factor, which we need to connect all these things together, as increasingly Wall Street and some of the marketplaces and even the media is starting to do. Again, huge behavioral change this year versus last year. Escalation has led to behavioral changes that now people are asking questions that should have been asked years ago, but demanding answers and not liking what they're uncovering, because in many ways, and a couple of different ways that we'll go through here, it looks entirely too familiar to the last two cycles that we went through, one in the stock market, one in the debt market. This one has them both. Many people might have seen this that came out in the Wall Street Journal a couple of days ago. It's sort of a graphic that shows just how much money is being thrown around here. And first of all, how we can't necessarily track it in the way that's, typical accounting standards and typical accounting reports that come out, or accounting numbers that get spit out every quarter. So another common trait with the 2008, I don't want to make too much of 2008, but off-balance sheet behavior has become a huge part of the AI bubble, bust, credit cycle, everything that's going on here. And so I thought the Wall Street Journal did a really good job of putting together at least part of it. This is only part of it. In many ways, it's the tip of the iceberg. I love the shape here because it fits. The tip of the iceberg, that's the tip of the iceberg, that's the tip of the iceberg. There's a lot of money being thrown around that is not necessarily seeing the light of day because of how these things are structured and worked out. So it's imperative now to at least understand the general framework, which is what we're going to do here, so that we can determine, or at least understand, why we're talking about NVIDIA as a gray swan, and why the market is starting to price the same potential. If you're not familiar with the term gray swan, Nassim Taleb came out with the term black swan many, many years ago as an analogy for things that are, unexpected, unknown unknowns that, we don't see it coming. And many people believe that, asset bubbles tend to be popped by black swans, when the truth is it's more of a gray swan than a black swan. And a gray swan, a true black swan, is something that's there that nobody knows it's there, then all of a sudden it shows up. And we didn't think it was possible because nobody had ever observed it before, therefore it's a black swan. A gray swan is somewhat different. It surprises most people, and this is usually the case in asset bubbles. It surprises most people, but it wasn't something that was completely out of the unknown, like it had never been observed before. A gray swan is something that everybody can see sitting in front of us, but we all just look the other way because, hey, it's bubble time. And bubble time means everybody's making money, everybody's having fun, everybody's taking risks. We don't care about the risks that are sitting there right in front of everybody. The gray swan, out in the open, hiding in plain sight. That's the gray swan. And in many cases, not necessarily NVIDIA itself, though this is the biggest one, but the NVIDIA finding itself at the center of the way this bubble cycle has truly been put together and the threads that are being pulled to try to untangle it. You've probably heard, because it's been talked about more recently, especially, the circular nature of money through the AI bubble and AI build-out. Well, that's only part of it. The bigger part of it is what connects everything together. The X factor, the gray swan in NVIDIA, the X factor to the private credit bust, that is indeed a bust, and even the real economy. All of these things are really connected together, which of course makes it one reason why we need to ask so many more questions and understand what's really going on here, because there's not a thing that it doesn't necessarily touch. Now, even while we're not talking about a 2008 style wipeout, can't take that off the table, it's still, because everything is interconnected, the numbers are indeed big enough, and because AI has become basically the only thing in the economy that's working, and the only thing in some of the markets that's working, understanding how this is put together, then therefore understanding the risk to it, leads us in the direction of starting to be able to analyze and game plan the downside of a credit cycle that is a lot more than just blue owls. Like I said, it's got gray swans in it. I almost never do ads, and I say no to the vast majority of those that are brought to my attention, but I was thrilled to be able to work with today's video sponsor, Monetary Metals. And the reason is because they're solving a big problem, one that I've been highlighting for a very long period of time. Gold is a safe haven, but other than sitting in a vault, it doesn't do anything. Monetary Metals fixes that. They let you earn real yield paid in physical gold without giving up ownership. It's not a fund, it's not a paper claim, it's your gold working for you. Every month, more gold gets deposited into your account. It's simple, it's transparent, and it is fully insured. If you believe in gold as a long-term store of value as I do, this changes everything. Go to monetary-metals.com/Snyder. That's monetary-metals.com/Snyder for all the details. We absolutely thank them for being the sponsor of today's video. And now let's get back to it. So we're going to go over what's really taking place here. About a week ago, NVIDIA announced a memorandum of understanding where it was going to ask for another $500 billion. It made it sound like they had secured the $500 billion from the biggest Wall Street names, when that wasn't really the case. And that was already a big red flag, because what it said was customers are having problems financing money. So we're going to take a little bit of a detour back in time to the dot-com era for a couple of small examples to really set the stage for what we're finding more and more, what we're finding out more and more here about the gray swans in 2026. So it's not really a question of why aren't investors watching this risk. The question is why is the situation set up the way that it is? And that's where the detour is going to come in. So like I mentioned, a little over a week ago, the red flag, $500 billion, but it isn't like Wall Street is providing $500 billion that it already has sitting around and just giving it to NVIDIA through its customers. There's a lot more detail to it. In many senses, it's, again, the familiar tale of trying to disguise risk and trying to downplay the severity or downplay the size and scope of what's really needed to keep this thing on track. This thing meaning the AI bust, or the AI bubble before it becomes a bust, to keep it on track so that everything can fit together. Because the large scale premise here, and it's not necessarily the wrong one, it's just there's more uncertainty attached to it than people are willing to admit. The thesis here is that AI is a world-changing technology, which is true. That's absolutely the case. However, what that actually means in financial and commercial terms is completely up in the air. But if AI works, then all we really need is a pile of debt to get us through the build-out period. Once we get through the build-out period, there'll be more than enough cash flow and wealth creation to pay back all the debt, as well as to create wealth for all the shareholders and the equity holders who participated in the build-out to begin with. So that's the premise. But in order to get that debt in place to be able to build this build-out, or be able to even have a prayer of getting it toward completion, a lot of things have to go exactly right at exactly the right time in exactly the right way. It is in many ways threading a very fine needle. And we're not even going to get to all the factors that can go wrong here. Like, for example, how you have a bunch of competing companies when not every one of those competing companies are going to win, which means some debt that's already financing the AI build out it's going to be lost. There's overcapacity because we don't need 17 different companies building AI. We're only going to have a couple winners and the rest of the losers are going to lead to. So we're not even going to get to that part here. We're just going to talk about the structure. How do we put this debt in place in order for any realistic chance for the AI payoff, at least in the first wave? So the announcement made it seem like NVIDIA had secured financing from the biggest names on Wall Street. Notice these are not the regulated banks. These are, other than Goldman Sachs, these are the shadow banks, alternative asset managers that have come to the forefront here in the 2020s. Those who are also leading the private credit boom, because shadow banking is now the marginal resupplier, redistributor of credit, where regulated banks used to be a generation ago. But we're going to go back in time to the .com again, for a simple illustration of the problem facing companies like NVIDIA. It's not just NVIDIA, but NVIDIA is the big one front and center. We're going to remember a couple of old names from the .com era. If you remember Nortel and Lucent, if you're old enough like me and you remember the 1990s, some of the biggest names and some of the best performers at least in the .com bubble. One of the reasons they were is because their customers seemed to have endless appetite for their products. And one reason why they did was simply because their customers had access to money that not a whole lot of people did at the time. So just like today, Nortel and Lucent's customers were relatively new firms that needed equipment. They needed equipment to build out the internet infrastructure and build a path forward to e-commerce and everything else that we take for granted these days. But just like now, back then, their customers didn't have a lot of cash flow. These are brand new businesses in many cases, or relatively new businesses that were not cash rich. It's because they were smaller firms that weren't cash rich, but yet still needed the equipment, and Nortel needed them to need the equipment in order to build that future. They had to find the financing somewhere. So Nortel said, and Lucent too, we'll just lend them the money because we have access to capital markets that they don't have. As small and medium-sized businesses with relatively thin histories, nobody's going to lend to these guys. Therefore, they're not going to be able to borrow enough money to buy our products. However, if we go into the capital markets, as darlings of the .com era, Nortel, we can borrow at obscenely low rates. So Nortel is going to go into the bond market, and it's going to go to various banks and say, let me borrow the money. And then Nortel acts as the redistributor to re-lend the money to its own customers, which, by the way, it's not as nefarious as it sounds. Vendor financing has been a part of the commercial industry and commercial business since there has been commercial business. There's nothing wrong with vendor financing. The difference this time is it was all bet on a complete unknown. It was a technology adoption cycle, a brand new future that was being built. They called it the new economy back then, which was absolutely true, just not in the short run. Because it was built on such an unknown, what Nortel and Lucent were really betting on is that these customers that had to borrow money to buy their products, the build out to the internet cycle, the new economy, would be successful in enough time to do just what I said before about AI. That eventually their customers would become, revenue growth would be fast enough, even parabolic, that would allow them to pay back all the debt. So as far as Nortel and Lucent were concerned, they were giving vendor financing to their customers, or a form of vendor financing to their customers, with the idea that this was all going to work really well. And then for the debt that they were borrowing in order to finance their customer acquisitions of their own products would be easily paid back. And you can already see the downside in this equation. Because if they're wrong about either the end state, the internet build out, which they were not wrong about, or the timing of the build out, that meant the debt would be there up front and the ability to pay the debt back wouldn't necessarily happen in time, which would leave Nortel and Lucent on the hook for essentially their customers and being wrong about the customers and the adoption cycle, which is exactly what happened. After they dumped a whole ton of money, they borrowed a bunch of money, dumped a whole ton of money into their customers. The customers bought their products. It started out working really well. Wall Street rewarded it. Their stock prices went straight up in the air, some of the best performers in the late 1990s. But all good things came to an end because, again, they were right about the technology in the long run. What they were wrong about was the timing, which is the case. This is the common theme, the common thread through every adoption cycle. It's not the technology that's bad or the technology that's wrong. More often than not, it's just the timing and who actually ends up winning for the technological adoption and overall process. So Nortel and Lucent, they went bankrupt. Nortel went bankrupt, I believe, in 2009. And yes, Bank of New York Mellon was its biggest bank creditor. Lucent went bankrupt before then. Big time cautionary tales about this kind of thing. So what do we see these days? Let's fast forward to the 2020s. Now, NVIDIA not making the same mistake or what they perceive of as the same mistake as Nortel and Lucent. They're not directly lending funds to their customers to buy their products. Instead, they're appealing to Wall Street to do it for them. So this is where Wall Street comes in. This is where that $500 billion comes in, the $500 billion on top of a whole bunch more beside. So we depend upon these shadow banks to go into the marketplace and secure assets. I mean, do what asset gatherers do really well, which is gather a whole bunch of assets. However, they're not going to lend the money directly either. They're going to set up what's called a special purpose vehicle, and that term should sound familiar because this is where the 2008 parallels come into it. Back then, they were using SIVs and SPVs to do offshore balance sheet securitization and a whole bunch of stuff. So a lot of similarities in that respect, putting stuff off balance sheet and using special structures in order to securitize and retranche risk and all that kind of stuff. But either way, you got the shadow banks who gather assets. So they gather funds through their various funds that they offer. So they gather investor funds through the vehicles at BlackRock and Apollo, and they create the opportunities. They then use that money to seed the SPVs and to invest in the SPVs. The SPVs also issue bonds to the general marketplace, which are largely bought by institutional investors, insurance companies, and pension funds. Yes, we do have all the same similarities there as well. Those who are reaching for yield. And then the SPV lends the money to NVIDIA's customers. Now, there are other ways to structure these deals. We're going to keep it relatively simple. I know it's not all that simple, but we're going to keep it relatively simple here. There's leasing arrangement. There's a whole bunch of variations and complications that have taken place in the real world. But for our purposes and just for illustration purposes, if you think about it in this way, you'll be close enough that it makes enough sense, and it's close enough to how things are really structured that you can actually form a mental roadmap of how all this stuff is put together. So the SPV in our example, and overall, just keeping in your mind conceptually, makes the loans to NVIDIA's customers. However, you can already see the flaw in this arrangement. The SPV isn't going to want to make loans to the NVIDIA's customers in the same way that banks in the investment market and the debt market back in the dot-com era didn't want to make loans directly to Nortel and Lucent's customers, because these are riskier customers. Just like back then, these are firms that are brand new or relatively brand new. They're small, medium-sized, they're high risk. So how do we do the same thing that we did before, where Nortel and Lucent were using their credit profile, their very good credit profile, at least before the bust, to allow for their customers to borrow at relatively easy rates? So this is something that NVIDIA's already brought up and talked about, that this is a scheme put together to allow customers to access funds at less than punishing interest rates and punishing credit terms. And so that we can also have the SPVs that are making the loans feel good about making those loans, and at least feel like they're not taking on too much risk lending in this uncertain technology to uncertain borrowers. But rather than route all of this through NVIDIA and have NVIDIA directly borrow from the SPV or directly borrow from Wall Street, we're going through the SPV, but we're going to collateralize everything, because everything on one level or another is collateralized. What Wall Street came up with was to securitize a whole bunch of new stuff. So more financial engineering to create even more collateral out of what wasn't collateral to begin with. And yes, like everything else in the beginning, this stuff does make sense, and there is a legitimate purpose for it. So in this simple example, what we're going to do is we're going to collateralize the loan to the SPV with the equipment that the customers are buying. And again, in many cases, the SPV can buy the equipment directly and use that as collateral and then lease out the equipment to the customer. There's a lot of different arrangements. But here, think about it this way. The SPV gathers in the funds and then relends the funds to NVIDIA's customers, collateralized by the equipment that these customers buy for NVIDIA, which raises a couple of other sticky questions, including the value of that collateral. First of all, it's relatively illiquid, it's specialized, and given the technology cycles, it's going to depreciate relatively quickly. So what NVIDIA can do, and where NVIDIA comes from, and what the questions that people are asking about NVIDIA this week and last week, is that they can enhance the collateral through what's called a residual value support or residual value guarantee. And this can be structured in a number of different ways, but conceptually, the biggest thing to think about is if the equipment is the collateral to the SPV and the equipment has depreciated substantially when the customers can no longer pay back the loans and the SPV has to seize the collateral, which is now diminished, NVIDIA promises to step in and make the SPV whole. So NVIDIA is on the hook for any potential losses that might arise from the devaluation and the depreciation of the equipment that's used as a collateral. And this doesn't show up on a balance sheet anywhere, because from NVIDIA's perspective, just like credit default swaps a generation ago, there is in NVIDIA's perspective and their modeling, there's almost no chance that these guarantees or these residual value supports are going to be triggered. So they don't even carry this part on the balance sheet, which is kind of what the story is this past week about uncovering all these off-balance sheet arrangements. And I think the big takeaway here, at least the one that you should be getting, is just how entangled everything really is. And then again, like I said, it gets a hell of a lot more complicated. So the money is coming from Wall Street, funneled through shadow banks and SPVs, that gets relent to NVIDIA's customers with some collateral as well as guarantees of that collateral. And everybody's kind of doing everything to everyone else. And they're all wrapped up into the same process. So there really is no way, at least no easy way, to disentangle one party or another, because everybody somewhere is on the hook for something And in theory, that's a good thing because you want to spread out potential losses as wide as possible, because that's one way that you mitigate the concentration and therefore the systemic risk for something like this. But the downside of doing that is, instead of a couple players being on the hook for almost everything, you've got almost everyone on the hook for something. And that leads to a whole bunch of other problems, which we're now seeing pop up, including why we have so many. I'll get to that stuff in just a second here. But so what we have here is another complicated set of structures, intertwining structures that basically entangle everyone else into everything in smaller ways. But then if something goes wrong, it affects a hell of a lot more people. And therefore, the backlash if something goes wrong would cover a wider area. So it doesn't necessarily lead to a massive catastrophic, loss in a couple of places or another. Maybe it's smaller losses to everyone, which I hope you can start to see why the private credit cycle has gone the way that it has, and how this can continue to plague the debt cycle as it goes through the downside. Let's talk about that, because that's one of the biggest risks here. Now, let's set NVIDIA aside for a moment. Let's set all this collateral stuff aside for a moment. Let's talk about the credit cycle. I think you can already appreciate where the big weakness is in this entire framework, even if it's just a conceptual one. It started out with private credit. We're talking about a year ago, almost a year ago exactly, where Tricolor first started making some noise, the subprime auto lender down in Texas. Since that time, well, most people have largely forgotten about private credit as much as they possibly can, focusing on AI, therefore missing the connections here, and also the debt cycle component to AI, because when you talk about AI, most people are talking about AI equities. However, the private credit situation did not go anywhere. It has gone underground in some respects, because unless you hear some major fund which is getting hit with redemptions, most people don't really pay attention because it's not a sexy story. At least it isn't anymore. It was for a while there. But now we're getting down to the nuts and bolts of everything, the nitty gritty. More and more what we see is not just that it is a credit cycle and a downswing in a credit cycle. More and more we're seeing widespread recognition of the same thing. Whereas everyone before said, oh, it's just a couple cockroaches, a couple of one-offs, then it was just a couple of funds, and maybe it was just Blue Owl's problem. More and more you can see the systemic nature of the downside of the credit cycle. It doesn't mean crash. It doesn't mean, everything's falling apart. Systemic as in everybody is exposed to this in one way or another. Again, like the example we just went through. And the bigger thing here is it's no longer contained to private credit alone. It has definitely spread to other areas, including what we're just talking about, public markets related to AI as well as outside of AI. But we have a credit cycle that isn't just recognized inside of private credit. It is now more and more a credit cycle across the entire debt markets, or at least significant portions of them. There are still pockets of strength and complacency. You see some credit spreads that are historically narrow or very close to historically narrow. So there's a tremendous amount of complacency, but more and more you can see the downside cracks coming, and more you can connect these dots, which suggests the X factor and gray swan that I talked about in the beginning, including inside of private credit itself, where there are losses coming. There was reports this past week, which I wrote about in our deep dive analysis subscription at Eurodollar University, where non-accrual loan status is creeping up, and it's creeping up pretty quickly in certain funds, and non-accrual loans is the step just short of booking complete losses. If it's a non-accrual loan, then the lender basically expects to take some kind of loss on it. Those are actually creeping up, which is something that the marketplace and investors have been expecting, which is why they're pulling all their funds out. Software is a big one. You want to really know why software is a huge deal in private credit specifically, and therefore outside of private credit too, is because investors who are paying attention understand that there is a serious refinancing wall next year as well as the year after. And that refinancing wall means if you're worried about these companies being able to meet that refinancing wall, because if they have to refinance their debts in the downside of a credit cycle, the chances of them not being able to do so goes way, way up. So this is where all the redemptions are coming from. Investors are doing a little bit of credit market and credit cycle math, and they're doing a lot of credit cycle math, and it's coming up in rational ways. So you think there's a massive refinancing wall for software companies coming up next year. Get your money out today. Get your money out last quarter as much as you can. You're not going to wait around to see downside in credit cycle, software borrowers, which are huge parts of these portfolios. This is where the redemptions are coming from. People are starting to do math in a way they hadn't done before. And so the X factor in the economy, the financial markets, is the credit cycle downturn that we keep seeing in all of these different ways. And part of it, too, is the behavioral change. It's something I talked about a couple webinars ago here at Eurodollar University. What really marks credit crises that become liquidity crisis is behavioral changes. And we see those all over the place, including how some of the private credit firms themselves are trying to remarket their products. Nothing screams toxic wakes like, hey, we need to put a brand new name and a brand new description and a brand new sales pitch together for the same product that nobody wants to buy. It's more and more evidence of the same thing, which is, for our purposes here in this video, downturn, downside in the credit cycle, which means a lot more than just strictly a refi wall for private credit and software loans. Now let's go back to that structure we put together before. And again, you can see the problem here. NVIDIA's business business depends upon money flowing from Wall Street and one side or the other to NVIDIA's customers. And it's not just NVIDIA. All the rest of them are the same thing. Data centers too. And by the way, you can see here, this is not just about data centers. It's about all parts of the AI build-out. So it depends upon the credit cycle continuing to shovel money down to these customers who are small and medium-sized businesses with the understanding, just like in the dot-com era, these small and medium-sized businesses will grow quickly enough and grow fast and far enough that they'll be able to pay back all these loans. And these loans are just to bridge the timing divide between where we are today, where customers don't have any money and don't have any business, to a couple years from now where they are absolutely booming and full of business and full of profits. But if anything interrupts that process where the debt doesn't flow, then the customers can't buy the products, then the products that NVIDIA sells, NVIDIA suddenly runs into trouble. And if NVIDIA runs into trouble, then all the rest of them, the hyperscalers are going to run into trouble. You take one little leg away from this and one little stool away like a Jenga tower, and it all starts to fall apart, just like it did in the dot-com era. So you get a credit cycle that is no longer on the upswing. You get a credit cycle that's now in the downturn. That means that investors in that credit cycle that are pushing this money through these shadow banks into these SPVs and therefore financing all this. If credit investors start to get even colder feet than they have now, they start to pull back the money that's available that goes into it. You have institutional investors. They start to pull back as well as the credit cycle continues to develop on the downside, which means the SPVs no longer have the unlimited funds that the technology build out really needs them to have. So then these customers for NVIDIA and all these data centers no longer have the money. They don't have the internal funds. They don't have the profitability. They don't have the revenue growth yet. So they no longer have the money, but they've already borrowed a ton from these SPVs, which means it triggers all of these collateral clauses. The equipment gets seized, which means NVIDIA has to stand beside it with its residual value support and guarantee. And suddenly everybody's entangled in the downside of the credit cycle. Not just one part or another. It's not just NVIDIA's customers that end up defaulting and therefore the SPVs get left holding losses. There's equipment that has to be sold and liquidated, therefore maybe depreciating the prices and depressing the prices. NVIDIA has to maybe pony up to make whole the SPVs. The SPVs sure as hell aren't going to lend where they're going to be tied up in all these collateral dimensions. And so the credit cycle downswing isn't just a credit cycle downswing where a couple of wealthy investors start to pull out of some funds. They're pulling out some funds because they're starting to do the math that should have been done a long time ago and not liking what they're seeing out of it. So NVIDIA sort of becomes the gray swan because it's at the middle of so many of these Jenga pieces that are stacked on top of it. Or think about it as a house of cards. So NVIDIA is kind of like a house of cards where you start tugging one of the bottom row or even just one in the middle row and things look a lot different. In fact, it's one reason why, in fact, it's probably the reason why NVIDIA shares are trading at a discount to, whether they're other peers, their cash flow. You can do any number of, Wall Street financial calculations. And you come back to the same thing, which is investors are treating NVIDIA more and more like a risk than necessarily a tremendous upside. I'm not saying that's not there. Again, AI is going to be a world-changing technology. It's going to be a huge success for somebody or a bunch of somebodies. The question right now is the debt will the debt be available to fill that divide between where we are today and where we would like to be down the road? Will there be enough? Will there be enough that says the debt keeps coming, the debt keeps flowing? And of course, another X factor in all of this is the macroeconomy. So it brings us back to the original part of the discussion. We've got lots of off-balance sheet financing and arrangements that are essentially necessary to provide the funding and financing to bridge the gap between the starting line and hopefully the finish line for a lot of this AI build-out. But we're in the middle of a credit cycle that was sparked by private credit in seemingly a completely different part of the debt market. Talk about Tricolor and First Brands, nothing like NVIDIA and Oracle and Meta and all the ones we're talking about now, but yet that's the credit cycle that ties everything together. So NVIDIA in the middle of all of this, the gray swan is being pulled apart, the feathers being picked off as Wall Street investors, the media for once, are starting to ask the more uncomfortable question. What is really going on here? And what really are the chances that this all goes perfectly, that all of these pieces can continue to fit together just right and just so that it gets us to something we've never seen in human history, which is a disruptive technological cycle that goes smoothly. So more and more the chances are the debt gets pulled back as the credit cycle goes further in the downside, which, by the way, the macroeconomy is a huge part of that, especially as it feeds back in from the debt cycle. Think about it this way. Weak labor market, weekly incomes. We're reminded of this by Walmart this past week. The more the macroeconomy looks shaky in the United States around the rest of the world, the more shaky the lenders are going to be, whether they be in SPVs or institutional investors that are funding SPVs, the less likely they're going to be willing to fund at the same rates and the same level they did before, which puts more pressure on NVIDIA's customers. And what happens if NVIDIA's customers can't afford to buy the same level of products that NVIDIA has promised everybody that it's going to sell? Then NVIDIA becomes more of a risk, more of a gray swan. And if NVIDIA becomes more of a risk than it already is perceived to be, the rest of it, in terms of sentiment as well as real dollars and real dollar flow, gets increasingly tighter and tighter and tighter. The screws get tightened down in every single direction. The house of cards gets shaker and shaker as we move some of the bottom layers. because the money doesn't flow the same way that it did. And it doesn't flow the same way as it did because when everything was on the way up, nobody cared about the details. Everything was all about this successful future instead of the details, how we get to that future. Now that we're poking around the details, Wall Street is starting to say, I don't like what I see. There are more risks than we thought there were, and more risks, including the fact that, like I described it here, this is really an incredibly fine needle to have to thread. And the chances of everything going perfectly right, that it can go forward and not be disruptive in terms of the adoption cycle, are increasingly diminishing. That's what's really going on in the marketplace. And it's starting to spread because at the end of the day, it is a credit cycle. It was not repealed. We see more and more evidence from it. And also, like I said, this is not about private credit in the same way that the 2008 crisis wasn't really about subprime mortgages. Subprime mortgages were just where the questions started to be asked. And when they didn't get the answers that they wanted or the answers that everybody needed, they started taking those same questions and applying them to more and more and more. And that's what's going to happen here. That's what's already happening here because in many ways, a lot of the numbers don't really make all that much sense. There are going to be tremendous losses that are going to be involved with this because not everybody's going to win just as a start. And there are enormous questions about how we get from where we are today to where we would like to be tomorrow and have everything go just perfectly right along the way, including the macroeconomy. That is a huge question mark that also needs to be answered some way too. So that's what we have going on in the private credit because it's not really about private credit. It's not really about AI. It's about the processes that are put together in these bubble periods that then become revealed. Again, bubbles really are, expectations are up here and expectations about everything, the payoff in the technology and how it's put together and the roadmap to try to get there. And then reality comes in and expectations need to be readjusted, both in terms of where that road is down into the future, but also the timing. How do we get from A to B and who actually is able to survive that process? That's where the risk comes in. And that's where the risk is starting to come in here with the entire credit cycle. So it's not really circular money so much as it is a very familiar setup that is being applied into somewhat of a new way. Wall Street doing what it does, money doing what it does during these bubble periods, and then for money doing the opposite of what it did in the bubble period on the way out. Hope everybody has a good rest of your week. I'll see you again soon. From October 9th through 12th, I'm bringing together a group of roughly 40 serious investors and financial professionals, along with some special guests and friends like Hugh Hendry and Mike Green, George Gammon, Brent Johnson, and a couple of other ones, where we're going to spend 4 days asking the questions that truly matter. What happens next? Where are the biggest risks being mispriced? Where are the opportunities? What should change our minds? And how should we think about positioning around it? This is not a conference built around speeches. It's a small room built around discussion, some disagreement, and actionable advice. So if you manage some meaningful capital or you're seriously interested in all of these questions and finding answers to them in a very small, intimate setting, apply below. So Fitch just reported a record high for private credit defaults. That would seem to validate what most people think, that the credit downturn is contained inside just private credit, and that's understandable. The most visible warnings have You think the credit cycle is all about private credit and
Interest rates are exploding on U.S. government debt, which has everybody asking, are we witnessing the death of the dollar?
The 30-year yield making a 19-year high, and for all the wrong reasons.
It feels like things ain't looking great for the dollar right now, Guy.
The US dollar's dominance is being tested.
But the key question we should all be asking ourselves is not if the dollar will lose reserve currency status, but when will the dollar lose reserve currency status? I'm going to do my best to answer that question for you in 3 simple, fast steps. Step number 1, there is no disputing the fact global central banks are holding fewer and fewer dollars and fewer dollar-denominated assets. Let's look at a chart from the end of 2025 or so, going all the way back to 2000. On the left, we go from 50% up to 70%. This is the U.S. dollar percentage of FX reserves for global central banks. And you can see back in 2000, way above 70%. And since that time, it's pretty much gone straight down to a point now where we're right around maybe 52, 53%. With the exception of some volatility right around 2014, 2015. But the bottom line is the trend is straight down. But it's not just central banks holding fewer dollars. It's also the fact they're holding fewer treasuries. Editor, go ahead and throw up that chart that we have of the amount of gold these central banks are holding versus treasuries. And you can see the trend line looks like we're going right back to where we were in 1980, where the overwhelming reserve asset was not U.S. treasuries denominated in dollars, but gold. I like to focus on macro here, but in the macro analysis today, we obviously have to include geopolitics. What's going on in the Middle East, the Straits of Hormuz, more specifically with oil. So this begs the question, how long is the petrodollar going to actually last? For those of you who don't know, the petrodollar, basically an agreement that the United States had with Saudi Arabia that they would sell their oil for dollars, going all the way back to the beginning of the 1970s, I believe. So a lot of people argue that this creates artificial demand for dollars because to get that oil, you got to have the dollars. But if these countries start settling for that precious commodity in a currency other than the dollar, this could lead to the dollar declining as far as its use globally, and it could lead to the death of the dollar. And let's not forget the latest news where Scott Bessent is opening up all of these swap lines to try to prevent countries from selling dollar assets, namely U.S. treasuries. And at the end of the day, what is a U.S. treasury? It's simply a longer dated dollar that pays you an interest rate. So when you look at the massive decline in FX reserves, also you look at the decline in treasuries versus gold, you look at the decline of the petrodollar and some of these emergency measures that Scott Bessent is having to implement with these swap lines, you have to start asking the question, well, when will the dollar lose reserve currency status? Because it sure looks like the wheels are in motion for possibly the imminent decline of King Dollar. Step number 2, to determine when the dollar is going to lose reserve currency status, I think we have to step back first and try to define what a reserve currency actually is. And for me, personally, I think most of you would agree with me, the reserve currency, or the dominant currency of the world, is the one that people use the most. It's pretty simple. So going back to step number 1, is it true that these central banks and governments are holding fewer dollars? It is absolutely unequivocally true. But at the end of the day, does that matter? Maybe, maybe not. So let's look at some charts and data to determine how much the United States dollar or other currencies are actually being used in the global economy, not necessarily held by a central bank. So we'll start by looking at the world share of international payments via SWIFT. Now, I realize there's other ways to settle interbank, but SWIFT is by far the largest one that we have in the world. So the blue bars represent the United States dollar. And I think what's very interesting is one of the arguments, and I think it's a valid argument that you hear for the dollar losing reserve currency status, is what we did in 2022 to Russia when they invaded Ukraine. We froze all of their accounts. So all these other countries, they don't want to do business in dollars, they don't want to hold dollars because they're worried about the United States, well, taking their money. And it is a very valid concern, but the proof is in the pudding. And if you look back to 2022, the percentage of global transactions that were settled in dollars, right around 40%. So what is it today? Have we seen a massive decline? Actually, the opposite of that. We have seen the dollar usage actually go up to a point today where it is over 50%. And the data gets even more shocking if you go back to 2012, which is the beginning of this chart. And back then, as we all know, the dollar was the global reserve currency, but it only had a 30% share of global transactions. So again, 2012, 30% share of global transactions on SWIFT. Today, over 50%. Now let's go over to the most recent BIS report. This is the Bank of International Settlements. And they've got a fantastic chart. This is the foreign exchange market turnover by currency and currency pairs. And you can see if we go back to 2022, it's represented by this blue bar. So the United States dollar was used in 88.4, I gotta use my glasses there, 88.4% of the transactions. But today, it's actually gone up to the point where it's at 89.2. Now, if you guys are paying attention, you're gonna add all these numbers up, say, wait a minute, this is way over 100%. That's because there's two currencies in each transaction. And we look at the main currency pairs for these transactions, and it's no surprise that the dollar is on one side of every single one of them. The main one is the dollar euro, then we've got dollar yen, then we've got dollar pound, and dollar, basically all the emerging markets combined. But we're not done there. Let's go over to another website where they've got some very recent data here from June 23rd, 2026. They say when excluding payments within the Eurozone, the USD's share of international payments rises to approximately 75%. Further emphasizing its centrality outside the Eurozone. The Euro share correspondingly decreases, reflecting its regional concentration. So you see what they're saying there. They're saying when you omit the Eurozone, the amount of global transactions increases even more as far as a percentage of dollar settlement. And then, as you would expect, the percentage of euros goes down outside of the Eurozone quite substantially. In other words, what's happening is when you exclude the United States, you exclude the Eurozone, and then you look at which currencies are being used globally for settlement, the percentage share that the dollar has goes up even higher, showing that it's even more dominant. Not necessarily with central banks, as we pointed out in step number 1, but with corporations, with entities, with individuals in the real economy. They go on to highlight the fact in trade finance transactions, the United States dollar dominance is even more pronounced, accounting for 82.5% of total transaction value. So if we're defining a global reserve currency by simply what central banks are doing, then it is no doubt the dollar is losing reserve currency status. But if we actually define a reserve currency based on which one is being used the most in the real world, we can see with the data that the dollar is being used more and more and more. Step number 3. So we've broken things down into 2 separate categories. I like to think of them as reserves and transactions, more so reserves for the government entities, not necessarily in the private sector. But to answer the question, when will the dollar lose reserve currency status, I've got to actually give you 2 separate answers based on these categories. But before we get there, let's kind of understand why. Right? I always like to ask, well, why? Why is the dollar being used in transactions so much? And why is the dollar being used less and less and less as far as reserves for these central banks? The first thing you have to understand, and we'll start with a central bank, the ECB right here in red. So we've got their balance sheet, assets on the left, liabilities on the right. And here, let's use a huge mega multinational corporation in the real world, in the private sector, Toyota. Same thing, assets on the left, liabilities on the right. Okay, cool. So we all know, or you should, that a central bank really can't go bust. So let's say their liabilities are all their local currency, euro. So euro bank reserves, whatever. And on the asset side, they've got some dollars, and now they've got a lot of gold. Well, what happens if the gold loses its value? Let's say it gets cut in half or something. Well, then they have negative equity. Now, does this mean they just go bankrupt and they're insolvent and they just go away and we don't have to deal with the ECB anymore? Absolutely not. You see, they can have negative equity. They could have this. They could have no assets and all liability, and they're still going to be there. They can't go bust. Now, it's completely different, obviously, for Toyota. So what happens is they have to match up their liabilities and assets. Because if they have dollar liabilities, let's say, and they have gold, let's just say the gold was here and then it disappears because the value of the gold goes down. Well, now all of a sudden, they have negative equity, but that could mean they actually do go bust. So when you actually zoom out and look at these 2 entities as proxies for what the government's doing and then what the private sector is doing, you see that they have completely different incentives. In other words, Toyota cannot do what the ECB is doing. The private sector cannot do what the government is doing because they actually have a balance sheet and they can actually go bust in the real world. So going back to those priorities that are much different, what is the ECB or any central bank, what is one of their main priorities? Well, access to their assets. And this is when you go back to 2022 and look at what happened when Russia invaded Ukraine and the United States froze Russian assets. All of a sudden, it sends a message to all of these central banks that, hey, you might want to hold fewer dollars, or you might want to hold fewer dollar-denominated assets, or assets with less counterparty risk, i.e. gold. And the central banks can do that because, once again, they can have negative equity. Now let's go over to the other side, the private sector here, and ask what is their main priority, or some of their main priorities. Number 1 by far, there isn't even a close second place, is utility. Because at the end of the day, why do we use currency? Well, because it's a lot easier than bartering. So the main reason we use it is for that utility. But then we have to ask the question, what is a currency? In today's day and age, it's actually a platform. It's like a financial platform, very similar to YouTube. And more on that in just a moment. But when we look at what gives a currency utility, or what gives a dollar financial system utility, we got to look at the apps. So the reason I say apps is because I want you to look at a dollar or euro or yen or yuan financial system as a phone. Okay, just like the one you've probably got in your hand, or you could have in your hand right now. And each phone has apps. Some of them have a lot of apps. Some of them have very few apps. It's just like a financial system. Some of them have a lot of features. Some of them have very few features. So what gives the dollar financial system a ton of utility are these apps. So you say, George, okay, I get the analogy. What are the actual apps? Okay, let me give an example of something that Toyota could really, really use. First of all, corporate paper market. Very deep, billions and billions and billions and billions of dollars. So if Toyota needs very quick funding, they know that they can get that funding almost immediately in dollars. Could they get that funding in Colombian pesos? No. Could they get that funding in Chinese yuan or South African rand? No. Okay, so also a bond market. So when they take their profits, they don't want to leave it at the bank. So what if the bank goes bust? So what they can do is take those profits and they can put them into the US Treasury market. Not because they have to, but because they want to. Because they can collect, let's say, a 4% interest rate. They can just roll over that debt. They can have the ultimate liquidity, and they're not taking a lot of FX risk because they have a lot of dollar-denominated liabilities. But let's keep going. The swap markets, and I don't want to get too in the weeds here, but this allows a mega multinational corporation like Toyota to go ahead and hedge their balance sheet among many, 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 many other things. So interest rate swaps, FX swaps are what I'm referring to. So it's just like that smartphone in your hand compared to a flip phone. Back in the day, if you had X flip phone versus Y flip phone, wasn't that much of a difference because all you could do is call someone on it. But nowadays, that smartphone gives you so much more utility than a flip phone ever could, and it's because of all the apps. So the main point here is one of the main priorities for these central banks and their reserves is access. And the main priority for everyone in the private sector, especially these huge multinational corporations and banks, very, very important, is utility. And I know a lot of you right about now are saying, George, okay, I get what you're saying with the analogy. It makes a lot of sense. But the United States is weaponizing the dollar. And therefore, even if it has this utility, at some point, the risk outweighs the reward. And I totally agree with this. But what you have to understand is the degree of risk relative to the degree of utility. Let me put it to you this way. We'll stick with this iPhone or smartphone example. So all of you watching right now, or I'm going to say 99% of you, probably have a smartphone. And you all know that smartphone is spying on you. Everybody knows this. Now, is a flip phone spying on you? No, probably not. So why don't you guys use a flip phone when you know that what you have in your hand right now is pretty much listening to every single thing that you say, spying on you to use that by the government potentially against you in the future? The reason why none of you will give up your smartphone, even though you know the downside of it, is because it has so much more utility than that flip phone that won't tattle on you to Big Daddy government. Okay, now what I want to do before I give you my prediction as to when the dollar will lose reserve currency status is I want to go through a real world example to make sure that we're all on the same page. What we were talking about earlier is kind of an oversimplification and it's out there in the abstract, but what I want to do is take that concept and now turn it into something real and concrete. Okay, so we're going to stick with the same entity, Toyota, right here, but instead of looking at the assets and liabilities on the balance sheet, this time we're going to look at kind of the income statement, if you will. So we've got revenue on the left, we've got expenses on the right. So Toyota is selling a lot of cars to these individuals, the average Joes and Janes in Colombia, COP, the Colombian peso, in South Africa, we'll say the South African rand, and in the UK, so the British pound. So they're receiving all of these different currencies. But there's a problem, because their inputs are denominated in dollars. So let's just assume for a moment they have to import rubber from Malaysia, copper from Chile, chips, I don't know if India makes computer chips, maybe Taiwan, but it doesn't matter. It's all for the sake of the example. You get it. So they're being invoiced in dollars from the entities, the producers in these countries that are providing them all of the inputs for the cars that they then sell to these other markets to get the foreign currency. And right off the bat, you can see the problem. Let's assume they keep all of these currencies in just a multi-currency account. We'll just say they do that with HSBC or something like that, or even hold the bonds that are denominated in these currencies. They still would have FX risk. And what I mean by that is if the value of these currencies goes down relative to the dollars they're being invoiced in, the burden of their inputs, in other words, basically their expenses, are going to increase, and they can't take that risk. So what they're going to do, as soon as they get this currency, they're going to immediately turn it into dollars. So they're going to take XYZ currency, turn it into dollars so they don't take that FX risk because the dollar can't go down versus the dollar. But now they've got another problem. See, they can't just hold billions and billions and billions of dollars in a checking account because what if the bank goes bust and they actually would like to get an interest rate on that money while they're waiting to deploy it? So they're going to take the dollars. And remember, initially they took the foreign currency, that goes into dollars. They take the dollars, that goes into U.S. Treasuries because they don't have that counterparty risk of a bank failing and they get an interest rate above zero. Well, you say, George, whoa, time out here. Why don't they just take the foreign currencies and turn them into yuan? Or maybe the new BRICS currency, or the Indian rupee, or the Russian ruble, or something, because we know that Toyota and everyone else out there hates the United States. They hate Donald Trump. They hate the fact that we have all these massive exploding deficits, which is actually true. They hate the fact that we have all of this debt, 40 trillion in debt. So at a certain point, they're not going to trust the bonds anymore. They're not going to trust the dollars, and therefore, they're going to want to take these foreign currencies and turn them into yuan because that's safer. Okay, well, let's just think that one through. So first and foremost, you would have to have a bond market denominated in yuan, which they do, but it's very difficult to access and it's very illiquid. It's not like holding the treasuries, which you can immediately sell for that liquidity you need based on what your needs are from your expenses, your balance sheet, etc. And you still have the problem that those Chinese sovereign bonds are denominated in yuan that can fluctuate, the yuan can fluctuate in value relative to the denomination of your inputs, which is still dollars. And then you might say, well, George, all of these countries are going to start invoicing in yuan because they hate Donald Trump and they hate the deficits and they hate the US having $40 trillion in debt. Okay, that's fine, but remember all of these companies, all these producers have inputs as well, and they're all invoicing these producers in dollars. So what you would have to have is the entire ecosystem, the entire supply chain, let's say, of Toyota and all of its suppliers somehow just immediately switch to Chinese yuan overnight. And we haven't even got to the toughest part of that switch, which would be the infrastructure and a lot of the features that I talked about earlier. So now let's get into that. Assuming Toyota chose to hold Chinese government debt because they just trust it more, denominated in yuan, at some point in time, they are going to need a foreign currency. Let's say they have to, I don't know, temporarily give money to a dealership in Australia or something like that. So they have to have Australian dollars. So what they have to do is they have to take the yuan and they could either sell the yuan for AUD, but once they get the AUD back, because this is just a temporary loan, let's say, then they're going to want to turn the AUD back into the yuan. But the problem there is, again, you're taking FX risk. So what you'd want to do is you'd want to do an FX swap. So what you're doing is you're agreeing to a set conversion rate for a set amount of time. So they would take the yuan and they would say, I don't know what the conversion rate is, let's just say it's 10 to 1 or something like that. Say, okay, 10 to 1 in 3 months. So they go ahead and with a counterparty, they would take the yuan, they would trade them for AUD, they take the AUD down here, the AUD comes back in 3 months, then they swap at that predetermined rate and they get the yuan back. They're not taking any FX risk. The problem there is you can't just do an FX swap yuan to AUD. It would be massively illiquid. There's not really a market for it. There isn't the infrastructure. But can you do it with United States dollars? Instantly. It's not even a question. There's massive amounts of liquidity. And in fact, it would be so inefficient to try to figure out a swap between yuan and AUD. What the treasurer, if that's the guy in charge of this at Toyota, he would likely take the yuan, sell it, or do an FX swap into dollars, and then take the dollars and do another FX swap into the AUD. But you see what we're doing here? We're adding layers and layers and layers of complexity. We're making this extremely cumbersome when it's just far, far, far easier to go ahead and use the dollars. So when I talk about utility, this is what I'm referring to. If you hate Trump, or if you hate the dollar, if you hate the deficits, if you hate the debt, whatever it is, you're going to run into these problems if you try to switch out of using the dollar for your main currency if you're one of these multinational corporations, or even more importantly, one of these global banks in the euro-dollar system. And at the end of the day, all of these banks and multinational corporations have one main incentive. That is profit. So what they're going to do is they're going to focus on the easiest least expensive way to do something. And again, that gives it utility by definition. So they're not going to willingly just do something that's more expensive, more illiquid, and highly, highly inefficient. They're going to choose the opposite of that. So when you combine this type of utility with this type of network effect, it becomes crystal clear why it is so difficult, if not impossible, at least right now, to dethrone the dollar. So when will the dollar lose reserve currency status? Well, if you're using this as a way to define it, I think it could happen within the next 5 years. Why not? Look at that chart going back to 1980, and we can see that back then, central banks had way more gold than they had dollars or treasuries. So why couldn't we go back to that in the next 3 years, 4 years, 5 years? I think we absolutely could, and if you look at a trend, it's definitely going that direction. But that's not how I define a world reserve currency. I look at it more as what currency is actually being used the most in the real world. And if that's the definition you're using, my prediction for when the dollar will lose this status would be at the very least 25 years, and probably a lot longer than that, because you'd have to build all of this infrastructure and you'd have to totally change this network effect in order to make that transition. And the bottom line is it takes a long, long, long time to do this. And you've got to be willing to use a system where you're going to make a lot less profit. It's highly inefficient, and there's going to be a lot less productivity, which means the standard of living is likely going to go down. And as a global society, are we willing to do that just to rotate out of the dollar and move into the Chinese yuan? Probably not. So the bottom line is right now, for better or worse, the dollar financial system is very, very strong. And you can tell by those charts I used in step number 2 that it's actually getting stronger, not weaker. In other words, it's alive and well, and whether we like it or not, it's basically the least bad system that we human beings can create, and therefore we're going to be stuck with it for a long, long time.
Baseline bites the velvet air. Neon kisses everywhere. Shadows twisted electric blue. I'm lost in the pulse, but I'm finding you. Bodies collide like waves on fire. Hearts beat fast, but we climb higher. Into the night, we let it go. Lights spinning wild, we lose control. Dance until the stars burn low. Oh, oh. Into the night, we glow. Sharp like a secret dare. Your eyes are trouble I wouldn't repair. Smoke curls up like a whispered sin. The rhythm calls, let the fever begin. Flashing strobes like a heartbeat broken. Words dissolve in the heat unspoken. Feel the night, it's alive, it's breathing. No turning back, we're lost bleeding. Into the night, we let it go. Lights spinning wild, we lose control. Dance until the stars burn low. Oh, oh. Into the night, we glow. Into the blue, let's fly. Feel the rhythm, feel the sky. Under the moonlight, we're alive.
Kim cycle, c'est balancé là-bas. Hop.
Ponte Dieguito. Así. A ver cómo está. Te quiero con un carro así, ¿eh? ¿dónde estás? Te quiero ver.
Non, puis je sais pas, après ça.
Ouais, mais c'est ce que j'ai dit tout à l'heure, tu vois, parce qu'il y a le Bentayga. Ouais. On sait que les gens allaient arriver. Nee, die haben noch Buchstaben. Ah, nee.
Да, там холодно. Да, там как-то прямо
Tu l'achètes à New York, à Monaco, ouais, putain, on l'attend. Regarde, il t'a mis là. Si à moi je te la garde, celle-là. Tu changes pas, je te la garde. Et Anthony, merci. Ja tada. Nie, ty же sama.
Tu m'entends? Je dois reprendre le fil.
Garde 5 millions.
Vabbè, te la regalo.
No, lui le faccio un po'. No? Non lo so. No.
Poi mica la fanno lui, che la fanno lui la porta.
Par contre, tu vas arrêter de me faire l'ancien, toi. Tu vas arrêter de me faire l'ancien. Ça va ou quoi, frérot?
Ah,
Ça va?
on est là jusque quand?
Bah, jusqu'à dimanche.
Oh, c'est bon, on se voit demain alors.
Ouais, on se voit
dans plein jour, c'est bon?
Vas-y,
Bisous, bisous.
Non, mais il est sur Maroc. Il est sur Instagram. Attends, mais ça, c'est déjà tellement rare. Il m'a fait la séance. On s'en fout, on va toujours être là. Et des meufs embêtantes quand même. Ramène-le l'offre. Non mais il y a qui là? Lui, il a dans le bouilleur des gens, il a appelé un mec pour le reprogrammer ses trucs. Bah, je vais acheter une voiture et puis voilà.
Alors elle, on voit qu'elle est rose.
Ah, moi. Il est sur la course avec une calandre de 50 euros.
Les jeunes, allez on y va. C'est la même chose.
Eu tô com 7 doses black na cabeça.
La casa la
C'è la Bagil de Phil. C'è qualche non te lo fa saltare.
Slovenia.
culo. È venuto 2 volte 20 lire.
Dai, ma mettete vicino magari, no?
Sei di movimento. Posto?
Poi ti voglio far vedere un difetto che tu dirai, wow, mi devo fare la foto. Che noti in quella non caso come lo vedo io?
Lui sta comprando male, secondo me uno ma non no, davanti c'è le cose.
어쨌든 그거 됐으면 시켜 가격이 알려줬어.
Et plus de sous pour les pneus là. Hein? Il y a plus de sous pour les pneus.
Quoi? C'est que toi t'as besoin.
Tu vois?
La moitié de ce carbone sur la barre.
the pinewood trees, carrying old forgotten melodies. And somewhere down the darkened railway line, another lonely heart is losing time. Rain on the Delta tonight, slowly washing through like muddy river water, pulling me from you. Every road I roam, every dream I chase, still leaves these old blues written on my face. Smoke hangs heavy in this old blues bar. Street lights shimmer from passing cars. Bartender pouring another round slow as old train whistles echo below. My guitar hums with a tired sound, like a lonely soul still wandering around. Every broken memory comes alive tonight under neon glow and candlelight. Smoky Delta night, burning low and warm, like an old blues record spinning through the storm. Every lonely mile, every faded sign still brings me back to the ghosts inside my mind. Rain taps softly on the window pane, trying hard to wash away the pain. But every melody still calls your name, and every midnight feels the same. Southern wind moves through the trees so slow, like secrets only lonely hearts know. And somewhere far beyond this town, another tired sun is going down. Smoky Delta night, hold me till the dawn, like the last old memory before it's gone. Every road I ride, every dream I chase, still leaves your shadow in this empty place. Cold wind blowing through the dale tonight, rusty street lamp barely shining light, old six-string crying by the motel sign, like a broken prayer lost somewhere in time. River keeps rolling dark and slow, carrying secrets only drifters know. Every heartbeat echoes through the rain, like an old freight train full of pain. These crossroads after midnight keep calling out my name, through empty southern highways and neon-colored rain. Oh Lord, can you hear this old guitar and fear? Every road I ride leaves another scar inside. Bartender wipes the dust from empty glass, watching lonely shadows slowly pass. Jukebox humming low in smoky air, playing songs for souls beyond repair. Moonlight falling on these worn-out boots, while silence hangs beneath the roof. And every chord I play tonight alone feels like searching for a place called home. Train wheels crying near the riverside, like the ghosts of dreamers left behind. Smoke keeps dancing underneath the blue, while this old world keeps breaking in two. These crossroads after midnight still pull me through the storm, like distant thunder rolling before the night is gone. Oh Lord, stay near tonight beneath this fading light. Every dream I knew turns back into the blue. Standing at the crossroads, late at night alone. Cold wind blowing through flesh and bone. Street lights trembling underneath the rain. Like tired hearts learning how to break again. Oh, black guitar hanging by my side, full of songs I've always tried to hide. Every mile behind me feels the same. Every broken town still knows my name. Crossroads, midnight blues, calling out my soul. Like a dark old river, too deep to control. Oh Lord, hear my prayer floating through the southern air. Every road I choose leads into these blues. Smoke drifts slowly through the neon light, while lonely strangers drink away the night. Bartender says some wounds don't heal, and tonight I finally know how that feels. Train tracks humming underneath the storm, like tide ghosts trying to stay warm. And every note my guitar softly cries feels like one more beautiful goodbye. Delta moon hanging low above the river tonight. Silver reflections dancing in the pale light. Old wooden porch creaking underneath my feet, while distant thunder rolls through the summer heat. My cigarette burns slow beside this rocking chair. Southern wind moving softly through the air, and every lonely cricket singing in the dark feels like another memory inside my heart. Delta moonlight blues, soft and low tonight, like an old forgotten prayer floating through the night. Oh Lord, hear my soul trying hard to stay whole. Every road I choose leads back to these blues. Rain clouds gather slowly over county lines, like old regrets buried deep in time. My guitar hums with a worn-out sound, like a tired man still drifting around. Oh, radio playing from the room inside, songs about lovers who never survive. And somewhere far beyond the riverbed, another lonely night begins again. Delta moonlight blues rolling through my veins, like muddy southern water after endless rain. Every dream fades slow, like smoke beneath the moon. Still singing these blues to an old forgotten tune. blow softly through this tired southern town. Old pickup trucks and faded signs breaking down. Neon buzzing outside the corner store, like memories I can't escape anymore. My boots feel heavy from these endless miles. Too many heartbreaks hidden behind smiles, and every cigarette burns slower tonight underneath this lonely yellow light. Dust and bones blues running through my soul, like an old black river nobody can control. Oh Lord, can't you see what these old roads did to me? Every dream I lose turns into dust and blues. Old bartender says the night's still young, but these tired lungs have sung enough songs. Train whistles echo somewhere far away, like ghosts begging me to stay. My guitar strings hum with a cracked old sound, like a worn-out man still drifting around. And every note beneath this southern sky feels like one more slow goodbye. Dust and bones blues, heavy as the rain, like old scars hiding deep beneath the pain. Every road I ride, every town I choose, still leaves me stranded with these dust and blues. Midnight train rolling through the rain, steel wheels crying like human pain. Coffee grows colder beside my hand as I watch the storm move across the land. beside the road. Another lost town carrying heavy souls. Old radio singing soft and low, songs about places I'll never know. Lonely train blues tonight, rolling through my soul like an endless highway, with nowhere left to go. Oh Lord, hear that sound as the rain keeps falling down. Every passing tune sings these lonely blues. Dusty suitcase lying by the door. I've seen too many towns before. Every neon light starts looking the same. Every heartbreak carries your name. My old guitar still understands the things this world never planned, and every chord beneath the moonlight sky feels like one more long goodbye. Lonely train blues tonight, slowly drifting on, like the whistle of a train just before the dawn. Every road I take, every mile I lose, still leads me back to these lonely blues. Rain keeps falling on the Mississippi road. Old guitar singing like a weary soul. Smoke from my cigarette fades into the night, while neon shadows dance beneath the pale light. Cheap whiskey burning slowly in my chest, trying to calm a heart that never rests. Every passing train sounds lonely and low, like memories from a life long ago. These midnight river blues keep pulling me I choose leads back to these blues. Dusty boots walking through an empty town. Every lost soul keeps looking down. Oh, jukebox crying in the corner bar, playing songs for hearts left scarred. Through the southern trees, like ghosts whispering old melodies. And every note my guitar plays tonight feels like holding on to fading light. These midnight river blues run deeper every year, like thunder in the distance, slowly drawing near. Oh Lord, hear my cry beneath this endless sky. Every dream I lose turns into these blues. Neon signs glowing through the midnight rain. Every small town highway starts to look the same. Cheap whiskey bottle resting by the sink, while lonely hearts sit quietly and think. Old jukebox humming in the corner bar, playing songs for people carrying scars. Smoke hangs heavy underneath the light, like broken souls hiding from the night. Neon whiskey road, take me far away, past the empty bars, memories that stay. Feels home. Every road I choose turns into these blues. Scream about all the things that could have been. Train tracks shining underneath the storm, like old ghosts trying to stay warm. My guitar keeps singing soft and slow, things this world will never know. home. Rain falls gently on a Delta town tonight. Street lights flicker in the fading light. Old men drinking slowly at the bar, talking about dreams that never got far. Smoke rises softly through the quiet room, like tired flowers trying hard to bloom. And every lonely blues song on the radio sounds like somewhere I used to know. Rain on the Delta tonight, cold against my skin, like old broken memories coming back again. Oh Lord, hear my cry underneath this southern sky. Every love I lose turns into these blues. My guitar rests heavy against the wall, like it already knows the rise and fall of every lonely soul that passes through, searching for something real and true. Wind moves softly through the pine wood trees, carrying old forgotten melodies. And somewhere down the darkened railway line, another lonely heart is losing time. Rain on the Delta tonight, slowly washing through like muddy river water, pulling me from you. Every road I roam, every dream I chase, still leaves these old blues written on my face. heavy in this old blues bar. Streetlights shimmer from passing cars. Bartender pouring another round slow as old train whistles echo below. My guitar hums with a tired sound, like a lonely soul still wandering around. Every broken memory comes alive tonight under neon glow and candlelight. Smoky Delta night, burning low and warm, like an old blues record spinning through the storm. Every lonely mile, every faded sign still brings me back to the ghosts inside my mind. Rain taps softly on the window pane, trying hard to wash away the pain. But every melody still calls your name, and every midnight feels the same. Southern wind moves through the trees so slow, like secrets only lonely hearts know. And somewhere far beyond this town, another tired sun is going down. Smoky Delta night, hold me till the dawn, like the last old memory before it's gone. Every road I ride, every dream I chase still leaves your shadow in this empty place. Cold wind blowing through the Delta night, rusty street lamp barely shining light. Old six-string crying by the motel sign, like a broken prayer lost somewhere in time. River keeps rolling dark and slow, carrying secrets only drifters know. Every heartbeat echoes through the rain, like an old freight train full of pain. These crossroads after midnight keep calling out my name, through empty southern highways and neon-colored rain. Oh Lord, can you hear this old guitar and feel every road I ride leaves another scar inside. Bartender wipes the dust from empty glass, watching lonely shadows slowly pass. Jukebox humming low in smoky air, playing songs for souls beyond repair. Moonlight falling on these worn-out boots, while silence hangs beneath the roof. And every chord I play tonight alone feels like searching for a place called home. Train wheels crying near the riverside, like the ghosts of dreamers left behind. Smoke keeps dancing underneath the blue, while this old world keeps breaking in two. These crossroads after midnight still pull me through the storm, like distant thunder rolling before the night is gone. Oh Lord, stay near tonight beneath this fading light. Every dream I knew turns back into the blue. Standing at the crossroads late at night alone, cold wind blowing through flesh and bone, street lights trembling underneath the rain, like tired hearts learning how to break again. Oh, black guitar hanging by my side, full of songs I've always tried to hide. Every mile behind me feels the same. Every broken town still knows my name. Crossroads, midnight blues, calling out my soul, like a dark old river, too deep to control. Oh Lord, hear my prayer, floating through the southern air. Every road I choose leads into these blues. Smoke drifts slowly through the neon light, while lonely strangers drink away the night. Bartender says some wounds don't heal, and tonight I finally know how that feels. Train tracks humming underneath the storm, like tide ghosts trying to stay warm. And every note my guitar softly cries feels like one more beautiful goodbye. Crossroads, midnight blues, hold me till the dawn, like the fading echo of an old sad song. Every dream I chase, every love I lose, still leaves me standing in these midnight blues. Delta moon hanging low above the river tonight, silver reflections dancing in the pale light. Old wooden poles creaking underneath my feet, while distant thunder rolls through the summer heat. My cigarette burns slow beside this rocking chair, southern wind moving softly through the air, and every lonely cricket singing in the dark feels like another memory inside my heart. Delta moonlight blues, soft and low tonight, like an old forgotten prayer floating through the night. Oh Lord, hear my soul trying hard to stay whole. Every road I choose leads back to these blues. clouds gather slowly over county lines, like old regrets buried deep in time. My guitar hums with a worn-out sound, like a tired man still drifting around. Oh, radio playing from the room inside, songs about lovers who never survive. And somewhere far beyond the riverbed, another lonely night begins again. Delta moonlight blues rolling through my veins, like muddy southern water after endless rain. Every dream fades slow, like smoke beneath the moon. Still singing these blues to an old forgotten tune. Dust blows softly through this tired southern town. Old pickup trucks and faded signs breaking down. Neon buzzing outside the corner store, like memories I can't escape anymore. My boots feel heavy from these endless miles. Too many heartbreaks hidden behind smiles, and every cigarette burns slower tonight underneath this lonely yellow light. Dust and bones blues running through my soul, like an old black river nobody can control. Oh Lord, can't you see what these old roads did to me? Every dream I lose turns into dust and blues. Old bartender says the night's still young, but these tired lungs have sung enough songs. Train whistles echo somewhere far away, this day. My guitar strings hum with a cracked old sound, like a worn-out man still drifting around. And every note beneath this southern sky feels like one more slow goodbye. Dust and bones blue, heavy as the rain, like old scars hiding deep beneath the pain. Every road I ride, every town I choose, still leaves me stranded with these dust and blues. Midnight train rolling through the rain, steel wheels crying like human pain. Coffee grows colder beside my hand as I watch the storm move across the land. Cheap motel glowing beside the road, another lost town carrying heavy souls. Old radio singing soft and low, songs about places I'll never know. Lonely train blues tonight, rolling through my soul like an endless highway with nowhere left to go. Oh Lord, hear that sound as the rain keeps falling down. Every passing tune sings these lonely blues. Dusty suitcase lying by the door. I've seen too many towns before. Every neon light starts looking the same. Every heartbreak carries your name. My old guitar still understands the things this world never planned, and every chord beneath moonlight sky feels like one more long goodbye. Lonely train blues tonight, slowly drifting on, like the whistle of a train just before the dawn. Every road I take, every mile I lose, still leads me back to these lonely blues. Rain keeps falling on the Mississippi road. Old guitar singing like a weary soul. Smoke from my cigarette fades into the night, while neon shadows dance beneath the pale light. Cheap whiskey burning slowly in my chest, trying to calm a heart that never rests. Every passing train sounds lonely and low, like memories from a life long ago. These midnight river blues keep pulling me down slow, like muddy southern water where broken dreamers go.
Is struggling to find enough people to borrow money from. So what are they doing? They're increasing their rescue operations, intervention. And this is bad for the US government, and this is bad for you and me. So let me explain. Okay, so why does the government need to borrow money? And the answer is actually very straightforward. It's because the US government has an overspending problem. They spend more money than they make. So this year, the US government's going to spend about $7 trillion, and they're going to make in tax revenue, tax collections, about $5 trillion. Okay, so how does that happen? How does that work? How do you spend $7 trillion when you only make $5 trillion? The answer is very straightforward. They borrow the difference. They borrow money from individuals, from private institutions, from other countries, etc. All right, then that leads us to this very good question. Why doesn't the US government just print the money instead of borrowing money? And the answer is very simple. It's because you have to remember that the US government does not have a money printer. That's the Federal Reserve. And the Federal Reserve is not a part of the US government. Therefore, the US government, to fund their overspending problem, they have to borrow the money. Now, let's answer this question. How does the US government borrow money? Like, how does it actually work? So the US government issues IOUs that investors can buy. They're called Treasury Securities. And honestly, you probably have some of these in your retirement accounts if you allocated any of your retirement money to a bond fund, to a target date fund, a balance fund, a fixed income fund, etc. So maybe you remember, some of those words like the title of the funds when you were allocating your money. I'm sure you didn't read the fine print. But Treasury bills are IOUs that come due. They mature in 1 year or less. Treasury notes are IOUs that come due in 2 to 10 years. And you have Treasury bonds that are IOUs that come due in 20 to 30 years. Anyways, what's going on here is very simple. The US government needs money. An investor, which can be you, institutions, other countries, they buy a Treasury security, which again is like an IOU, and the US government pays you interest for lending them money. So basically, anybody that holds a Treasury security, the US government is paying them interest. Now, I just want to say that it's very important that you understand that the bond price and the interest rates have an inverse relationship. So I'm going to explain this in a way that everybody understands. So, okay, here's the high-level overview of it. If the bond price falls, then the interest rate goes up. If the bond price increases, then the interest rate goes down. Again, don't worry, I'm going to explain it very thoroughly. And I'm going to do so with an example, a very simple one. So let's just say that you need money right now. And let's just say that so me, Brian, I'm an investor willing to lend you money. And I want you to tell me which scenario is going to be better for you and which one's going to be better for me. So let's take a look at scenario A. In this scenario, I'm going to give you $97 right now, and you're going to pay me back $100 in 1 year. Okay, so that's the first scenario. And then the next scenario is that I'll give you $94 right now, and you pay me back $100 in 1 year. So you being the person that needs money, which is a better scenario for you? Now, obviously, scenario A is going to be it's going to be much better for you. Okay, well, why is that? It's because in scenario A, you're getting charged an interest rate of 3% a year. And in scenario B, you're getting charged an interest rate of 6% a year. So, it's as simple as that. As the price goes down, the interest rate goes up. If the price goes up, the interest rate goes down. It's an inverse relationship between the two. And you know what? This is going to make it even easier for you to understand. So we have two scenarios, A and B. And in scenario A, you pay $97 for this Treasury IOU right now, and then the government's going to pay you back $100 in 1 year. And then your scenario